So the next chapter what we are going to start is consolidated financial statements. Consolidated financial statements. So in consolidated financial statements, we are going to learn three accounting standards. One is Accounting Standard 21, Accounting Standard 23, Accounting Standard 27. Three standards we are going to cover in this chapter. So, Accounting Standard 21, Consolidation of Subsidiary. Consolidation of Subsidiary. Accounting Standard 23, Consolidation of Associate Company. Accounting Standard 27, Consolidation of Joint Venture. Consolidation of Joint Venture. So 21, 23, 27. These are the three standards we are going to cover in this chapter. But in these three, consolidation of subsidiaries is very, very important. So from this chapter, sir, you can expect a 14 marks question. Big question will come. They will ask you to prepare the consolidated balance sheet. Generally, maybe consolidated P&L account also they can ask. Mostly they are asking a question from Accounting Standard 21. Accounting Standard 21. Of course, from Accounting Standard 21 or from this chapter, there is a small question is also a possibility. One big question, one small question they can ask from this chapter. So 14 marks minimum, up to 20 marks they can ask from Consolidated Financial Statements chapter. Okay. So let us first start with Accounting Standard 21, that is Consolidation of Subsidiary Company. Consolidation of Subsidiary Company. Sir, in this first you need to understand the concept of parent and subsidiary company. Concept of parent and subsidiary company. Suppose there is a company A Limited, sir. If A Limited is controlling B Limited, then we say there is a parent subsidiary relationship. Parent company also known as holding company. Parent company also known as holding company. Suppose if A Limited is controlling B Limited, then we say A Limited is the parent company, B Limited is the subsidiary company, right? So how this control will be achieved, sir? There are two ways a control can be achieved. One company is controlling another company. How control is possible? Control is possible because of two ways. One is having more than 50% voting power. If one company is having more than 50% voting power in another company, we say there is a control. Or if one company is having control over composition of board of directors of another company, we say there is a control. What is control over composition of board of directors? Ability to appoint or remove either all or majority of board of directors. If one company is able to appoint or remove either all or majority of the board of directors, then we say we have control over composition of board of directors. For example, in B Limited, there are 10 directors. If A Limited can either remove all the directors or majority of the directors, 6 or more, either it can remove or it can appoint, we say there is a control. But majority of your problems you are going to see only this one, that is parent company is having more than 50% of voting power. Tell me how one company will have more than 50% of voting power in another company? By having shares. By having which shares? Equity shares. Equity shares. So before we are going to understand about consolidation, first we need to understand that there must be the concept of parent and subsidiary. And this parent subsidiary relationship will come only through control. And this control will be achieved through either having more than 50% voting power or having control over composition of board of directors. Okay. Now the next point. Suppose you are A Limited, you are the parent company. Your subsidiary is B Limited, it's a subsidiary company of yours. At the end of the year, A Limited will prepare its individual financial statements. They will prepare their balance sheet, P&L account, cash flow statement, notes to accounts. As well as subsidiary company, they will prepare their individual financial statements. Their balance sheet, their P&L, cash flow statement, notes to accounts, they will prepare. But if you look at the financial statements of the parent company, you will understand about the financial position, financial performance of only parent company. If you look at the financial statements of subsidiary company, you will understand the financial position and performance of only subsidiary company. But I want to know the performance and financial position of the group. Parent along with its subsidiary, I need to know the performance. I need to know the financial position. So, therefore, parent and subsidiary together, we need to prepare the financial statements. Those are called consolidated financial statements. So, consolidated financial statements are financial statements of the parent along with its subsidiary together. So, in financial statements, we will prepare consolidated balance sheet, consolidated P&L account, consolidated cash flow statement, consolidated notes to accounts. We will prepare. And sir, why as a parent company I need to prepare consolidated financial statements? Because it is mandatory legal requirement as per section 129 of the Companies Act. As per section 129 of the Companies Act, a parent company has to prepare consolidated financial statements. And also sir, the procedure for consolidation of subsidiary is prescribed in Accounting Standard 21. Accounting Standard 21. So tell me, as a parent company, is there any legal requirement for me to prepare the consolidated financial statements? Yes, as per section 129. Now tell me, to prepare the consolidated financial statements, so what is the procedure? Where that procedure has been prescribed? AS 21. That's why I need to learn Accounting Standard 21. Accounting Standard 21. Okay. So therefore, consolidated financial statements are nothing but financial statements of the parent along with its subsidiary. By treating parent and subsidiary as one single economic entity. One entity only. Parent and subsidiary, if they are treated as one entity, by assuming them as one entity, if I start preparing the financial statements, those are called consolidated financial statements. Those are called consolidated financial statements. See this, see the material. So first, consolidated financial statements. Consolidated financial statements are the financial statements of a group, presented as those of a single enterprise, where group includes parent and all its subsidiary. So if I prepare the financial statements for the group, group means parent, subsidiaries. That is called consolidated financial statements. So the parent company must provide financial information for the entire group, not just itself, by preparing the consolidated financial statements. So being a parent company, sir, if I prepare my own financial statements, that anyway I will do at the end of the year, that is not sufficient, sir. I need to prepare the financial statements for the entire group also. So that is called consolidated financial statements. And this consolidated financial statements will show what? Financial position, financial performance, the resources, assets, obligation, liabilities, and overall results of the parent and its subsidiaries as a single entity. Suppose total assets of the group, total liabilities of the group, and what is the total profit of the group? I want to know. Reliance Group, total assets. Reliance Group, total liabilities. Reliance Group, total profits. I want to know. So they will prepare consolidated financial statement. And AS 21 is mandatory if an enterprise presents consolidated financial statements. AS does not mandate an enterprise to present CFS. However, if it chooses to do so for legal compliance or any other reason, it must follow AS 21 while preparing and presenting consolidated financial statements. Sir, accounting standard 21 in its standards doesn't say this standard is applicable for this enterprise. But any parent company, if they are preparing consolidated financial statements, they need to compulsorily follow accounting standard 21. They need to compulsorily follow accounting standard 21. Okay, so you understand about consolidated financial statements, sir? So to put it simply, if you prepare the financial statements for the group means parent and subsidiary, that is called consolidated financial statements. And definitions, you see, group means parent and its subsidiaries is called group. Parent means a company which is having control over other enterprise, controls one or more subsidiary. Subsidiary means a company which is controlled by parent. A company which is controlled by parent or another enterprise is called subsidiary. And see, in subsidiary there are two types, sir. One is wholly owned subsidiary, another one is partly owned subsidiary. Wholly owned subsidiary means if parent company is having 100% shares in the subsidiary, that is called wholly owned subsidiary. If the parent company is having more than 50 but less than 100, that is called partly owned subsidiary. So in case of wholly owned subsidiary, no minority interest. What is minority interest? That means other shareholders. If 100% is held by parent company itself, then there are no other shareholders in subsidiary. That means no minority interest. No minority interest. Suppose in case of partly owned subsidiary, parent company is having 80%. That means remaining 20% of the subsidiary is held by minority shareholder. So like this, subsidiaries can be two types: wholly owned subsidiary, partly owned subsidiary. Okay, so very simple. Next important definition, control. Sir, tell me, sir, first concept only I told, parent subsidiary concept. How you become a parent? By having control. How control will be achieved? Two ways. One is more than 50% voting power or control over composition of board of directors. If one company holds more than 50% of the voting power in a subsidiary, either directly or through other subsidiaries, that is one way. Or when one company has the ability to control the composition of board of directors or governing body of the subsidiary. If one company has the ability to remove or appoint either all or majority of the board of directors, then we say we have control. So control can be achieved these two ways. Next, what are the components of consolidated financial statements? Generally in financial statements we prepare what? Balance sheet, P&L, cash flow statement, notes to accounts. Even for consolidated financial statements also, consolidated balance sheet, consolidated P&L account, consolidated cash flow statement, consolidated notes to accounts. Those are called components of consolidated financial statements. See this: consolidated balance sheet, consolidated P&L account, consolidated cash flow statement, notes to accounts, and explanatory schedules. These are all together, so we call it as components of consolidated financial statements. Sir, one more interesting point, sir. When you are preparing the consolidated financial statements, which format I need to follow? Which format? Schedule 3. To the extent possible, I need to prepare the consolidated financial statements by following the format which is prescribed in Schedule 3. We have learned in first chapter, sir, Schedule 3, how the financial statements of the company is prepared. So the same format we need to follow. So see this. CFS are presented to the extent possible in the same format as that adopted by the parent for its separate financial statement. When a parent company prepares its separate financial statements, definitely it will follow Schedule 3, right? So to the extent possible, even consolidated financial statements are also prepared in the same format. Okay. Next, sir, what are the advantages of consolidated financial statements? Tell me. Suppose if I prepare financial statements, if parent company is preparing financial statements for the entire group, what are the advantages? So I told you, see, there are 4 advantages which is there here. See this. First one, single source document. Single source document means if I want to check how this group is performing, I am not required to see lot of documents. If I check only consolidated financial statements, it is sufficient. That's why it is called single source document, because this CFS provides overall view of the group's performance. So when you look at the consolidated financial statements, consolidated balance sheet, P&L account, you see, you will get an idea as a group how much assets are there, how much liabilities are there, how much profits they have earned. So we easily know. So therefore it's a single source document. With one document will give you overall view about the organization. Next, intrinsic value of the share. What is intrinsic value? Real value. If I want to determine the real value of the parent company, real value of the share, holding company share, I need to consider the consolidated financial statements. Sir, why only individual financial statements not sufficient? Not sufficient. Individual financial statements not sufficient, sir. We need to see the consolidated financial statements. Because as a parent entity, sir, how you are performing, at the same time, wherever you invested, your subsidiary company, how subsidiary is performing will also affect your valuation. That's why intrinsic value of the share. The consolidated balance sheet helps calculate the real value of the holding company shares. And also acquisition of subsidiary. Suppose when parent company acquires any subsidiary company, in that subsidiary company, how much is the minority interest? That will also we know by by preparing the consolidated financial statements. And also evaluation of the holding company. So CFS allows investors to assess the financial health of the holding company for investment or acquisition decisions. So these are the advantages, sir. We know the overall performance of the group. Now scope of AS 21. Definitely this standard is applied in preparation and presentation of CFS of the group under the control of the parent. But the standard does not cover, simple sir, see this, methods of accounting for amalgamation and their effects on consolidation, including goodwill from amalgamation. Sir, AS 14 we have done, sir, AS 14, amalgamation. In amalgamation in purchase method, when the PC is more than net assets, we got goodwill. So the goodwill treatment is done as per AS 14. So therefore this standard is not applicable. AS 21 cannot be applied for methods of accounting for amalgamation and their effects on consolidation, including goodwill from amalgamation. And also accounting for investment in associates, because investments there is a separate standard, sir, AS 23. So therefore cannot be AS 21 cannot be applied. And also accounting for investments in joint venture, AS 27 is applicable. So this standard is not applicable. Okay. And most important topic, sir, exclusions from preparation of consolidated financial statements. Sir, when a subsidiary is excluded from consolidation, generally if you are a parent company, you will consider subsidiary and prepare the consolidated financial statements. But A subsidiary is excluded from consolidation when in two situations. One is temporary control. Another one is severe long-term restrictions. One is what, sir? Temporary control. Temporary control. For example, you purchased shares of subsidiary, sir, but you don't want to continue. You want to sell it in the near future. With that intention, if you purchase the shares of any company, so then that kind of subsidiary you cannot consider for consolidation. For example, A Limited purchased 60% shares of B Limited. But with what intention they purchased? They want to sell it in the near future. Whenever they will get good price, they will sell it in the market. That means here there is no intention for the parent company to control the subsidiary company. We invested in subsidiary company only for temporary control. So AS 21 says, if any subsidiary you acquired with an intention to temporary control, we don't want to continue the investment, you don't want to control, then that kind of subsidiary cannot be included for consolidation. No need to consider that kind of subsidiary for consolidation. So temporary control, see this. If control is intended to be temporary, such as when subsidiary is acquired for subsequent disposal in near future. See this, subsequent disposal in near future. Subsidiary is acquired for what? Subsequent disposal in near future. Then such kind of subsidiaries, please don't consider for consolidation. And also severe long-term restrictions. Severe long-term restrictions. What is the severe long-term restrictions? Suppose there is a subsidiary, sir, which is situated outside India. Now there are some restrictions in our subsidiary in that country. Now our subsidiary is unable to send fund backs to the parent company. Then when your subsidiary is operating under severe long-term restrictions, don't consider such kind of subsidiaries for consolidation. For example, we have a subsidiary in Ukraine. Okay. Now that subsidiary, that government has imposed certain restrictions. Because of that restrictions, our subsidiary is not able to send funds back to the parent. Then such kind of subsidiaries cannot be considered for consolidation. Because the main object of subsidiary is what, sir? From the subsidiary, the benefits must come to parent company. If the subsidiary itself is operating under severe long-term restrictions, then those kind of subsidiaries cannot be considered for consolidation. See this, it operates under severe long-term restrictions, which significantly impair its ability to transfer funds to the parent. For example, if a parent company owns a subsidiary in a country with capital controls preventing fund transfers for long period, the subsidiary might be excluded from consolidation. So such kind of subsidiaries must be excluded from consolidation. Okay now? So these are the basic theory we have discussed, sir. So what is the meaning of CFS? Definitions. And what are the components of consolidated financial statements? Advantages, scope and exclusions from preparation of consolidated financial statements. So tell me, if you want to prepare the consolidated financial statements, you should be a which company? Parent company. You should have a subsidiary. And how any company will become your subsidiary? You should have a control. How control will be achieved? More than 50% or control over composition of board of directors. And when this subsidiary is excluded from consolidation, when the control is temporary, you don't want to control it. Second, when subsidiary is operating under severe long-term restrictions, which significantly impair its ability to transfer funds back to the parent, then those kind of subsidiaries we will not consider for consolidation. Okay. Okay. Now, according to law, is it mandatory for parent company to prepare consolidated financial statements? Yes, as per section 129. Now, if you want to consider subsidiary for consolidation, which accounting standard is applicable? AS 21. According to that standard, we need to consolidate. Okay. Now, the next thing what we are going to discuss is consolidation procedure. So, listen to me carefully. Suppose I am the parent company. Now I need to consider my subsidiary and I need to prepare financial statements for the group. right? Now to do this, what is the procedure I need to follow? What is the procedure I need to follow? That procedure we need to learn. That procedure we need to learn. Actually, sir, if you look at our material, sir, I have divided the entire procedure into 9 steps. You see, I have divided the entire consolidation procedure. You see this procedure. Steps for preparing consolidated financial statements. Very, very important, sir. Steps for preparing consolidation procedure. So in our material, sir, I have given 9 steps for preparing consolidated balance sheet. Very, very important, Anna. These 9 steps, if you follow carefully, I think you can able to prepare any consolidated balance sheet. And see, these 9 steps are, every step is logical and interrelated with each other. Logical as well as interrelated with each other. You see here, first just I will read the step names. Step 1, date of acquisition. Step 2, shareholding pattern. Step 3, analysis of subsidiary company reserves and surplus. Step 4, apportionment of profits. Step 5, minority interest. Step 6, cost of control. Step 7, intercompany transactions. Step 8, reserves for consolidated balance sheet. And the last step, preparation of consolidated balance sheet. So, date of acquisition, shareholding pattern. Third step, analysis of reserves and surplus of subsidiary company. Fourth step, apportionment of profits. Step number 5, minority interest. Step number 6, cost of control. Step number 7, intercompany transactions, intercompany owings. And then steps 8, reserves for consolidated balance sheet. And the last step is preparation of consolidated balance sheet. These are the steps we are going to follow. Now see, important. In these steps, Nana, the major step is step number 3, analysis of subsidiary company reserves and surplus. Analysis of subsidiary company reserves and surplus. If you not done properly this analysis, every other step will go wrong. In consolidation, step number 3 is the most important step. Okay? If you do step number 3 wrong, remaining steps obviously wrong. So you have to be very careful when you are analyzing the subsidiary company reserves and surplus. Sir, what is this analysis of reserves and surplus of subsidiary company? Why we will do the analysis? Everything I will explain. But first understand, fix in our mind that whenever as a parent company I want to prepare the consolidated balance sheet, there are 9 steps. Okay? In these 9 steps, step number 3, analysis of subsidiary company reserves and surplus. Step number 5, minority interest. Step number 6, cost of control. And then step number 8, reserves for consolidated balance sheet. These 4 are the most important steps. Can you tell me what are the 4 most important steps of consolidation? Analysis of subsidiary company reserves and surplus. That is one step. Next step, minority interest calculation. Next, cost of control calculation. Next, reserves for consolidated balance sheet. These steps are very, very important. Now, what we will do is, we will try to understand these steps with small examples. See, solving a direct question is not a good idea, because these steps you will understand better only if you learn it in a gradual manner. So what I will do is, I will solve some examples. In those examples, I will try to introduce each and every step, whatever we are using here. Okay. So we are learning consolidation procedure. Consolidation procedure for what? For balance sheet. Which balance sheet? Consolidated balance sheet. We are preparing consolidated balance sheet of the parent along with its subsidiary. Consolidated balance sheet I am preparing. And for this, what is the procedure? Okay. Now, look at this example, sir. First come to example number 1. Example number 1, sir. You see this example, balance sheet as on 31st March 2025 given. This is the date of acquisition, important. Date of acquisition means parent company acquired subsidiary. On which date? 31st March 2025. On that date, the balance sheet position given. Right? First, look at the asset side. Parent company, subsidiary company assets. PPE. Next, in the parent company balance sheet, you look at investment in 100% shares of subsidiary. See this. Sir, when you look at the individual balance sheet of the parent company, obviously you will find the investment in subsidiary as an asset, na sir? When one company purchased the shares of other company, definitely this is what? My asset. So therefore, in the parent company balance sheet, you see investment in shares of S Limited is there as an asset, right? And this investment in shares of S Limited point of view, this is share capital. Subsidiary point of view, what is the share capital? 70. This 70,000 is actually subscribed by whom? Parent company. 100%, because 100% they have given. Okay, so understand the interlink, sir. I am parent entity. I invested in subsidiary company equity shares. So my investment in my books, asset. Subsidiary point of view, this is share capital. Now see, I know the individual balance sheets. I am able to see. Now I want group balance sheet. Parent along with subsidiary, I need to prepare the balance sheet. How I am going to prepare? That is the most important point. Suppose, sir, in this case, just take assets, add, take liabilities, add, take share capital, add. Consolidated balance sheet is over. Is that correct? The answer is no. Simply adding assets, liabilities, adding share capital, investment is not correct. So then, in this case, how to prepare consolidated balance sheet? So, see here. Consolidated balance sheet. Understand, I am preparing consolidated balance sheet of H Limited, sir. H Limited means parent company. When? As on 31st March 2025 at the end of the year. The date of acquisition, date of consolidation, same date. Okay. So if I prepare the consolidated balance sheet, asset side I will take, liability side I will take. Asset side you see PP, property, plant, equipment, parent company 1 lakh, subsidiary 60, total 160 rupees. Next, current assets, parent company 30,000, subsidiary company 20,000, total 50,000. And similarly come to current liabilities, parent company 30, subsidiary 10, total 40. So simple, assets, liabilities we added. Now come to the major part, sir. Will you consider parent company investment in subsidiary, this 80,000 in the consolidated financial statements. This 80,000 will you consider in the consolidated balance sheet? No. Why? Why we will not consider it? Because understand sir, I am the parent company, this is my investment. In the individual financial statements, this is my asset. But if I prepare group balance sheet, that means this investment is within the group only, na? So therefore, whenever you are preparing consolidated balance sheet, sir, understand sir, parent company investment in subsidiary versus net assets. This investment is replaced with the net assets of subsidiary company. So in the subsidiary company, what are the net assets, sir? Total assets minus liabilities. Total assets 80,000, liabilities 10,000. So 80 minus 10, 70. So therefore, see this, important sir. We need to compare two things, sir. First, cost of investment we need to compare. What is the cost of investment? Parent company investment in subsidiary cost is 80. With this investment, what is the share in net assets of S Limited? How much share in the net assets of S Limited? Here net assets can be ascertained either by assets minus liabilities or share capital plus reserves and surplus. There are two ways to ascertain the net assets. So the subsidiary company net assets, if you see, assets 80,000, liabilities 10,000. That means 80,000 minus 10,000. The net assets are 70,000. Or else I can directly take the share capital plus reserves and surplus. Only share capital is there, 70,000. Reserves and surplus not there, 70,000. 70,000. 70. Therefore, the net assets of S Limited is how much? 70,000. In that, as a parent company, what is my share? 100%. Because I acquired 100% in subsidiary. Therefore, 70,000. Now, I want every one of you to think. I am the parent company. I invested 100% in the subsidiary company. Right? I spend 80,000 rupees. But my share in the net assets of subsidiary is 70,000. That means how much excess I am investing? 10,000. This 10,000 is my loss. This will be treated as goodwill. This will be treated as goodwill. So in the consolidated financial statements, parent company investment in subsidiary will not appear. Instead, in the place of parent company investment in subsidiary, subsidiary company net assets will be incorporated. And if you invest more than the net assets, that will appear as a goodwill. Therefore, in the consolidated balance sheet, I need to write goodwill. How much? 10,000 I need to write. 10,000 I need to write. Because already you see, in the assets, PP, subsidiary company assets are there. How much? 60. Subsidiary company current assets are there. How much? 20. In the current liabilities, subsidiary company liabilities are there. How much? 10,000. That means in the balance sheet, consolidated balance sheet, 80,000 assets of subsidiary, 10,000 liabilities of subsidiary. Already how much is incorporated? 70,000 incorporated, na? 70,000 incorporated in the form of net assets. But how much is my actual investment? As a parent company, what is my actual investment? 80. Therefore, that excess only will be recorded in the consolidated balance sheet. Understand this. So, therefore, in the preparation of consolidated balance sheet, parent company investment will be replaced by the net assets of the subsidiary company. And if you are investing more than the net assets, that will be treated as goodwill. If you invest less than the net assets, that will be capital reserve. So, this step is called cost of control step. Cost of control step. And in our material, this step is step number 6. Step number 6. And in every problem of consolidation, you need to calculate cost of control. And there are individual problems they are going to ask for 5 marks relating to cost of control. How to calculate cost of control? Tell me. 2 things you need to take. First, cost of investment compared with the parent company share in the net assets of subsidiary company. Parent company share in the net assets of subsidiary company. In this case, my cost of investment 80,000. My share in the net assets of subsidiary company 70,000. That means how much excess I spend is my goodwill. That will appear in the consolidated balance sheet. So I incorporated the total net assets of the subsidiary company, and whatever excess I invested, I written as a goodwill in the consolidated balance sheet. So assets over, liabilities over. Now come to the main aspect, sir. Share capital. Equity share capital. Tell me, sir, when you are preparing the consolidated balance sheet, which company share capital you will consider? Parent, subsidiary, or both? Only parent company share capital will be considered. How much? 1,80,000. Why only parent company share capital? Why can't subsidiary company share capital will be considered? Sir, subsidiary company share capital is nothing but contributed, subscribed by parent only. And that too, you are preparing consolidated financial statements from group point of view. So group point of view, the capital which is introduced by the outsiders will be considered. Here in this case, parent company share capital 1,80,000 is contributed by outsiders. But subsidiary company capital majority contributed by parent only. In this example, 100%. And that too, sir, subsidiary company entire net assets. Net assets can be assets minus liabilities or share capital plus resource and surplus. Already incorporated, sir. Again, if I add the share capital also, it will be double times addition of the net assets. Double times addition. Sir, understand, sir. Group point of view, think group point of view. The total assets of the group is 1,60,000. Correct. Total current assets of the group 50,000. Everybody will accept. Total liabilities of the group 40,000. But total capital of the group means these two together. Total capital of the group means only capital of the parent. Because this 70,000 is actually invested from parent company only, na? From the parent company amount only this 70,000 came. Therefore, please understand, when you are preparing the consolidated financial statements, consider always parent company share capital. Parent company share capital. Okay, subsidiary company share capital will not be considered. Why? Because the net assets of the subsidiary is already incorporated. This is first example. So what is the speciality of the first example? Speciality of the first example is I have introduced the concept of cost of control. Introduction of cost of control concept. And this cost of control concept, and generally this COC is calculated at what time? At the time of acquisition only. At the time of acquisition, what is the cost of investment? And what is the parent company share in the net assets of subsidiary? Compare those two. If you invest more, goodwill. If you invest less, capital reserve. That will come in the consolidated balance sheet. Okay. Now, this is example number 1, sir. Very simple. Assets, liabilities will be as usually added. Share capital, only parent company share capital will be considered. Parent company investment in subsidiary is incorporated by net assets of the subsidiary company. And any difference between the investment and net assets? Any difference between the investment and net assets will be goodwill or capitals. This is example number 1, sir. Come to example number 2. See this example. Little bit improvement in the position. Suppose here also they have given the balance sheet as on 31st March 2025, sir. This is also on the date of acquisition. On the date of acquisition. So on the date of acquisition, the position given, sir, balance sheet position given. See this, parent company PPE 1 lakh, investment in 80% shares of S Limited 90. Here how much we are investing? 80%. Previous example 100% we invested. Current assets 30 60. Now H Limited, S Limited, equity share capital 2 lakhs, 1 lakhs, current liabilities 20 40. Now if I prepare consolidated balance sheet, in this case consolidated balance sheet of H Limited as on 31st March 2025. So how I am going to prepare the consolidated balance sheet? First, property, plant, equipment, parent and subsidiary. Parent 1 lakh, subsidiary 80. Total 1 lakh 80. Next, investment in 80% shares of S Limited will not come. Why? So we need to compare. See this, investment will be compared with the net assets. Investment will be compared with net assets. So therefore I need to calculate what? Cost of control on the date of acquisition. How cost of control will be calculated? Cost of investment I need to take. How much my investment? 90,000. This 90,000, how much is my share? Share in net assets of S Limited. Correct now? And how S Limited net assets will be ascertained? How net assets of S Limited will be ascertained? Either assets minus liabilities or share capital plus reserves and surplus. And what are the assets and liabilities? Assets minus liability, total assets 1 lakh 40 minus liabilities 40. So 1 lakh 40,000 minus 40,000. So how much? 1 lakh. Or share capital plus reserves and surplus. How much is the share capital? 1 lakh. Reserves and surplus, nothing is there. So 1 lakh. Okay. Plus nil. So total 1 lakh. So the net assets in S Limited is 1 lakh. But you need to understand, sir, in this 1 lakh net assets, what is the share of the parent company? 80% share only. Therefore, my share in the net assets of the subsidiary is 80%. So therefore, 80,000. So therefore, here my investment is 90, but my share in the net assets of the subsidiary company is 80. So how much excess I invested? 10,000. This will be my goodwill. Goodwill. Cost of control is goodwill. This goodwill I need to show in the consolidated balance sheet. How much I need to show? 10,000. 10,000 I need to show. And then current assets. Parent company 30, subsidiary 60. Total 90,000 current assets. Now coming to share capital. I told you we need to consider only parent company share capital. How much? 2 lakhs. Parent company share capital 2 lakhs we need to consider. And as far as the current liabilities is concerned, we need to consider both. Parent company 20,000, subsidiary company 40,000. Total 60,000. And here balance sheet will not tally. Why it will not tally? If you see the balance sheet, sir, 1 lakh 80 plus 10,000, 1 lakh 90 plus 92 lakhs 80,000. Correct? 2 lakhs 80. This side also 2 lakh 80,000 should come, but only 2 lakh 60 is there. Why it is not telling? Because here you need to understand, we acquired only 80% shares in the subsidiary company. That means in the subsidiary company net assets, as a parent company we are eligible only for 80%. But we incorporated 100% of the assets and liabilities of the subsidiary. That means you see, in these assets, 80,000 subsidiary company assets are there. And current assets, 60,000 subsidiary company current assets are there. In current liabilities, 40,000 subsidiary company current liabilities are there. That means 80 plus 60, 1 lakh 40, 1 lakh 40 minus 40, 1 lakh net assets we have incorporated. 1 lakh net assets of the subsidiary company we have incorporated in our books, but actually our control is only 80%, na? So therefore understand, sir, when you are doing the consolidated financial statements, you need to do 100% consolidation. 100% consolidation means total assets and liabilities of the subsidiary company will be incorporated, even though you are having 80%. But legally speaking, sir, you are having only 80%. Remaining 20% is held by other shareholders. Those other shareholders share in the net assets of subsidiary company, you need to recognize, because you are incorporating 100% net assets of the subsidiary company. So in the consolidated financial statements, as a parent company, I am incorporating the total net assets, even though I am having only 80% share. So the remaining 20%, which is held by the outside shareholders of the subsidiary company, that I need to recognize in my books. Sir, is it the liability? A kind of a liability. Case 21 says minority interest. So therefore, here in this case, what we need to do, sir? We need to calculate minority interest. Minority interest. So what is minority interest? Very simple, sir. Suppose S Limited is there, subsidiary company. In the subsidiary company, how much is the net assets? 1 lakh. In this 1 lakh, in the subsidiary company, parent company H Limited is having how much share? 80%. Minority interest is having 20%. Therefore, 80,000 is your share in the net assets. 20,000 is the share of minority shareholders. But this 20,000 belongs to the minority shareholders. Because you are recognizing total 1 lakh in your books, in the consolidated balance sheet we see 1 lakh you are recognizing, even though you have the eligibility of only 80%. Therefore, this 20,000 which is belongs to the minority shareholders, that you need to recognize in your books. So therefore, here in the consolidated balance sheet, we need to recognize minority interest. So what is minority interest? Minority shareholders share in the net assets of subsidiary company. Subsidiary company net assets how much? 1 lakh. In that, minority shareholders share how much? 20%. So that will be called 20,000. 20,000. That means indirectly what is happening? Say this. We have incorporated 1 lakh worth of net assets of subsidiary and we are recognizing minority interest 20. That means 1 lakh minus 20, 80,000 only we are incorporating. But you do 100% consolidation while incorporating assets and liability, 100% you incorporate. In that 100%, whatever belongs to minority shareholders, you write separately. Ultimately, you are recognizing only your share only. In the subsidiary company, you have 80% here. In the subsidiary company, 1 lakh is their net assets. In that 80,000 only your share. You recognize 1 lakh in consolidation. And in that 20,000 belongs to minority shareholders, you record separately. That's why in the consolidated financial statements, minority interest will also come. What will come? Minority interest. Why minority interest will come? Because in the consolidation, as a parent company, I am incorporating 100% of the net assets of the subsidiary company, even though I am not eligible for 100% share in the net assets. Whatever the share in the subsidiary company net assets belongs to other shareholders, I need to recognize in the books as my minority interest. Minority interest. So in this example, sir, I have introduced one more new concept. What is that, sir? Minority interest concept was introduced. In the first example, cost of control. Second example, minority interest. Now I have a doubt. You tell me. Minority interest is a one-time calculation. Cost of control is a one-time calculation. Every year we need to calculate. Cost of control. Cost of control, is it a one-time calculation? Is it calculated by using the information on the date of acquisition, or every time you are doing consolidation every year and you need to calculate date of? Sir, cost of control is calculated by using the information on the date of acquisition. as a parent company, on which date you are acquiring the subsidiary. On that date in the subsidiary, what is, how much you are investing, your cost, what is the share in the net assets. The difference is goodwill or capitalism, right? So it is calculated on the date of acquisition. Every time it will not change that goodwill or capitalism. It will be same, because what is the investment value, cost of investment, and how much worth of net assets you are getting on that day, on the date of investment, on the date of acquisition. So the difference is nothing but goodwill or capitalism. So instead of parent company investment in subsidiary, net assets of subsidiary company will be incorporated. But when you are not 100% eligible for the net assets of the subsidiary company, when doing consolidation you incorporate, but whatever the portion belongs to minority shareholders, you need to recognize separately. And minority shareholders is not a liability, sir, but we need to show on the liability side. After share capital, before non-current liabilities. It is not shareholders fund, but we need to show separately. You understand this, sir? So this is how we need to do. So two important steps I introduced, and you tell me minority interest is covered in which step? Step number 5 in our procedure. Cost of control, step number 6. So in consolidation procedure, I told you 4 steps are important. Analysis of reserves of subsidiary company, minority interest, cost of control. So I introduce cost of control step. This cost of control, every time you need to calculate, I mean every problem definitely cost of control will be determined. Tell me quickly, to determine cost of control, what are the 2 components you compare? Cost of investment with net assets, share in the net assets of subsidiary. On which date? Date of acquisition. Date of acquisition, right? And how to calculate minority interest? Minority shareholders share in the net assets of subsidiary. Either you take assets minus liability, net assets into minority share, or share capital, reserves and surplus in that minority shareholder share. Now in this example, sir, in this example, minority interest can be calculated like this. See this. Minority interest can be calculated. What is the share capital of the subsidiary company? 1 lakh. 1 lakh is there na? So simply 1 lakh into 20%. How much? 20,000 is the minority interest. Because net assets can be assets minus liabilities or simply share capital plus reserves and surplus. So therefore, whenever you want to find out the net assets, don't waste your time by following assets approach. Instead, you see just share capital plus reserves and surplus. On that you apply minority interest. So this is example number 2, sir. Now come to example number 3, sir. Example number 3. Example number 3, sir. See this example. This is also balance sheet given on 31st March 2025. Date of acquisition. Same date, date of acquisition given, sir. Date of acquisition. Asset side you see PPE 2,80,000. Investment in 80% shares of S Limited 1 lakh. Current assets 1,70,000. Share capital 3,80,000. Reserves and surplus also given. The difference between previous example and this example is, in this example reserves and surplus also there. Okay. That means if I want to find out the subsidiary company net assets, total assets minus liabilities, or simply adding share capital plus reserves and surplus. Simply adding these two, 1 lakh, or else 1,50,000 minus 50, 1 lakh. Therefore, that's what I am taking. That's what I am saying. When you want to find out the subsidiary company net assets, just add share capital plus reserves and surplus. Now, in this case, if I calculate, if I prepare consolidated balance sheet of H Limited as on 31st March 2025. So how I am going to prepare the consolidated balance sheet? First I will take PP. Sir, even though I am having 80%, will I take subsidiary company total assets and liabilities for consolidation? Yes. 100% consolidation I will do, and after that I will calculate minority interest. So therefore in this case PP 2,80,000. 2,80,000 80,000 PPE. Next, investment in 80% will not come. In that place, subsidiary company net assets will be replaced. Current assets 1,70,000. Next, when it comes to share capital, we will take only parent company, holding company share capital. How much? 3 lakhs. 3 lakh share capital. And then current liabilities, if I take 30 plus 50, 80,000. And then cost of control, I need to decide now. I need to compare my cost of investment. What is the cost of investment? 1 lakh. And what is the share in net assets of S Limited? How to find out net assets of S Limited? Assets minus liabilities or share capital plus reserves and surplus. 1 lakh, correct now? So share capital plus reserves and surplus. How much? 1 lakh. In that, what is my share? 80% parent company. That means 80,000. So my share in the net assets 80, but my cost is 1 lakh. So how much excess? What is this? Goodwill. Goodwill will come. So therefore, in the consolidated balance sheet, we need to write goodwill 20,000. And also one more thing we need to calculate, minority interest. Minority interest means minority shareholders share in the net assets of subsidiary company. In the subsidiary company net assets, share capital 80,000. In that 20% minority shareholders. How much? 16,000. Reserves and surplus 20,000. In that 20% belongs to 4,000. So total it will be 20,000. Minority interest 20,000. So this minority interest I need to recognize. I told you the reason also. Because as a parent entity I am doing 100% consolidation of subsidiary, even though I am having only 80%. Therefore, remaining 20% of the subsidiary company net assets belongs to minority shareholders. So I recognized minority interest. And the important thing is reserves and surplus. Tell me, reserves and surplus for the group, which company reserves and surplus we will take? Only parent company reserves and surplus. Subsidiary company reserves and surplus we will not take, because the entire net assets of the subsidiary company were incorporated. If I add it again, it will be a overvaluation. Because the net assets, that is 1 lakh, we have already incorporated in our books. See this, in this assets, in this liabilities, if you take the subsidiary company portion, we have already incorporated 1 lakh's worth of net assets of subsidiary company. Now again, if I add share capital, it will be overvaluation, double counting. I can't do that. And that too, you think from the group point of view. Group point of view, what are the reserves? Parent company reserves are the reserves of the group. Sir, what about subsidiary company reserves? These subsidiary company reserves are on the date of acquisition, sir. On the date of acquisition. Whatever the reserves are there in the subsidiary company on the date of acquisition, sir, those reserves cannot be considered in the consolidated balance sheet. Because they are part of net assets of the organization, subsidiary company, which we are incorporating. And see, when you are calculating the cost of control, you are considering 1 lakh into 80%, 80,000. That means it is already incorporated in the consolidated financial statements. So no need to incorporate again. But remember guys, you need to understand here the important point is date of acquisition 31st March 2025. On that date, this reserves and surplus is there. Suppose for example, date of acquisition, date of consolidation is different. Then whatever the post-acquisition profits are there in the subsidiary, in that post-acquisition profits, parent company share, we need to consider in the consolidated reserves. That I will explain, wait. So therefore here, the reserves and surplus we need to consider only parent company. How much? 70. Okay. So if I consider here, what happens, you tell me? 4 lakhs 70,000. 4 lakhs 70,000. 4 lakhs 70,000. So this is the reserves for consolidated, this is the consolidated balance sheet. So therefore cost of control, minority interest. So two important steps we have done. So can you help me out? What we are learning? We are learning consolidation procedure for preparation of what? Consolidated balance sheet. How many steps are there? 9 steps. First step, date of acquisition. Just steps, date of acquisition. I will tell you the logic also. Why each step I will tell you. Just I am giving the synopsis. Just I am introducing some important steps through these 3 examples. So first, date of acquisition. Second, shareholding pattern on the date of acquisition. Third, analysis of subsidiary company reserves and surplus, which we have not done yet. We will do the analysis of reserves and surplus of subsidiary company. Once analysis completed, apportionment. Once apportionment is done, minority interest. Minority interest. We understood what is minority interest. In the subsidiary company net assets, minority shareholders share. Since subsidiary company entire net assets we are incorporating in the consolidated financial statements, even though we may not have 100% shares. Therefore, we need to calculate minority share and we need to show it in the consolidated balance sheet on the liability side. And next, cost of control. This is the important step. So, on the date of acquisition, being a parent company, what is my cost of investment? And with this cost of investment, what is the share in the net assets of subsidiary? If my cost of investment is more than the share in the net assets, goodwill. If it is less than that, capital reserve. So therefore, in the consolidated balance sheet, we need to show goodwill or capital reserve also. This is step number 6. Step number 7, intercompany owings. Step number 7, intercompany owings. Step number 8, reserves for consolidated balance sheet. And last step, preparation of financial consolidated balance sheet. Okay, see this, sir. So come to the consolidation procedure, sir. Consolidation procedure. Just we have explained. I have explained the examples, sir. Examples, through that examples I have introduced some steps. Important steps what I have introduced, sir. Minority interest, cost of control. These 2 steps I have introduced. Remaining steps also we will understand, sir. And come to last step, everybody. Step number 9. Preparation of consolidated balance sheet. Imagine yourself, you are preparing consolidated balance sheet. First, equity and liabilities. Correct? In equity and liabilities, shareholders fund. In shareholders funds, share capital. Which company share capital you will take? Only parent. Only parent. So when you are preparing the consolidated balance sheet, share capital, only parent company share capital you need to consider. Okay. Reserves, step number 8. Step number 8. Reserves for consolidated balance sheet. We will do one step here. From this step, whatever the consolidated reserves arrive na, that we will take. Step number 8. Of course, we will discuss. Wait. Next to minority interest. Step 5. We understood minority interest. That we will show. Next, liabilities. Other liabilities, loans, current liabilities, provisions, whatever. Just we will add what? Parent company, subsidiary company. In these examples also what we have done, sir? Liabilities, assets. Just we added both. But remember guys, when you are preparing the consolidated balance sheet, assets and liabilities, especially liabilities, parent liability, subsidiary liability, any common liabilities are there, na, eliminate. For example, mutual debts between parent and subsidiary, any loan given by subsidiary to parent, parent to subsidiary, they will be eliminated, because now parent and subsidiary is treated as one entity only, na. Therefore, whatever the mutual or common debts is there, those debts will be eliminated. Like in amalgamation we have done. If I am transferor company, if I am transferee company, you are transferor company, your business I am taking, na. Therefore, you and me has becoming one entity. So when we are becoming one entity, any common debts between us we will eliminate. First, at the time of incorporation, we are incorporating all assets and liabilities. Later, we are writing a separate entry for elimination of intercompany transactions. In amalgamation chapter, we have done, na? Trade payables, trade receivables, loan given, loan receivable, bills payable, bills receivable. Wherever there are common debts are there, what we have done? We eliminated, na? Same thing we'll do in consolidation also. Why we will do? Tell me. Because parent, subsidiary, two entities, sir. But if they become one entity, whatever the common debts is there between them, they will not be debts, na. For example, parent given a loan to subsidiary. Parent books, that is asset. Subsidiary books, that is a liability. Now parent and subsidiary one entity only. Therefore, this asset, this liability, both will be cancelled. So that is what they are saying. See, when you are considering the assets, liabilities in the consolidated balance sheet, aggregate both individual liabilities minus intercompany transactions, which we will do in step number 7. Any intercompany transactions are there, just eliminate. So therefore, this is the liability side of the balance sheet, consolidated balance sheet. So tell me, consolidated balance sheet you are preparing. Shareholders fund, share capital. Which company share capital? Only parent. Next, reserves and surplus. Step number 8, consolidated reserves. We need to do. Next, minority interest. Step number 5. Minority interest, step number 5. Then come to liabilities. Non-current liabilities, current liabilities. You will add parent liability, subsidiary liability. Both. Minus intercompany transactions. Any mutual debts, mutual owings are there, eliminated. So liability side is over. Now come to asset side. First, fixed assets. Fixed assets means PP, property, plant, equipment, intangible assets, parent company, subsidiary company. Add it. See this. Both, total of both the companies. And important thing is, any revaluation, any unrealized profit is there, we need to adjust. And sometimes we will get goodwill, na sir, cost of control step. That goodwill also form part of the fixed assets. Sir, step number 6, sir. Step number 6. What is step number 6? Cost of control. When you calculate cost of control, you may get what? Goodwill. That goodwill must appear in the consolidated balance sheet. So fixed assets, parent company assets, subsidiary company assets. Subject to 2 things. What are those? Revaluation, unrealized profit. Next, investments. Tell me investments. Parent company investment we will take. Parent company investment in subsidiary we will take. No. I told you, no sir. Parent company investment in shares of subsidiary company will be eliminated against net assets of subsidiary company. Correct? So therefore, investments. When it comes to investments, sir, only outside investment will be totaled. Parent company outside investment, subsidiary company outside investment. See this. Total of outside investment of the parent and subsidiary will be considered. Parent company investment in the shares of subsidiary company we will not consider. Why? Because that investment is within the group. So if I invest in subsidiary company, so that is my asset in individual financial statements. But in the consolidated financial statement, that is not an asset. Therefore, I will not consider it. Only outside investments. See, the important word is outside investments I need to consider. And come to current assets and loans, advances, remaining current assets. Simple. Add parent company and subsidiary company. See this. Aggregate of both the companies. Adjusted for any intercompany owings. So if the intercompany owings can be intercompany debts, mutual debts, intercompany owings are there, we will eliminate from the liabilities as well as asset. Because generally in case of intercompany owings, for one company it is an asset, another company it is a liability. So when you combine them, so we need to eliminate from the assets as well as liability. So that's why it's subject to intercompany owings. So therefore, when you prepare the consolidated balance sheet, fixed assets you take first fixed assets. Fixed assets means PP, intangible, parent company asset, subsidiary asset. Subject to revaluation, unrealized profit elimination. Investments, consider only outside investment. Current assets, you add parent and subsidiary. Subject to intercompany owings. So this is the entire consolidated balance sheet. So therefore, when you are preparing the consolidated balance sheet, sir, you require what? Compulsorily you require consolidated reserves. This one. Step number 8. Reserves and surplus. Compulsorily you required minority interest. Compulsorily you required cost of control. Because if you calculate cost of control, either goodwill come, capital reserve. If it is capital reserve, it will affect reserves. If it is goodwill, it will affect fixed assets. And one more thing, sir. If you want consolidated reserves, sir, first you need to analyze the subsidiary company reserves and surplus. So this is the most important step. So this is the procedure for consolidation. I have not explained the entire procedure, sir. Just what is the main object of consolidation procedure? Preparing consolidated balance sheet. And when you are preparing the consolidated balance sheet, you require what? So you require minority interest, you require consolidated reserves, you require goodwill or capital reserve, all these things you want, intercompany owings. So therefore, before preparing consolidated balance sheet, we will first arrange all these things. That's why, see, this is put as step number 9. Why this is put as step number 9? Because if you don't know the consolidated reserves, if you don't know the minority interest, if you don't know the intercompany transactions, if you don't know whether goodwill or capital reserve, then how can you prepare the consolidated balance sheets? That's why these steps you need to follow systematically and arrive one by one. Once you arrive these things, just they will be recorded in the balance sheet and the balance sheet will be completed. Okay, so can you help me out? Final, how many steps are there in the consolidated balance sheet? 9 steps. Can you tell me the first step? Date of acquisition. On which date parent company acquired subsidiary? That is the first step. Second step, shareholding pattern. In the subsidiary, parent company having how much, others are having how much. That is step number 2. Step number 3, subsidiary company profit analysis must be done. That is the most important step. And once you done the analysis, next apportionment. Once you done the apportionment, next minority interest, then cost of control, then intercompany transfer, then reserves for consolidated balance sheet, then consolidated balance sheet. Everything is linked, sir. First step is linked with the third step, second step linked with the fourth step. If you done the fourth step correctly, third step correctly, fourth will come. If you done fourth correctly, then only fifth will come. Then sixth. Everything is interlinked. So next what we are going to do is, we are going to understand each and every step properly. Okay? Okay, let us continue our discussion, sir. We have started the consolidation procedure. Consolidation of balance sheet we have started. In consolidation of balance sheet, there are, I told you, 9 steps involved. One is date of acquisition. First we need to determine the date of acquisition. Then shareholding pattern we need to find out on the date of consolidation. And I told you the most important step is analysis of subsidiary company reserves and surplus. After that, apportionment of profits. After that, minority interest. Next, cost of control step. 7th, intercompany transactions. 8th, reserves for consolidated balance sheet. And finally, we need to prepare the consolidated balance sheet. And yesterday, through examples, I have introduced the concept of cost of control and also minority interest. So in the consolidation procedure, we have understood the basic steps. Now what I am going to do is, I am going to discuss each and every step in detail, especially the analysis of subsidiary company reserves and surplus, which is the most important step. Analysis, apportionment. Once you done the analysis properly, then apportionment, minority interest, cost of control, so reserves for consolidated balance sheet, these steps will be very easy. Okay, so let us start. So whenever you want to do the consolidation, sir, whenever you want to do the consolidation of subsidiary company, always the first step is determine the date of acquisition. Determine the date of acquisition. On which date parent company has acquired the control of subsidiary company. Sir, why we need to determine the date of acquisition? Because in step number 3, when you want to do the analysis of subsidiary company profits, so this date of acquisition is very, very important. So there is a link between step number 1 and step number 3. Step number 1 and step number 3. As I told you, each step is logical and interlinked with another step. So the first step is identify the date of acquisition. Identify the acquisition date of the parent in the subsidiary company. And the main object of determination of date of acquisition is this helps distinguish pre and post acquisition profits for accurate profit analysis. Sir, at the time of consolidation, we need to analyze the subsidiary company reserves and surplus into two categories: pre-acquisition, post-acquisition. Now, to analyze this, we require date of acquisition. Whatever the profits are there in the subsidiary till the date of acquisition, they are called pre-acquisition profits. Okay. After acquisition of subsidiary, whatever the profits generated by the subsidiary, they are called post-acquisition profits. Why this analysis is necessary, I will explain in step number 3. So this is the first step. Second step, sir, ascertain the shareholding pattern. Ascertain the shareholding pattern. That is, on the date of consolidation in the subsidiary company, who is having how much share? Parent company is having how much share? Minority interest, other shareholders is having how much share, we need to determine. So step number 2 is ascertain the shareholding pattern. Establish the subsidiary shareholding as of the consolidated balance sheet. Always it is important to understand, if you want to determine the shareholding pattern, you need to determine the shareholding pattern on the date of consolidation. On the date of consolidation. Suppose you are preparing consolidated financial statements at the end of 31st March 2025. On that date, in the subsidiary company, how much percentage of shareholding held by parent company, how much held by minority interest? Sir, why this step is important? Why we need to, calculate the shareholding pattern? Step number 4. Step number 2 is linked with, sir, step number 4, sir. Step number 4. In step number 4, what you are going to do is, the subsidiary company profits which you analyzed into pre and post, they will be apportioned between the subsidiary company shareholders. Who are the subsidiary company shareholders? Parent company, minority interest. So the subsidiary company reserves and surplus will be apportioned between the parent company and minority interest in the ratio of their percentage of holding. That's why in step number 2, we will determine the shareholding pattern. Okay. So see this, parent company, number of shares, percentage of holding. Minority interest, number of shares, percentage of holding, total. Okay. And this pattern is essential for apportioning the subsidiary profits. So tell me, can you help me? Whenever you want to do the consolidation of subsidiary company, when you want to prepare the consolidated balance sheet, so what is the first step? Date of acquisition. Always first in the problem, see what is the date of acquisition. Why date of acquisition is necessary? Because to apportion, analyze the profits of subsidiary, this date of acquisition is important. Okay. What is step number 2? Determine the shareholding pattern, and the shareholding pattern is decided on the date of consolidation. And in the subsidiary company, who is having how much percentage of shares? This is step number 2. And the most important step is analysis of subsidiary reserves and surplus. Listen to me carefully. Analysis of subsidiary company reserves and surplus. Analysis of subsidiary company reserves and surplus. Sir, whenever you want to do the consolidated balance sheet, in the subsidiary company balance sheet, what are all the reserves held by subsidiary company? You take each reserve and try to divide that reserve into two categories: pre-acquisition, post-acquisition. For example, in the subsidiary company, general reserve is there. This general reserve balance is on 31st March 2025. Suppose 12 lakhs given. This is the closing balance. This balance you need to divide into pre-post. You need to divide into pre-post. Why subsidiary company profits will be analyzed like this? Why they need to be divided into pre-post? Because as a parent company, I acquired subsidiary on a particular day. On that day, already subsidiary company, whatever reserves are there, actually those reserves, I don't have any investment in the subsidiary till that point of time. Just I am acquiring the subsidiary company. By the time I am acquiring the subsidiary company, already in the subsidiary company there are some reserves and surplus. And imagine, sir, suppose you purchased shares of a company. After you purchase shares of a particular company, that company declared the dividend on those shares. And the dividend is basically your income. You will credit to P&L account. Suppose, imagine you purchased the shares of a company. In the year 2025, you purchased shares of a company. But relating to last year, the company given a dividend to you. Even though you don't have investment in the last year, but before declaration of dividend for the last year, you purchased shares of company and you will get dividend. And what is the nature of the dividend to you? Capital profit. See, if I invest in any securities, after my investment, if my investment has given any income, that is my revenue income, revenue profit. Suppose if I receive any income for the period where I don't have any investment, basically that is capital in nature, capital profit in nature. Similarly, in the subsidiary company, at the time of consolidation, whatever reserves and surplus are there, those reserves and surplus I need to divide into two categories, pre-post. Pre means at the time I am acquiring the subsidiary company, what are the profits which are already there in the subsidiary? Actually, I don't have any investment till that time. So whatever the profits are there in the subsidiary company, parent company point of view, these are capital profits. All pre-acquisition profits are capital profits. After I made the investment, whatever the profits earned by the subsidiary, those are called post-acquisition profits. These are my revenue profits. So when you are doing the consolidation of subsidiary, one of the most important thing you need to do is take each reserve of subsidiary company and divide that reserve into two categories, pre-post. How much balance of this reserve is there in the subsidiary by the time I am acquiring the subsidiary? All those are my capital profits. And once I acquire the subsidiary, whatever the profits, whatever the reserves earned, increased, those are post-acquisition profits. So pre-post. Because AS 21 says you need to divide the reserves into two categories, pre-post. All pre-acquisition profits are capital in nature. All post-acquisition profits, revenue in nature. Accordingly, we will need to do the accounting treatment. Accordingly, we will do the accounting treatment. Okay. So, like this, we need to analyze the subsidiary company profits into pre-post. See this, sir. What they are telling. Analyze reserves and surplus of subsidiary company on the date of consolidation into pre and post acquisition profits with the necessary adjustments. Now, sir, okay, you said we need to divide each reserve of subsidiary company into two categories, pre-post. So, on what basis you will allocate this? Time basis. Always which basis, sir? Time basis we will follow. Time basis. For example, 12 lakhs. You acquired subsidiary on 1/4/2024. Date of consolidation is 31st March 25. So at the end, general reserve is 12 lakhs. And the opening balance is suppose 5 lakhs. That means 5 lakhs is which profits? Pre-acquisition profits. Already this 5 lakhs is there in the subsidiary company at the time of acquiring the subsidiary. So subsidiary point of view, this 5 lakhs is what? Capital profit, pre-acquisition profit. That means what will be the post-acquisition profits? Remaining balance 12 minus 5, 7 lakhs is the post-acquisition profits. Post-acquisition profits. So suppose for example, parent company acquired the subsidiary exactly in the middle of the year. Then what we need to do? This 7 lakhs will be divided into 2 parts. First 6 months, next 6 months. Then first 6 months, 3.5 lakhs will be pre. Next 3.5 lakhs will be post. There, understand. Till the time you are acquiring the subsidiary company, whatever the profits are there in the subsidiary, they are pre. Once you acquire the subsidiary, whatever the profits earned increases, reserves, they are called post. So at the time of consolidation, sir, what we need to do is every reserve of subsidiary company will be divided into pre-post. Pre-post. Why we need to do that? Tell me the logic. Because the character of the profit is deciding the fate of accounting treatment. If I invest in shares, after investment in shares, I receive dividend. Generally that is revenue profit. But if I receive dividend for the period where I don't have investment, last year I don't have any investment, this year only I purchased shares of the company, but this year, last year dividend was declared, so I received dividend. So my point of view, that dividend is what nature? Capital nature. Accounting standard 13, which says if you receive any dividend from pre-acquisition profit, that is adjusted to the cost of investment rather than crediting to P&L account. Similarly, sir, subsidiary company profits have to be analyzed into pre-post. All by the time you are acquiring the subsidiary, whatever the profits are there in the subsidiary, they are all pre-acquisition profits. They are all capital profits. After you acquiring subsidiary, whatever the profits earned by the subsidiary, they are all post-acquisition profits, revenue profits. So that's why in order to segregate pre-post, I require what? Date of acquisition. That we decided in step number 1. That's why step number 1 is important. Date of acquisition, on which date you are acquiring, till that date whatever the profits are there, they are all profits. After that whatever the profits are there, they are post. So to determine the subsidiary company profits into pre and post, I need date of acquisition. And here the profits will be apportioned based on time. Assumption, sir, assumption. Time basis we will take. Okay, see this. For apportionment of profits between pre and post acquisition periods, we follow time basis, assuming profits are accruing evenly over time. So here as an assumption that profits are evenly same over the years. That's why we follow time basis to allocate the profits between pre and post. Okay, now the interesting point is, when you are analyzing the subsidiary company reserves into pre and post, there are 3 important adjustments. 3 important adjustments which will play a crucial role. When you are analyzing the subsidiary company profits into pre and post, there are 3 adjustments. First adjustment is revaluation of assets of subsidiary company. Revaluation of assets of subsidiary company. First adjustment. Second adjustment, sir, dividend given by subsidiary company. Dividend given by subsidiary company. Third adjustment, sir, intra-group transactions between parent and subsidiary. And also bonus shares given by the subsidiary company. So while analyzing the reserves and surplus of the subsidiary company, we need to consider the effect of the following items in particular. What are those? Revaluation of assets of subsidiary company, dividends given by the subsidiary company, intra-group transactions between the parent and subsidiary. Tell me what are the important adjustments? 3 important adjustments. First one, revaluation of assets of subsidiary. Revaluation of assets of subsidiary company. Second one, dividend given by subsidiary. Third, intra-group transactions between parent and subsidiary. These 3 are the highlights of this chapter. Each can be asked as a separate question. And in the big question, generally you see, either you will find revaluation of assets adjustment, or dividend adjustments, or intra-company, intra-group transactions between parent and subsidiary. These are the adjustments usually you find in big question sums. I will show you. If you want, after discussion, you go and check the previous exam question papers. Okay. So I will explain about these revaluation of assets, dividend given by subsidiary, intra-group transactions also. So tell me what we are discussing. Consolidation procedure. Which consolidation? Balance sheet or P&L? Balance sheet. Tell me the first step. Date of acquisition. Why date of acquisition is necessary? To analyze the profits of subsidiary into pre-post. Okay. What is step number 2? Shareholding pattern. On which date? On the date of consolidation. Why that is necessary? Next step, apportionment of profits. What is step number 3? Analyze the subsidiary company profits. Take each reserve of subsidiary company, divide into pre-post. All pre-acquisition profits, capital profits. All post-acquisition profits, revenue profits. And then, when you are analyzing the reserves and surplus of subsidiary company, you need to consider the revaluation of assets of subsidiary company, dividend given by subsidiary company, intra-group transactions. Next, see step number 4, sir. I will come back to step number 3. Those important adjustments I will explain. Sir, once you analyze the subsidiary company profits into pre-post, then what you need to do is, this subsidiary company profits is apportioned between the shareholders of subsidiary company. Who are the shareholders of subsidiary company? Parent and minority interest. So therefore, see this. Apportion the profits analyzed in step number 3 among the shareholders and minority interest. That means among the parent and minority interest. Here wrongly. Among parent and minority interest. Okay. Whatever the profits you divided, you need to divide, apportion, analyzed, you need to apportion between the parent and minority interest in step number 2. That's why step number 2 we decided the shareholding pattern. Now look at how apportionment is done. First, pre-acquisition profits. I told you all pre-acquisition profits are capital profits. Next, post-acquisition profit. Post-acquisition profit can be revenue reserve or can be revenue profit. Pre-acquisition profits are all capital profits. Post-acquisition profits, either revenue reserve or revenue profit. Simple, sir. If you are analyzing the P&L account of the subsidiary company, that is called revenue profit. If you are analyzing other reserves of subsidiary company, they are called revenue reserves. Suppose you are analyzing the general reserve of subsidiary company, that is called revenue reserve. If you are analyzing the P&L account of the subsidiary company, that is called revenue profit. Okay, say one by one reserve. See, general reserve. Already you divided into pre-post. So take each reserve. You already done in step number 3. In this general reserve, how much is the pre-acquisition? How much is the post-acquisition? In other reserves, how much is pre? How much is post? In P&L account, how much is pre? How much is post? Okay, actually, when it comes to P&L, sir, amount should come here. Revenue profit, because P&L account is revenue profit. Okay, understand. General reserve, obviously, pre-acquisition, post-acquisition, revenue reserve, correct only. Any other reserve also that. In this reserve, how much is pre, how much is post? In P&L account, how much is pre, how much is post? Now make a total. Then you divide this reserves and surplus which are apportioned as pre and post between the parent and minority interest. And in which ratio? Already we decided in step number 2. Already we decided in step number 2. How much is parent? 80%. How much is minority interest? 20%. For example. So this profits which is apportioned between the subsidiary company profits which are analyzed as pre and post, so will be divided to parent minority interest. See this, parent, this is the parent share, this is the minority interest share. Now I will tell you the most important point, listen to me carefully. Sir, parent company share in the pre-acquisition profits, parent company share in the pre-acquisition profits of subsidiary, this amount is adjusted to cost of control, cost of investment in step number 6. While determining the goodwill or capital reserve, what we are doing? Cost of investment is compared with the share of net assets, which are represented by share capital plus reserves and surplus. On the date of acquisition, whatever the reserves and surplus are there in the subsidiary, they are basically what? Pre-acquisition. By the time you are acquiring the subsidiary, whatever the reserves are there, they are all what? Pre. In that pre-acquisition profit, as a parent company, what is your share? That will be adjusted to the cost of investment. So, parent company share in the pre-acquisition profits adjusted to cost of investment. Cost of investment is adjusted with the parent company share in the net assets of subsidiary. The difference is goodwill or capital reserve. And parent company share in the post acquisition profits of subsidiary. See this, these are post acquisition profits. Understand, parent company share in the post acquisition profits, what we need to do is we need to add them to the parent company reserves in step number 8. Step number 8, when you are preparing the consolidated reserves of the balance sheet, the parent company share in the post acquisition profits of subsidiary company will be added to the consolidated reserves. Tell me, hello, what is step number 3? Analysis of the subsidiary company reserves. Correct? How you are going to analyze? Pre, post. Pre-acquisition profits are always capital. Post-acquisition or revenue profit or revenue reserve, or revenue reserve, revenue profit. Right? Once you analyzed, then you need to apportion. Apportion between whom? Shareholders of subsidiary. Who are shareholders? Parent, minority interest. Now, parent company share in the pre-acquisition profits of subsidiary adjusted to cost of investment. At the date of acquisition, we are finding goodwill or capital reserve na? Here, there. Parent company share in the post-acquisition profits of subsidiary will be added to the consolidated reserves in step number 8. We are doing step number 8. See this, step number 8. See here, step number 8. Reserves for consolidated balance sheet. In this step, you see here, see this. See point, everybody see. Add parent company share of post-acquisition reserves and profits of subsidiary. Step number 4, I have given a reference also. Parent company share of post-acquisition reserves and profits of subsidiary company will be added to the reserves of consolidated balance sheet in step number 8. Sir, why? Why they will be added? Pre-acquisition profits or capital profits. Therefore, they will be adjusted to the cost of investment. So therefore, they are not to be incorporated separately. But after you are acquiring the subsidiary, whatever the profits are there in the subsidiary, they are post-acquisition profits, right? Because of them, the net assets of the subsidiary increases. Therefore, the corresponding increase must reflect in the consolidated balance sheet. Therefore, understand, in the subsidiary company, by the time you are acquiring the subsidiary, whatever the profits are there, they are all pre-acquisition profits. They will be adjusted to the cost of investment. And the difference is goodwill or capital reserve we are showing. That means parent company investment, subsidiary company share capital plus reserves and surplus. We adjusted. The difference is goodwill or capital reserve we are showing. That means at the time you are acquiring the subsidiary, whatever the reserves and surplus are there in the subsidiary, they are already adjusted in the form of goodwill or capital reserve. Now, once you acquire the subsidiary, whatever the profits, whatever the reserves increases in the subsidiary, they will be added to the consolidated reserves. That means to the extent of the increase, the post-acquisition profits. In that post-acquisition profits, as a parent company, what is your share? That will be added to the consolidated reserves. You understand the logic? All pre-acquisition are adjusted. Post-acquisition will be added to the consolidated reserves. Okay, sir, okay, parent company, okay, share. What about minority interest? Minority interest share. Sir, minority interest share is added only to minority interest. Whether it is pre-na, post-na, doesn't matter. Entire minority interest share will be added to the minority interest in step number 5. In step number 5. See here. This one, entire minority interest. So, minority, step number 5 you see. I told you what is minority interest. Minority interest is nothing but minority shareholders' share in the net assets of the subsidiary company. Why we recognize minority interest? Because parent company is consolidating 100%. Even though we don't have 100%. Therefore, the share which is held by the minority shareholders, we need to recognize. So, how to calculate minority interest? Simple, net assets into minority percentage. So, net assets can be ascertained in two ways, either assets minus liabilities or share capital plus reserves and surplus. Here, reserves and surplus already divided into pre-post. So, in the pre and post acquisition profits, what is the share of the minority interest? So, you add to minority shareholders. See this. That's why here you see capital profits from step number 4. Capital profits means pre-acquisition profits. Minority interest share. Revenue reserve means post-acquisition profits. Minority shareholders share in step number 4. Revenue profit means pre-acquisition profits. Sorry, post-acquisition profits. Minority shareholders share. So will be added. Okay. So the most important steps is, once you analyze the subsidiary company profits into pre and post, then you need to apportion these profits between parent and minority shareholders. Because the character of the profits of the subsidiary company is changing the accounting treatment. That's why we need to analyze. Understand that logic, you should not forget. Why we need to analyze the subsidiary company profits into pre and post? Because by the time you are acquiring subsidiary, whatever the profits are there in the subsidiary, they are all your capital profits. You don't have any investment, but you are getting the rights on those profits. They are your capital profits. Capital profits generally will not be credited to P&L account. That's why, see, in case of parent company, whatever the share they are getting from the pre-acquisition profits, what we are doing is, we are adjusting to the cost of investment. In cost of control step number 6, first we will take cost of investment. This cost of investment will be deducted with the value of investment, that is parent share of subsidiary net assets. When you are deciding the net assets, you are taking share capital and at the same time pre-acquisition profits. On the date, I told you, no, cost of control will be decided on which date? Date of acquisition. Date of acquisition. It's a one-time calculation, I told you. So date of acquisition means on the date of acquisition in the subsidiary, whatever the profits are there, which profits they are? Pre-acquisition profits. That way, see, share capital plus pre-acquisition profits. In this, what is the parent company share? We are comparing with the cost of investment. Any difference is there, that will be adjusted to goodwill or capital reserve. So therefore, here what we need to learn is, parent company share in the pre-acquisition profits of subsidiary is adjusted in step number 6. Parent company share in the post-acquisition profits will be added to step number 8. Minority shareholders share will be considered in step number 5, minority interest. That's it. So this is step number 4. Okay. So when you are doing the consolidation, first date of acquisition, second shareholding pattern, third analyze the subsidiary company reserves and surplus into pre-post. Once you analyze, apportion between parent and minority interest. Now parent company share in the pre-acquisition profits adjusted to cost of investment in step number 6. Parent company share in the post-acquisition profits added to the consolidated reserves in step number 8. Minority shareholders share minority interest. Step number 5. Okay. Okay. Now, sir, I told you when you are analyzing the subsidiary company reserves and surplus, how many important adjustments are there? 3. Now I am going to talk about all these 3 important adjustments. Kindly concentrate. This is very, very important. Very, very important. So can you tell me what is the first adjustment? Revaluation of assets of subsidiary company. Revaluation of assets of subsidiary company. Sir, generally, sir, when parent company acquiring subsidiary company, what parent company will do is they may revalue some of the assets of subsidiary company. They may revalue some of the assets of subsidiary company. Why they will revalue? Because parent company point of view, those assets are not properly valued. Happens na? When suppose you are subsidiary company, I am parent company, I want to take over your company, I will look at your balance sheet and I feel some of the assets are not properly valued. So therefore I will do revaluation. So generally revaluation will happen when? On the date of acquisition. So therefore revaluation happens on the date of acquisition. Now revaluation can be, there are 2 possibilities. Revaluation of assets. As far as the revaluation of assets is concerned, there are 2 possibilities. Can you tell me what are the 2 possibilities? Either upward revaluation or downward revaluation. Either upward or downward. Upward means increase the asset value. Downward means decrease the asset value. When you increase the asset value, the increase generally transferred to revaluation reserve. But in consolidation, when parent company increases the asset value of subsidiary company on the date of acquisition, that increase is transferred to pre-acquisition profits, that is treated as capital profit. That is pre-acquisition profit, because you are doing exactly on the date of acquisition. For the purpose of this acquisition only you are doing the revaluation. Therefore, whatever the profits are there, whatever the increase in the asset value, that will be treated as pre-acquisition profit, that is capital profit. So therefore, when you are analyzing the subsidiary company reserves and surplus, this revaluation profit will be considered as pre-acquisition profit, and you need to apportion that in step number 4 also. You need to analyze in step number 3 and also step number 4 you need to apportion. So whenever there is a upward revaluation, right, what we need to do? The increase in asset value is treated as pre-acquisition profits, correct? Pre-acquisition profits. That means it is which profit? Capital profit. Capital profit, not revenue profit. Okay. Sir, downward revaluation may also happen, sir. Parent company decreased the asset value of subsidiary company. Possible? Maybe in the subsidiary company any asset is overvalued. Now parent company decreased the asset value of subsidiary company. Downward revaluation. If there is a downward revaluation, same treatment. The decrease in asset. The decrease in asset is treated as pre-acquisition losses. Pre-acquisition losses, and it will be treated as what? Capital losses. Sir, whenever I said profits, opposite will also be there. So very simple, sir. When parent company is acquiring subsidiary company, sometimes subsidiary company assets are revalued. Here revaluation can be upward, downward. If there is an upward revaluation, the increase is treated as pre-acquisition profit, transferred to capital profit. If there is a downward revaluation, the decrease is treated as capital loss, pre-acquisition loss. Now tell me, because of this, is there any other consequence? Because of this, is there any consequence? Is there any effect on the profits of subsidiary company? Yes. Yes. What is that? See, if you do the upward revaluation, sir, definitely in future additional depreciation will come. That will reduces the post-acquisition profits of subsidiary company. Sir, if you increase the asset value, to that extent, your depreciation will be more. Because of that, my post-acquisition profits will be reduced. My means subsidiary company. So that also you need to consider. Because entire subsidiary company profits we are analyzing into pre-post. Because of the revaluation, whatever the profits, they are pre-acquisition capital profits. Now, because of this increase and decrease in the asset value, what happens? Either additional depreciation may come or you may return off the excess depreciation. For example, if asset value decreased, then you provide less depreciation. Already in the books, you might provide depreciation on the original value. Therefore, the excess depreciation must be returned back. If you provide additional depreciation, your post-acquisition profits will be decreased. If you are writing back the depreciation back, your post-acquisition profits will increase. So that will also need to be considered. So please understand. So if there is an upward revaluation, sir, see this. Additional depreciation will reduce the post-acquisition profits of subsidiary company. So additional depreciation will reduce the post-acquisition profits of subsidiary company. Sir, if there is a downward revaluation, excess depreciation will be added back. Hence, post-acquisition profits, what happens to post-acquisition profits? Post-acquisition profits will increase. Post-acquisition profits will increase. So, you understand this adjustment? You understand this adjustment? What is this adjustment? Revaluation of assets of which company? Subsidiary company. Who done the revaluation? Parent. Tell me, when you do the revaluation, how many possibilities? 2. What are those? Upward, downward. If there is upward, that increase will be treated as pre-acquisition profits. It is nothing but capital profit. Pre-acquisition. And because of the, if there is a downward, pre-acquisition losses, capital loss. Now, if there is an increase in the asset value, obviously what will increase? Additional depreciation. Because of that, your post-acquisition profits will decrease. You need to provide depreciation on the increased value. And if there is a downward revaluation, obviously asset value decreased, but you provided depreciation on the original cost. Therefore, whatever the excess depreciation you provide, what we need to do? Return back. If you add back the depreciation excess you provide, obviously your post-acquisition profits will increase. So this is the revaluation of assets topic. Sir, have you understood, sir? Very easy, sir. Very easy. Revaluation of assets. For example, sir, you see this. There is a property, plant, equipment, sir. This property, plant, equipment carrying value 1 lakh, sir. Now, parent company has increased this to 1,50,000. This is called revalued amount. So tell me how much increase? 50. So what is this 50,000? Can you tell me what is the entry we will write? Simple. Asset value increased na? PP account debtor to pre-acquisition profits. Simple. These are directly credited to which profits? Pre-acquisition profits. How much? 50,000, 50,000. That's it. So to the extent of 50,000, increase your pre-acquisition profits. And these pre-acquisition profits are nothing but which profits? Capital profits. And you know what to do. In step number 3, you analyze pre and post. Once you analyze pre-post, in step number 4, you need to apportion. That means this profit is also apportioned between the parent and minority interest. And parent company share in the pre-acquisition profits is adjusted to cost of investment. Parent company share in the post-acquisition profits will be added to consolidated reserves. Minority shareholders share in the pre and post acquisition profits of subsidiary will be added to minority interest. So therefore, see, in step number 3, whatever I am analyzing, that is entirely affecting the accounting treatment, because this pre and post I am apportion between parent and subsidiary, and once I apportion between parent and minority interest, not subsidiary, parent company minority interest, after that I am adjusting them. Pre-acquisition profits are adjusted to cost of investment, post-acquisition profits I am taking to consolidated reserves. So therefore you have to be very careful. And now I increased the asset value 50,000, right? Suppose depreciation rate is 10%. Therefore, how much additional depreciation I need to provide? 5,000. This additional depreciation decreases my post-acquisition profits. That's it. My post-acquisition profits will be decreased by 5,000. Only remaining profits I need to analyze into pre-post. So that's it. This is one adjustment, sir. Sorry, you understand this adjustment? Hello? Yeah. Now, one more important adjustment. What I told, tell me. When you are analyzing the subsidiary company reserves and surplus, I told you one more important adjustment. What is it? Dividend. Very, very important. Listen to me carefully. Dividend given by subsidiary company. Sir, what is the treatment of dividend given by subsidiary company in consolidation? Simple. Listen to me carefully. When subsidiary company pays the dividend, sir, you need to see from which profits they have given dividend. If dividend is given from pre-acquisition profits, obviously the dividend received by the parent company is capital dividend, capital reserve, that will be adjusted to the cost of investment. If the dividend is given from post-acquisition profits, then parent company will credit the dividend to P&L account. That's it. Because post-acquisition profits are revenue profits. Pre-acquisition profits are capital profits. So from the capital profits, if any dividend given, that is also capital receipt. That is adjusted to cost of investment. So simple. Dividend is given from which source? Dividend given from pre-acquisition profits, post-acquisition profits, you have to see. Sir, dividend given from pre-acquisition profits, sir. Simple, sir. Then dividend is adjusted to cost of investment. It is nothing but treated as recovery of my cost. Recovery of my cost. Therefore, as a parent company, what entry I will write? Bank account debit to investment account. I will directly adjust the dividend received from subsidiary company from pre-acquisition profits to my investment account. Suppose, for example, if dividend received from post-acquisition profit, this is credited to P&L account. Credited to P&L account. That means the entry is bank account debited to P&L account. Bank to P&L account. Guys, important. In the question, if they have given subsidiary company declared dividend, you see from which profit subsidiary company given dividend. If subsidiary company given dividend from pre-acquisition profits, then parent company share in that dividend. Parent company will receive dividend now, because parent company invested in subsidiary. Therefore, whatever the dividend receivable by the parent company from the subsidiary, from the pre-acquisition profits, that dividend is treated as which dividend? Pre-acquisition profits. That dividend is adjusted to cost of investment. If dividend is received from post-acquisition profit, credited to P&L account. That's why you see step number 6, you see step number 6, cost of control. In this step, from the amount invested, I reduced what? Pre-acquisition dividend received from subsidiary company. I told you na, any dividend given by the subsidiary from pre-acquisition profits, then parent company adjusted to the cost of investment. That's why amount invested minus pre-acquisition dividend received. Sir, why? Already I told you. in the subsidiary company, whatever the profits are already there at the time of acquisition, the nature of those profits are capital profits. You don't have any investment till that point of time, but now you are getting rights on those profits also. Without having investment, if you get a right on any profits, they are what? Capital profit. They will be adjusted to cost of investment. That's why if you receive any dividend from subsidiary, from which profits? Pre-acquisition profits, adjusted to cost of investment. Adjusted to cost of investment. Sir, if dividend received from post-acquisition profits, P&L, normal dividend. If I purchase any company shares, after I purchasing those shares, if company declares a dividend for the future period, then these are my revenue profits. They will be credited to P&L account. Okay? So you understand this adjustment? Come on. Two important adjustments I explained. What is the first one? Revaluation of subsidiary company assets. Who will do the revaluation? Parent. When? On the date of acquisition. On the date of acquisition, any revaluation happen. How many possibilities? Two. Upward, downward. If there is an upward revaluation, pre-acquisition profit. Downward also pre-acquisition. Basically. Now, once upward, downward happened, because of that, is there any effect in future profits? Yes. If there is an upward revaluation, additional depreciation, which decreases my post-acquisition profits. If there is a downward revaluation, so whatever the excess depreciation I provided, I need to return back. So therefore, my post-acquisition profits will increase. Like, what is the second adjustment we done? Dividend given by subsidiary company. When subsidiary company pays the dividend, that dividend which is received by the parent, you need to see what? When dividend given by subsidiary company, which source the subsidiary company has given a dividend? Is it pre or post? If dividend is given from pre, adjusted to cost of investment. If dividend is given from post, credited to P&L account. This is another adjustment when you are analyzing the profits of subsidiary company. And one more important adjustment, sir. What is that? Intra-group transactions. See this. Intra-group transactions. This is also very interesting. Listen to me. Intra-group transactions. Sir, between the parents of some subsidiary, parent and subsidiary, any transactions might happen. Generally, purchase of goods, sale of goods may happen. Generally, those are called intra-group transactions. For example, everybody see A Limited, B Limited. Two entities are there. A Limited is parent company. B Limited is subsidiary company. Subsidiary company. Suppose A Limited sold goods to B Limited. Cost 100 rupees. Profit 20. So sale value 120. Parent sold goods to subsidiary. Okay. Now you are preparing the consolidated balance sheet. That means A Limited, B Limited are both treated as one entity. Right? Now you tell me, when parent company sold goods to subsidiary, who has booked the profit? Parent, seller. Seller is A Limited, sir. Buyer, B Limited, sir. When I sold goods to anybody, I will recognize the profit now. That means how much profit recognized by parent company? 20. Profit recognized by parent company. But see, this stock, whatever sold by A to B, it remains unsold at the time of consolidation. Total stock not yet sold, 120. Now, AS 21 says, since the stock is not sold to outsiders, on this stock, what is unrealized profit? This is unrealized. Therefore, you need to eliminate. Eliminate. From the profits of which company? Parent. Because the profit is there in whose books? Parent books. So, in step number 8, from the parent company reserves, you deduct unrealized profit. Unrealized profit. If you want, you can check it. See this. Go to step number 8, sir. See this. Step number 8. See this. D point. Less reserves for. See this. Reserves for unrealized profit created. Reserves for which profits? Unrealized profit. Sir, first of all, you understand what is this unrealized profit. Unrealized means not yet realized, not yet received, or not yet realized. Why it is not realized? Because stock is not yet sold outside. It is still there with our subsidiary only, na? Sir, I am parent, sir. You are subsidiary. I sold goods to you. Stock is there with you only. Now I am doing consolidation. Now as a parent company, I see, I made sales to you. I recognize 20 rupees profit, but this profit is not yet realized. Because stock is there within the group only. Parent and subsidiary now one entity only. Consolidation means by treating parent and subsidiary as one entity. When you treat parent and subsidiary as one entity, whatever the stock is there with the subsidiary, it is my stock only, na? Stock is with me only, it is not yet sold, but I recognize the profit. Is it logically correct? Therefore, what I need to do? Eliminate this 20 rupees profit, which is not yet realized. From where I will eliminate? It is already there in the subsidiary company profits. That's why reduce from the subsidiary company profits. From the subsidiary company profits, you reduce this 20. Subsidiary company and parent company books, it is already there. So reduce from the parent company reserves. Parent company P&L account, this 20 rupees is there. So from the parent company P&L, you reduce this 20 rupees. Parent company post acquisition profits, revenue profits, P&L account is there, na? From that you reduce this 20 rupees. And also one more adjustment you need to do. What is that? Stock. Inventory value also be reduced by 20. Because this inventory, whatever parent sold to subsidiary, that inventory is valued at sale price, na? But it should be brought to cost. So therefore, inventory value is reduced by 20, unrealized profit. Therefore, finally tell me what happens here. Two adjustments will be done. One is parent company post acquisition profits will be reduced. Second, inventory value will be reduced. Both are reduced by unrealized profit. Why? Profit not yet realized, but profit already recognized by parent. Therefore, from the parent company reserves you need to deduct. At the same time, from inventory value you need to deduct. Inventory value you need to deduct. Sir, is it logically understandable to you? Hello? Who sold goods to whom? Parent sold to subsidiary. Who booked the profit? Parent. In whose books the profit is there? Parent. Is this profit realized? So, at the time of consolidation, since parent and subsidiary is one entity, you can't recognize profit on sales made to you. Therefore, you eliminate this profit. Now, my question is, suppose you sold 120 sale value. Suppose this company, subsidiary company, managed to sold 60. That means what is the unsold portion? 60. So, tell me now how much URP, unrealized profit, will be eliminated? 10 rupees. Because total profit is how much? 20 for 120 sale value. Out of that, if 60 is sold, na sir, unsold is how much? 60. That means to the extent of inventory sold, profit realized. No need to eliminate. To the extent the stock not yet sold, in that 60, whatever the profit unrealized is there, 10, you need to eliminate. Therefore, from the parent company post acquisition profits, you need to reduce 10. At the same time, inventory value decreased by 10. Hello? And this is called downstream transaction. Downstream transaction. Why it is called downstream transaction? Because parent company sold goods to subsidiary, sir. Parent sold to subsidiary, na sir. Parent obviously above, below that subsidiary. So goods are flowing from above to down. That's why it is called downstream transaction. So when downstream transaction happened, who booked the profit? Parent. So remove from the parent company books. At the same time, inventory value will be decreased. Now, upstream transaction next. Upstream transaction. Upstream transaction. Upstream transaction. What is this upstream transaction? When subsidiary sold goods to parent. Subsidiary sold goods to parent, sir. Suppose same example, sir. A limited, P limited, sir. Suppose P limited sold goods to A limited, sir. A limited is parent, P limited is subsidiary, sir. Sir, subsidiary company sold goods to parent, sir. cost 100, profit 20, sale value 120. Subsidiary sold goods to parent. That means profit recognized by whom? Subsidiary. Stock is there with whom? Parent. Unsold stock. Suppose the total stock is not yet sold. Now you are doing consolidation. You are doing consolidation. Important, listen to me carefully. Sir, when subsidiary company sold goods to parent company, subsidiary company recognized the profit. Now in that sale, whatever the stock is there which remains unsold, now you are doing consolidation by treating A and B as one single entity. Now what is the accounting treatment? Simple. How much is the unrealized profit? 20. This unrealized profit is included in whose books? Subsidiary. But already subsidiary company profits we are analyzed into pre-post. We analyzed into pre-post, and in step number 4 we apportion between the parent and minority interest. Therefore you need to reduce this unrealized profit from the parent company as well as minority interest. Because subsidiary company sold goods to parent means subsidiary company books already there is a profit that was included in reserves and surplus. In step number 3, the reserves of subsidiary company we are divided into pre-post, and those reserves we apportion between the parent and minority interest in step number 4. Therefore this unrealized profit is included in whose books? Parent, minority interest. So you eliminate from the parent as well as minority interest. So therefore you need to see here, see this, in this 20, suppose in the subsidiary company 80% is held by parent, 20% held by minority interest. So in this 20, 80% means 16 will be eliminated from parent company reserves, 4 is eliminated from minority interest. That's why you see here in this step I will show you. See this, when you are preparing the consolidated balance sheet, step number 8 you come. See this, D point. What is the D point? Reserve for unrealized profit created. Same point. Sir, that means when parent company sold goods to subsidiary, profit is there in the parent company, 100% unrealized profit is eliminated from the parent company reserves. When subsidiary sold goods to parent company, in that unrealized profit, parent company share will be removed from the consolidated reserves. Sir, I am parent, sir. You are subsidiary. I sold goods to you, 120. 100 rupees cost, sold at 120. That means what is the profit? Entire 20 is unrealized. I need to remove. Correct? In consolidated balance sheet. Because this 20 is not a profit for the group. Stock is there with me only, in the group only. Okay, entire 20 will be eliminated. Suppose subsidiary sold goods to parent. In subsidiary, I am having only 80%. Remaining 20, minority interest. Therefore, this profit is included in parent as well as minority interest. Therefore, I need to remove from the parent company minority interest. Respect to shares. So that's why see here, reserve for unrealized profit I will deduct. And also you see minority interest. Step number 5, you see less stock reserve. Minority share. If upstream, see this, upstream. You see step number 5, we deducted stock reserve. This is nothing but unrealized profit. In which case it will come? Upstream transaction. What is upstream transaction? Subsidiary sold goods to parent. When subsidiary sold goods to parent, in the profit is recognized by subsidiary, the profit should be shared between the parent and minority interest. Sir, here one interesting point, sir. Suppose at the time of analysis of profits of the subsidiary company itself, if I remove this profit, these unrealized profits from the subsidiary company profits, okay, then I am not required to do this adjustment because it is already eliminated. So only when the unrealized profit, the profit which is earned by the subsidiary on sale of goods to parent, if it is analyzed and apportioned in step number 3 and 4, then it has to be eliminated from the respective parent and minority interest. So do you appreciate this? So tell me, 2 things we have learned. What are the two things we learned? Upstream, downstream transaction. Tell me first upstream. Upstream what happens? Downstream. Downstream what happens? Parent sold to subsidiary. Who booked the profit? So if the stock is not yet sold, the entire unrealized profit we need to eliminate from parent company. In step number 8, consolidated. Step number 8, parent company reserves we need to eliminate. If subsidiary sold goods to parent, upstream. In upstream transaction, who booked the profit? Subsidiary. Subsidiary profits are already analyzed and apportioned between parent and minority interest. Therefore, this unrealized profit is there in parent company as well as minority. Remove from both. Minority interest, step number 5. Parent company shares, step number 8. Sir, you understood? This is the concept, sir. Now, sir, one more interesting point I will tell you, sir. Dividend, I forgot to tell one point, sir. Tell me, I told you, when subsidiary company gives the dividend, I told you we need to see the source. If the subsidiary company gives dividend from pre-acquisition profits, what we need to do? Adjust it to cost of investment. If subsidiary company give dividend from post-acquisition profits, what we need to do? P&L account. Sometimes in the question they will give like this. Subsidiary company given a dividend from pre-acquisition profits, but parent company created to P&L account. Sir, when subsidiary company gives dividend from pre-acquisition profits, generally parent company, whatever the dividend received, will be adjusted to cost of investment. But what they have done? Created to P&L. Now we need to rectify while solving the question. Therefore, how to rectify it? Already it is included in the parent company reserves. So in step number 8, you deduct wrongly created dividend. Hello? And in step number 6, cost of control step, so pre-acquisition dividend, we need to deduct from the cost of investment. So therefore, see here, interesting points. Dividend given by subsidiary from pre-acquisition profits. Pre-acquisition profits, dividend given. If dividend is given by subsidiary company from pre-acquisition profit, parent company, what they need to do? Bank account debit to investment account they will do, right? Correct? This dividend they need to adjust to the cost of investment. This is what we learned, correct? But sometimes what they will do is parent company will write a wrong entry. Wrong entry they will write. What is the entry they will write? Instead of adjusting to cost of investment, this entire dividend they created to P&L account. Now you need to pass a rectification entry. Rectification entry you need to pass. Can you tell me what will be the rectification entry? So, what is the rectification entry you need to do? You need to credit investment, but you credit P&L account. Therefore, first you need to add back. You need to deduct from the P&L account because it is already included in P&L account, this dividend. So, you need to reduce from P&L account and you need to reduce from investment. So, investment account will be created, P&L account will be debited. So, that's why you see step number 8. Step number 8, you see this one. Step number 8, reserves for consolidated balance sheet, you see. Dividend received from, see this, dividend received from which company? Subsidiary. Out of which profits? Pre-acquisition profits, but they transferred to investments. So from pre-acquisition profits, if dividend is received, it should be adjusted to investment account. But they have created to P&L. That's why we did deducted now. Deducted. And you go to step number 6, sir. Step number 6, you see. Pre-acquisition dividend we reduced it from amount invested. Why pre-acquisition dividend is reduced? Because pre-acquisition dividend is what? Capital profit. It is adjusted to cost of investment. So you understand this treatment? Sir, tell me, sir. Dividend given by subsidiary from pre-acquisition profits. As a parent company, you need to adjust to cost of investment. In step number 6, you need to reduce from amount of investment. Correct? But what you have done? I created to P&L account wrongly. Now I need to rectify the mistake. How to rectify? In the P&L account, reduce it in step number 8. And in step number 6, you need to deduct from cost of investment. So this is 3 important adjustments while analyzing the profits of subsidiary company. So 3 important adjustments explained, sir. What is the first important adjustment? Revaluation of assets of subsidiary company. What is the second important adjustment? Dividend given by subsidiary company. What is the third important adjustment? Intra-group transaction. 2 transactions I explained. One is upstream, another one is downstream. Upstream means parent sold goods to subsidiary. That means profit, whatever unrealized is there in the parent company, we need to eliminate from step number 8. Entire profits, 100% profit. When subsidiary sold goods to parent, it's a upstream transaction. In this upstream transaction, the subsidiary company profits will be eliminated from the parent as well as minority interest. Because in step number 3, the subsidiary company profits are apportioned between the apportioned and analyzed and apportioned between parent and minority interest, right? So therefore we need to reduce from both the parties in step number 8 as well as step number 5. Okay, so see this. So first step, so come on, help me. Consolidation of balance sheet. What's step number 1? What is the date of first step? Date of acquisition. Why date of acquisition? To divide the subsidiary company profits into pre-post. What is step number 2? Shareholding pattern on the date of consolidation. Why this step is required? Whatever the profits of subsidiary analyzed, sir, we need to apportion between parent and minority interest. For that we need to know how much percentage they had. Na? So step number 2. Step number 3. Analysis of reserves of subsidiary company. Subsidiary company reserves are analyzed into 2. Pre, post. All pre-acquisition, capital profits. All post-acquisition, revenue profits. And when you are analyzing the subsidiary company reserves and surplus, 3 important adjustments. What are those? Revaluation of assets. If revaluation of assets happen, upward, downward or downward, it's a pre-acquisition profit or loss. And if there's an upward revaluation, additional depreciation affecting my post-acquisition profits. If it's a downward revaluation, excess depreciation will be written back, added back. Therefore, my post-acquisition profits will increase. Next, dividend given by subsidiary. Any dividend given by subsidiary company? Which source they have given? Pre or post? Pre. Cost of investment will be adjusted. Post. So, credited to P&L account. Sometimes parent company wrongly credited to P&L instead of adjusting to cost of investment. Rectify it. How to rectify? Reduce from the parent company reserves, and in step number 6, from the cost of investment, you deduct the pre-acquisition dividend. Right? Next, what is the third adjustment? Intra-group transactions. Upstream, downstream. Upstream, parent sold goods to subsidiary. Unrealized profit will be reduced from the parent company in step number 8. Subsidiary sold goods to parent. Unrealized profit will be apportioned between parent and minority interest. In step number 5, minority interest. In step number 8, parent company. Consolidated reserves. Sir, you understood? Next. Step number 4, we know. Step number 5, we discussed. In step number 5, can you tell me what is the most important thing? Upstream. Why minority interest is deducted in respect of stock reserve only in case of upstream transaction? Why in case of downstream transaction it is not eliminated? Because in downstream transaction, who sold goods to whom? Parent sold goods to subsidiary. When parent sold to subsidiary, profit is there in whose books? Therefore, how minority interest will be affected? Hello. Next, cost of control. Tell me how to calculate cost of control. Cost of investment. And to this amount investment, what we need to adjust? Pre-acquisition dividend. Why we need to deduct pre-acquisition dividend? Because it's a recovery of cost, capital profit. And we need to compare with the net assets. Parent company share in the net assets on the date of acquisition. The difference is either goodwill or capitalism. Okay. And this step also, step number 7, intercompany transactions. I told you this upstream, downstream transactions, sir. So in downstream, who sold goods to whom, sir? Parent sold to subsidiary. So unrealized profit eliminated from the asset, 100%. From the inventory, whatever the unrealized profit is there, we need to eliminate. And also, this unrealized profit is adjustment against parent company reserves, 100%. Minority interest, nil. Because here goods sold by parent to subsidiary. So entire unrealized profit is there in parent company books. Therefore, we need to eliminate 100% from parent company reserves. And see, if it is an upstream, upstream means subsidiary company sold goods to parent. From the inventory, total profit will be eliminated, unrealized profit. Always inventory will be brought to cost. Whoever sold goods to whom? because you are preparing consolidated financial statements from group point of view. Whether parent sold goods to subsidiary or subsidiary goes to parent, doesn't matter in respect of stock. It is the group asset, right? Therefore, in that inventory, whatever the profit is there, you need to eliminate. That's why 100% profit eliminated, whether it is downstream or upstream. But when it comes to adjustment against reserves, in case of upstream, see this, to the extent of parent share in subsidiary in step number 7. Step number 7 or 8? I think step number 8. We are adjusting the parent company reserves in step number 8. So make it step number 8. Minority interest, step number 5. Sir, what is this step 8? Step 5 you understood? What is this step 8? Tell me. In consolidated reserves, basically first we start with parent company reserves. To that parent company reserves, we will adjust. This why we will adjust? Tell me. In this case, upstream transaction, why parent company reserves are adjusted? In case of upstream transaction, why parent company reserves are adjusted? Because in upstream, who sold goods to whom? Always remember, whenever upstream or downstream, forget, simple logic. You are, who sold the goods? You see first, who sold the goods? Subsidiary. Seller will recognize the profit. Correct? If profit is there in seller books, that profit already you analyzed in step number 3 into pre-post, and then you apportion between minority interest and parent, right? But the profit is now which profit? Unrealized profit. So it has to be eliminated. Na? Unrealized profit has to be eliminated. From where it will be eliminated? In whose our books it is already included, in whose our accounts already it is included, eliminate. This profit, unrealized profit, already we apportion between parent and minority interest. So therefore deduct from both of them. That's it. That's why step number 8, step number 5. But in downstream, who sold the goods? Parent. That means profit is in whose books? Remove from parent 100%. Sir, when only subsidiary company sold goods, na sir, because in the subsidiary company, parent and minority shareholders are the owners. Whatever the profits of the subsidiary company, they will share, na sir. So therefore, in the profits of subsidiary, which is already shared between the parent and minority interest, there is an unrealized profit. Why unrealized profit? Because goods are sold by, 1 minute. Goods are sold by whom? Subsidiary to parent. The profit we will eliminate from both of them. Okay. And also, sir, any intercompany owings or debts? Any intercompany owings or debts? Parent company sold goods to subsidiary, subsidiary sold goods to parent, because of the trade receivables, trade payables. Any loan given by parent to subsidiary. So these are mutual debts and owings are there. These mutual debts and owings also we will eliminate when we prepare the consolidated balance sheet. Common sense. Why we will adjust? Because parent and subsidiary is treated as one entity only, na? So I can't due amount to myself. So therefore, like in amalgamation we have done. Trade receivables, trade payables, bills receivable, bills payable, loan given, loan received. We adjusted, na? Similarly, parent company at the time of preparation of consolidated balance sheet, whatever the mutual debts are there, they will be eliminated. Like see this, debtors, creditors, loans given, loans taken, interest receivable, interest payable, fees receivable, fees payable, dividend receivable, dividend payable. The adjustment involves reduction of the amount from the aggregate of both receivable and payable. Aggregate of both receivable and payable. For example, see this, one simple example I will give. A Limited, B Limited, two companies are there. Loan 10 lakhs. B Limited loan 5 lakhs. Okay. Now, parent point of view, this is asset, loan given. Subsidiary point of view, this is liability, loan taken. Now, you are preparing consolidated balance sheet. Okay. What we will do? Suppose you are preparing consolidated balance sheet. Parent company loan, asset, how much? 10 lakhs, right? In this 10 lakhs, 5 lakhs is given to B Limited only. Therefore, I will deduct 5 lakhs. So, only remaining 5 lakhs will be shown in the consolidated balance sheet. Because in this 10 lakhs, sir, how much is given to B, sir? 5. Now, when it comes to liabilities, so loan, B Limited loan is there, na sir, 5 lakhs. We will take how much? Nil. Why? 5 lakhs minus 5 lakhs. Why we deducted 5 lakhs? Because this loan and this asset, A Limited loan given, B Limited loan taken, both will be adjusted. Why they will be adjusted? Because A and B are one entity now. A given to loan B, A and B one entity. That means loan given, loan taken, same party, na? So therefore this intra-group items will be irrelevant. Eliminate. Similarly, suppose trade receivables, trade payables. Parent company books to trade receivables, certain portion is B Limited only. B Limited point of view trade payables, A Limited point of view trade receivables, both will be adjusted. Common debts, sir, common debts. Because A Limited, P Limited now treated as one single entity. That's why. Okay, so this is step number 7, sir. And what is step number 8, sir? Reserves for consolidated balance sheets. Sir, important, sir. When you are preparing the reserves for consolidated balance sheet, first always start with the parent company reserves. Reserves as appearing in the parent's balance sheet. Parent company reserves you take. And tell me till now what adjustments I have we have discussed relating to this. I will recollect one by one. First, parent company share in the post acquisition profits of subsidiary will be added. Correct? See this. Parent company share in the post acquisition reserves and surplus. Step 3. Step 4, sorry, apportionment. One adjustment. Second adjustment, parent sold goods to subsidiary. In that, unrealized profit will be eliminated. See this. Reserves for unrealized profit eliminated. One more adjustment, dividend adjustment. Dividend received from subsidiary from pre-acquisition profits but wrongly included in P&L. Therefore, now we need to deduct it from the P&L account. So these 3 already we have discussed. Tell me, this is important. What adjustments will come in consolidated reserves? First, always you start with what? Parent company reserves. Now to this parent company reserves, 3 adjustments. Tell me, first adjustment, parent company share in the post acquisition profits of subsidiary. First. Second, any unrealized profit in respect of transactions between parent and subsidiary, eliminate. Next, any dividend received from subsidiary from pre-acquisition profits wrongly credited to P&L. Now deduct these 3. Apart from that, capital reserve will also come. What is this capital reserve? In step number 6, cost of control step, either goodwill or capital reserve come, sir. If there is a capital reserve, that you will take it. Now, whatever the reserves came, this is the reserves for consolidated balance sheet. These are the reserves for consolidated balance sheet. So that's it, Nana. This is the consolidation procedure. So one last time consolidation procedure we will discuss. First, tell me what is the first step? Date of acquisition. On which date parent acquired subsidiary? This date is relevant for analyzing the subsidiary company profits into pre-post. Step number 2. Shareholding pattern on the date of consolidation. On the date of consolidation, in the subsidiary company, parent company is having how much? Minority shareholders is having how much? Decide, determine. What is step number 3? Analyzing the subsidiary company reserves into pre-post. Pre-acquisition profits, capital profits. Post-acquisition profits, revenue profits. Why in analyzing? 3 important adjustments. What are those? Revaluation of assets, dividend given by subsidiary, intra-group transactions, downstream, upstream. Everybody, what is step number 4? Apportionment of subsidiary company analyzed profits. How you do apportionment? Pre-acquisition profits, capital profits, post-acquisition profits, revenue reserve. Apportion between parent and minority interest. And step number 5, minority interest. How to calculate minority interest? Minority interest is calculated. In the subsidiary company, share capital, what is the share of minority shareholders? In reserves, pre-acquisition, post-acquisition reserves, what is the share? You need to deduct one thing. What is that? Stock reserve in respect of upstream transaction. Upstream. When subsidiary sold goods to parent, so unrealized profit of the subsidiary is apportioned between the parent and minority interest. So from minority interest you need to deduct, because you already done apportionment and analysis. You apportion between the parent and minority interest. What is step number 6? Cost of control. How to calculate cost of control? Amount invested minus pre-acquisition dividend. Then you will get adjusted investment. Compare with the share in the net assets of subsidiary company. And this is calculated on which date? Date of acquisition. Therefore, share capital plus pre-acquisition profits. In that, what is your share? Compare. The difference is goodwill or capital. And what is step number 7? Intercompany transactions. I told you, any intercompany owings are there, eliminate. And also, any transactions happen between parent and subsidiary, upstream, downstream, adjust. And what is step number 8? Reserves for consolidated balance sheet. When you are preparing consolidated, reserves, first you need to start with what? Parent company reserves. 3 important adjustments I told you. So, parent company share in the post-acquisition profits of subsidiary, unrealized profits, and any dividend given by subsidiary from pre-acquisition profits wrongly credited to P&L, adjust. And last step, preparation of consolidated balance sheet. And in preparation of consolidated balance sheet, already I told you, share capital, always which company share capital we need to take? Parent. Reserves, step number 8. Minority interest, step number 5. And any liabilities, both the company's liabilities minus intercompany transaction. Intercompany owings eliminate. Fixed assets, same. Both the company's assets will be added, and any unrealized profit, any revaluation adjust, and also any goodwill comes in step number 6, take it. Investments, parent company investment in subsidiary shares, will you consider it? No. Only these are outside investments we will consider. And last one, current assets, loans and advances. Simple. Add parent, subsidiary. Any intercompany dues, eliminate. That's it. Important adjustments also I told you. Revaluation of assets, dividend, and eliminate intra-group transactions. Bonus shares I will cover it. Wait. So except bonus shares, all things we have discussed. So tell me, have you understood the entire consolidation procedure? Are you comfortable? Yeah. Okay, sir. We have discussed the consolidation procedure for balance sheet. Now we are going to solve questions relating to consolidation. Questions are very, very important, sir. You learned the theory. Now we try to apply that theory in the questions. Okay. Come to illustration number 10. I will start with a small question and gradually we will do different kinds of questions. So come to question number 10, sir. Illustration number 10 in our material. Illustration 10. Say this. Prepare the consolidated balance sheet of H Limited and its subsidiary as at March 2011 from the following information. Sir, they are asking consolidated balance sheet of H and its subsidiary. Okay. So HS details given, sir. PP 5 lakhs, 3 lakhs. Investments, you see, 20,000 equity shares of S Limited. I told you, no, sir, in the parent company balance sheet asset side, investment in subsidiary company will be there, na? So 2,20,000. This is the cost of investment. Current assets given 1,55,000, 1 lakh. Share capital, fully paid equity shares of 10 each, 5 lakhs, 2,50,000. So that means in the subsidiary company, total 2,50,000 share capital is there, each share 10 rupees. That means 25,000 shares. In that 20,000 shares are purchased by parent. So can you tell me the percentage? 80%. Correct now? Hello? 20,000 divided by 25 into 100. 80% is the percentage of holding. So parent company is having 80%. Minority interest 20%. P&L account balance 2 lakhs, 1 lakh. Trade payables 1 lakh 7550. H Limited acquired the shares of S Limited on 31st March 2011. Date of acquisition 31st March 2011. And these figures are also given on 31st March 2011. That means date of acquisition, date of consolidation, both are same date. That means one important point, sir. Whatever the reserves in subsidiary company on the date of acquisition, can you tell me what is this reserve? This 1 lakh is what? Pre-acquisition reserves. Very good. Because all the reserves, whatever there on the date of acquisition, are which reserves? Pre-acquisition reserves. There is no post-acquisition reserves. Therefore, consolidated reserves will not be affected. Okay. Now, what I will do is, whatever theory I discussed, sir, accordingly I will solve, so that there will be uniformity and your confidence will also increase. Okay. Now see. So quickly I am going to solve this question. So can you help me? What is illustration number 10? See the procedure. See, actually last step is what? Consolidated balance sheet. Consolidated balance sheet. That is the main solution. Remaining steps and all working notes for that solution. So in the examination, you do the working notes first, consolidated balance sheet first, don't have any discussion. In whatever order you do. They will allot the marks. So that is not the important point here. Okay. But in the study material, if you see, first main solution, consolidated balance sheet is given. Below that working notes will be there. So, but these working notes are very important for us to prepare the consolidated balance sheet. So first, always, what is step number 1? Date of acquisition, 31st March 2011. Take this date. Second, shareholding pattern on the date of consolidation. On the date of consolidation. On the date of consolidation, sir, in the subsidiary company, how much shares are held by parent and others? Here parent company is which company, sir? H Limited. They are having 20,000 shares. Minority interest, obviously remaining 5,000 shares. Correct? Huh? Total 25,000 shares is there in the subsidiary. Now can you tell me the percentage of holding? 80-20. So total 100%. Always determine this. Step number 2, shareholding pattern. Step number 3, sir, most important step, analysis of reserves and surplus of subsidiary company S Limited. Right? Sir, if you see the study material, they will not give this much systematically. That's why most of the students are confusing in consolidation, because they will not follow any uniformity. I will make sure that I will follow uniformity. Whatever you learned in the theory, same thing you apply in problem solving, so that there will not be any confusion. So see this, analysis of reserves and subsidiary company. Always go to subsidiary company balance sheet and tell me what are the reserves we had. P&L account. This 1 lakh. So see this. So P&L account 31st March 2011. How much balance is there? 1 lakh is there. Now this 1 lakh, sir, entirely which profit, sir? Pre-acquisition profits. Because by the time you are acquiring subsidiary, this profit is there. So this is which profit? Capital profit. Capital profit. Okay. And I analyzed the subsidiary company profits. Only P&L account is there. Nothing is there. Right? Nothing. No other reserve. Step number 4. Apportionment. Apportionment of profits. Whatever the profits we analyzed, reserves we analyzed into pre-post. Now apportion it. See this. All profits are which profits? Pre-acquisition profits. Pre-acquisition profits are capital profits. What is there? P&L account. How much is there? 1 lakh. So entire 1 lakh is pre-acquisition profit. And this 1 lakh, I told you, in the subsidiary company pre-acquisition profits, you need to share between the parent company minority interest. Parent company share 80%, minority interest 20%. So parent company share 80,000, minority interest 20,000. Now you tell me what we are going to do. This parent company share in the pre-acquisition profits of subsidiary company, step number 6, cost of control, we will adjust. This minority interest share in pre-acquisition profit, step number 5, minority interest step we will consider. Okay, hello, tell me, you understood? Next, step 5 is minority interest. What is minority interest? Nothing but minority shareholders share in the subsidiary company net assets. The net assets of the subsidiary company, how they will be find out? Simply share capital plus reserves and surplus. Take these two, share capital and reserves and surplus. 2,50,000, 1,00,000. So therefore, see this. In the share capital, 2,50,000, 20% held by minority interest. In the P&L account, that is pre-acquisition profits, already we calculated. See, here we analyzed na pre-acquisition profits. In the pre-acquisition profits of step number 4, minority shareholders share is 20,000. And in the share capital 2,50,000, 20% means how much? 50,000. So therefore minority interest 70,000. That's it. So minority shareholders share in the net assets of subsidiary company 70,000. Got it. Now what is step number 6? Cost of control. One of the most important steps. First, always you take amount of investment. Amount of investment. Tell me how much cost of investment done by parent in the subsidiary? 2,20,000. Always, Nana, once again I am explaining, this parent company investment will be compared with less share in the net assets of S Limited, represented by share capital 2,50,000 into 80%, pre-acquisition profits, parent company share 80,000. Already we analyzed in step number 4. How much? 80,000. So 2,50,000 into 80%, 2 lakhs. 2,80,000 will be what? 2,80,000 will be, yes, share in the net assets of subsidiary company. So therefore we invested more than the net assets we got. So it is called, we invested less than the net assets we got. So 60,000 will be what? Capital reserve. Capital reserve. Okay, sir, understand, sir, this is important step, sir, important step. Understand, sir, this step, sir, cost of control is determined on the date of acquisition. In this case, date of acquisition is 31st March 2011. Always, sir, you compare your investment value with the share in the net assets, sir. In the subsidiary company, on the date of acquisition, what will be the net assets? In that net assets, what is your share? So see this, see, understand the logic here. On the date of acquisition, if you see, in the parent company, investment is how much? 2,20,000, correct? Against this 2,20,000, in the subsidiary company, there is a share capital and reserves and surplus. So both will be adjusted. Remaining will be reflected as goodwill or capital reserve. Logically, you understand. Logically, parent company investment, subsidiary company share capital and reserves and surplus. Actually, we will not incorporate subsidiary company share capital and reserves and surplus. Why? Because we are setting off these two. Parent company investment is nothing but subsidiary company share capital. Sir, this 2,20,000 invested by whom, sir? Parent. This is in the form of share capital and reserves and surplus. It is there in subsidiary company. So therefore, what I will do is I will adjust these two. This is called cost of control. Cost of control is nothing but your investment is adjusted with the net assets. Net assets means share capital plus resource and surplus. On that date, in the subsidiary company, there is 1 lakh rupees is there. This is pre-acquisition profits. So 2 lakh 50 plus 1 lakh, 3 lakh 50 into 80%. How much we got? 2 lakh 80,000. 2 lakh 80,000. So therefore this 2 lakh 80,000, 2 lakh 20,000 I need to compare. So 60,000 I need to incorporate. Now if anybody asks you one question, suppose I am asking your friend asked one question. Tell me what the question is. In consolidation, why you are not incorporating the subsidiary company share capital and reserves and surplus? What is your answer? Tell me. One of your friend is learning consolidation chapter, sir. He asked you, why you are not considering subsidiary company share capital and reserves and surplus in the consolidated balance sheet? What is your answer? My answer is, it is already included in the form of goodwill or capital reserve. Why? Because see, I cancelled this against this. Yes, of course. See, in this my share means parent company share. Remaining 20% I am incorporating in minority interest. So understand, on the date of incorporation, whatever the net assets means share capital plus resource and surplus. On the date of acquisition, whatever the resource and surplus are there, they are pre-acquisition profits. So in this 3 lakh 50,000, 80%, 2 lakh 80,000, I compared with my investment. So therefore my investment is eliminated. Subsidiary company, my share in the net assets eliminated. The difference I am showing it as what? Goodwill or capital reserve. Now this should be your answer. You need to tell your friend that, see, in the subsidiary company, whatever the share capital and reserves and surplus is there, we are adjusting it against our investment. Our share in the net assets of subsidiary company, we are adjusting with our cost of investment. The difference we are showing it as goodwill or capital reserve. Therefore, all pre-acquisition profits are already adjusted. That's why post-acquisition profits we are adding back in step number 8. Sir, step number 8, why you are adding only post-acquisition profits of parent company? Post-acquisition profits, parent company share, why you are adding back? Why you are not considering pre-acquisition profits? Because pre-acquisition profits are already adjusted in the form of goodwill or capital reserve. We cancel this pre-acquisition profits against investment and my share. Logic you understood? Yes. Actually, sir, consolidation, if you learn the logics, it's a beautiful chapter. Only thing is that if you don't understand the logics, it will be a normal routine chapter. Are you understanding whatever the logics I am telling you? Yes, yes. So capital reserve, 60,000. What is step number 7? Intercompany owings, nothing is there. Correct? Intercompany owings, nil. That's it. One most important step. Reserves for consolidated balance sheet. Now you have to help me here. Tell me, how much will come in reserves for consolidated balance sheet? I told you, whenever you are preparing reserves for consolidated balance sheet, first you need to consider parent company. See, parent company balance of reserves. Tell me, in parent company, how much reserves is there? 2 lakhs. P&L account? P&L account, 2 lakhs is there. For this, what adjustment you do? Any adjustment? Any post-acquisition profits? No, because we are preparing consolidation on the date of acquisition. So there is no post-acquisition. Sir, in the subsidiary already reserve is there, sir, P&L. Why you are not taking that? That's a pre-acquisition reserve which is already adjusted. We need to add only which reserves? Post-acquisition profits of subsidiary. So post-acquisition profits of S Limited, nil. So therefore, the total reserve for consolidation purpose is 2 lakhs. Wrong. One more thing you need to do. What is that? Capital reserve we got in step number 6. Correct? You should not forget it. Capital reserve. How much we got? 60. So total 2 lakh 60. Done. All steps we have done. Very simple. If you follow my procedure, it will be very easy. And if you see the study material, it will be very difficult. For this simple problem, they are doing a lot of things. And you see, next we are going to solve very deep questions. So if you see the answer they have given, you don't understand. So therefore, there should be a system you need to follow. Okay, now we need to prepare what? Consolidated balance sheet. Now consolidated balance sheet. So see here, in consolidated balance sheet, what items will come first? Equity and liabilities, shareholders funds, share capital, reserves and surplus. Next, minority interest. Look at this. The speciality of the consolidated balance sheet is this one. Minority interest is added. One item. Actually, in the normal individual balance sheet we are preparing as per schedule 3, minority interest will not be there. Na? Minority interest is a special item which will come only in the consolidated balance sheet. Remaining items are same. Like for example, next liabilities. What liabilities we have? Only trade payables. Next asset side we have PPE, non-current assets, current assets. Investments will be cancelled, right? So take one by one. First, equity and liability, shareholders funds, share capital. So tell me how much is the share capital? Only which company share capital we need to consider? Parent company share capital. I told you. In consolidation we need to consider only parent company share capital. So take parent company, how much share capital is there? 5 lakhs. So 50,000 equity shares of 10 each, 5 lakhs. So take 5 lakhs. Reserves and surplus. Already we have done the consolidation. Step number 8. So P&L account 60,000. Capital reserve. Sorry, P&L account 2 lakhs. Capital reserve 60. So therefore, you see, capital reserve 60,000. P&L account 2 lakhs. Or else I can do like this. Capital reserve 60, P&L 2 lakhs. So total 2 lakh 60. Equity share capital 5 lakhs. Okay. Next. Minority interest already we calculated, na sir? So minority interest means minority holders share. So step number 5 we have done. How much? 70,000. So step 5, 70,000. How we got? You know this. In the paid up value share, 50,000, 20,000 actually. 50, 20. Okay. Next. Trade payable, sir. H limited 1,75,000. H 50. Any intercompany? No. 175, 50. Total 2,25,000. Asset side PP, any changes? No. H 5 lakhs. S 3 lakhs. Total 8 lakhs. Come to current assets. H 1 lakh. S total, that's it, 2,55,000. So share capital 5 lakhs. Reserves and surplus 2,60,000. Minority interest 70. Trade payables 2,25,000. Just whatever the items are there. Total 10,55,000. Next, asset side, non-current assets 8 lakhs PPA. Next, current assets 2,55,000. Total 10,55,000. That's it. This is the consolidation. First question we have solved. This is illustration number 10, sir. We have completed illustration number 10. Illustration number 11, sir. See illustration number 11. H Limited, S Limited provides the following information as at 31st March 2012. So H Limited, S Limited, sir. PP 1 lakh, 1,30,000. Investment 8,000 equity shares of S Limited. Sir, H Limited is having 8,000 equity shares of S. 1,26,000 investment. Current assets given. Share capital fully paid equity shares of 10 each. That means in S Limited, how many shares total? 10,000. 1 lakh is the share capital. Each share 10 rupees. 10,000. In the 10,000, how many shares are held by H? 8,000. So therefore H is having 80%. Minority interest 20%. P&L account balance 50, 40. Trade payables 1,60,000. Additional information, important sir. Additional information. H Limited acquired the shares of S Limited on 1/7/2011. So date of acquisition and date of consolidation is different. Date of consolidation, you see, they have given 31st March 2012 because balance sheet date given 31st March 2012. But H Limited acquired subsidiary on 1/7/2011. 1/7/2011. So, and balance of P&L account of S Limited on 1/4/2011, 30,000 given. Important sir. This question is important. Sir, H Limited acquired the shares of S Limited on 1/7/2011 sir. Date of acquisition. And they have given the P&L account of subsidiary company on 1/4/2011, 30,000 sir. Prepare consolidated balance sheet of H and a subsidiary on 31st March 2012. Sir, last problem quite easy because date of acquisition and consolidation same. But here date of acquisition, consolidation date are different. You have to be very careful when you are analyzing the profits of subsidiary company in this case. Now see, I am going to solve it. Say this. This is illustration 11. Illustration 11 sir. First date of acquisition. Can you help me? What is the date of acquisition? 1/7/2011 sir. 1/7/2011 is the date of acquisition, right? Next, shareholding pattern on the date of consolidation. On the date of consolidation. On the date of consolidation in the subsidiary company, how many shares are held by parent company? How many shares are held by minority interest? Parent company H Limited, minority interest. Parent company is having 8,000 shares, minority interest 2,000. So percentage is 80%, 20%. Correct? So 10,000, 100%. So shareholding pattern also done. Now analysis of profits, which is very, very important in this question, sir. See this. Analysis of S Limited reserves and surplus. Now in S Limited, what are the reserves and surplus given? Only one. What is that? P&L account. How much? 40,000. 40,000 P&L account given, sir. So P&L account when 31st March 2012. See, this balance is on 31st March 2012. How much is the balance? 40,000. Correct? Now I am analyzing it properly. See this. I told you subsidiary company profits are analyzed into pre-post. Look at the date of acquisition. Date of acquisition is 1/7/2011. Therefore, whatever the profits are there on that date, pre. After that, post. Right? Now, they have given in the question the opening balance. See this. Opening balance they have given. Opening balance on 1/4/2011, how much given? 30,000. Right? So this is called pre-acquisition profit, definitely. Because this profit is already there before date of acquisition. So pre-acquisition profits. Now tell me, if your opening balance is 30,000 and your closing balance is 40, that means what will be your current year profit? 10,000. Obviously common sense. This is the balancing figure. Sir, your opening balance 30,000 sir. Closing P&L balance 40,000 sir. That means current year how much profit sir? 10,000. But tell me this 10,000 pre na posta. See, this is current year profit. In the current year, from 1/4/2011 to 30th June 2011. Right? So April, May, June. This 3 months is what? Pre-acquisition profits. And from 1st July 2011 to 1st July 2011. 1st July 2011 to 31st March 2012. This 9 months is what, sir? Post-acquisition profits. Agreed or not? You check the problem. Which date parent acquired subsidiary? 1st June. July. 1st July. 1st July. That means till 30th June, whatever the profits are there, pre. After that, post. So therefore, already whatever the profits are there on 1/4/2011, obviously pre. Now in the current year, subsidiary company earned 10,000 profit. So if I divide it on time basis, first 3 months pre, next 9 months post. You understood? Very simple. So now I got pre and post profits, sir. Pre-acquisition profits, post-acquisition profits. Understand, sir? All pre-acquisition profits are capital profits. All post-acquisition profits are here. We are analyzing P&L. So this is revenue reserve. Sorry, this is revenue profit. You are analyzing P&L account. So therefore, this is revenue profit. You understood? Revenue profit. Now this is the analysis. Now once I analyze the subsidiary company profits, next step is apportionment I need to do. Apportionment of profits. Apportionment of profits. So if I do the apportionment, sir, see this. Pre-acquisition profits, capital profits. Post-acquisition profits, here revenue profit. Only P&L account is there. Now you tell me, in the P&L account of 40,000, how much is the pre-acquisition profit? 30,000. See this, 30. This 3 months. Oh, this 3 months we need to analyze it. 10,000 into 3/12. Can you tell me how much? 2,500. This is 10,000 into 9/12. 7,500. Therefore, what is the total capital profit? 30 plus 2,500. 32,500. Correct? So 32,500 is capital profit. Revenue profit is 7,500. Like this we need to divide. Important, sir. Look at this, sir. In the subsidiary company, at the end of their 40,000 profit is there. This profit, if I divide into pre and post, it is 32,500, 7,500. How I divided, sir? Based on date of acquisition. So when parent company acquired subsidiary on 1/7/2011, till that point of time, whatever the profits are there, they are pre. Already opening balance I know, that is pre. In the current year, I allocated the profit on time basis. Here the assumption is profit is occurred evenly throughout the year. Therefore, first 3 months profit is a capital profit. Next 9 months profit is a revenue profit. Revenue profit. So therefore, now we have done it. So now this profit is apportioned between the parent company H Limited, 80% their share, minority interest 20%. So can you tell me the different portion? 26,000, 6,500. This one revenue profit 6,000, 1,000. Can you tell me the what is the treatment I explained? See this. Parent company share in the pre-acquisition profit. Correct? Parent company share in the pre-acquisition profit, what we need to do? Step number 6, cost of control we will adjust. Correct? Parent company share in the post-acquisition profit we will add to consolidated reserves. Step number 8. Minority interest share, whether it is pre or post, we will consider in step number 5. So this is the important treatment. This we discussed in, while I am explaining the theory, I explained this. Sir, are you all understanding? So apportionment of profits we have done, sir. So we divided the subsidiary company profits into pre-post. Then this pre-post profits we have apportioned between the parent company and minority interest. Okay. Now once this one is over, next step is minority interest. So minority interest is 20%. Correct? 20%. So look at one by one. Take the share capital of the subsidiary company. How much is the share capital? 1 lakh. In that 20%. Correct? And take the pre-acquisition profits. Pre-acquisition profits, nothing but capital profit, sorry. Pre-acquisition profits, capital profit. You go step number 4 and see. In the capital profit, what is the minority interest share? 6,500. So take 6,500. This is 20,000. And in the revenue profit, what is the share of minority interest? So 1,500. Correct? 1,500. So therefore, total it will be 28,000. So we got minority interest. Minority interest is nothing but minority shareholders share in the net assets of subsidiary company. So simply net assets means share capital plus reserves and surplus. Already reserves and surplus are analyzed and divided. So therefore no need to do it. Just from step number 4, take the minority interest share, and in the share capital, what is their share, you calculate, you will get net assets, minority interest share. And now step number 6, most important step, cost of control. First take the cost of investment. What is the cost of investment? 1,26,000. Now less share in net assets of S Limited, represented by what? In the share capital. In the subsidiary, what is the share capital? 1 lakh. In that 80%. And also on the date, see, this is calculated on the date of acquisition. On the date of acquisition, all profits of subsidiaries pre-acquisition profits, correct? This is nothing but capital profit. In the capital profit as a parent company, my share is how much? 26,000, correct? So take 26,000 and this one 80,000. So total it will be 1,06,000. So 1,26,000 minus 1,06,000. 1,26,000 is the cost of investment, sir, less my share in the net assets. How much? 20,000 is what, sir? Goodwill. Our investment cost is more than the share in the net assets. Goodwill we got 20,000. So cost of control. So always remember, sir, what is the amount you are spending, and for that what is the share of net assets you are getting. So that's why in the subsidiary company, on the date of acquisition, whatever the pre-acquisition profits is there, that we will not incorporate separately, because this share capital and pre-acquisition profits is adjusted against our cost of investment. Only remaining we will represent as goodwill or capital, sir. Next. So next is step number 7. Step number 7, intercompany owings nil, correct? Any intercompany owings? No. Most important step, reserves for consolidated balance sheet. Reserves for consolidated balance sheet, always you need to consider which company reserves? Parent company reserves. So only P&L account is there, correct? So balance of H Limited, how much? 50. Now any post acquisition profits? See, go to step number 4. You see here, in the post acquisition profits, what is the parent company share? 6,000. This 6,000 we need to consider. Add post acquisition profits. How much? 6,000. Can anybody tell me why post acquisition profits are added? Because pre-acquisition profits already adjusted. After that, the subsidiary how much profit earned, that will be the profit of the group. And because in the subsidiary company, because of the increase of the profits, obviously net assets will increase. Therefore, this increase should also be reflected in the reserves. So therefore, I increased the reserves of parent company. Because this reserve 6,000 is coming from what? Subsidiary company. So total how much it is? 56,000. Got it? So that's it. So reserves for consolidated balance sheet also we have done it. Next, what we need to do? Balance sheet we need to prepare. Simple. So go to the balance sheet. So first, equity and liabilities, shareholders funds. So share capital, reserves and surplus, minority interest. In current liabilities we had trade payables. Assets same, non-current assets, PP is there. Intangible asset is also there. Why intangible asset? Goodwill. And then current assets. So let's fill one by one, sir. First, share capital you take. So share capital, sir, only parent company share capital you need to take. In the parent company, 1,50,000 is there, correct? So of share, each share 10 rupees. Therefore 15,000 shares of rupees 10 each. Say this 1,50,000. Now come to reserves and surplus. We already calculated na consolidated reserves. Reserves for consolidated balance sheet, how much? 56,000. So take 56,000. Okay. So this is how the calculation they have done. So you simply in examination, sir, you put reference of step number 8. That's it, over. Okay, they will look after it. Minority interest we calculated step number 5. So in step number 5 we done minority interest. See this 20,000, 6,500, 1,500. See this 20,000, 8,000. That means we have done more detailedly 6,500, 1,500, total 28,000. Minority interest 28,000. Trade payables, parent company 1 lakh, subsidiary, any intercompany owings, so total 1 lakh 60 will come in consolidated balance sheet. PP parent 1 lakh, any change, subsidiary 1 lakh 30, 1 lakh 30, total 2 lakhs 30. Now intangible assets, sir. Intangible assets we got goodwill. So goodwill calculation we have already done. He has given entire thing here, cost of investment, paid up value. So step number 6, you give the reference of step number 6. So how much we got? 20,000. So goodwill 20,000. Current assets parent 74. Subsidiary 70. Total 144,000. 1,44,000. So if I update this in balance sheet, sir, share capital 1,50,000, reserves and surplus 56,000, minority interest 28, minority interest 28, current liabilities trade payables 1,60,000, total 3,94,000. Now non-current assets PP how much? 2,30,000. Intangible goodwill 144. Correct? Intangible assets 20. Yeah. So goodwill 20,000. 20,000 goodwill. Current assets 1,44,000. Sir, you need to be very careful because when you are calculating cost of control, either capital reserve or goodwill may come. So they will be updated in the balance sheet. Can you tell me the total? 3,94,000. That's it. So these are simple consolidation sums, sir. So this is illustration number 11. We completed. Yeah. Now come to illustration number 12. So from the balance sheet and information given below, prepare consolidated balance sheet of Virat Limited and Anushka Limited as on 31st March. Virat Limited holds 80% equity shares in Anushka Limited since its incorporation. So since from the incorporation, Virat Limited is having 80% shares in Anushka Limited. Therefore, all the profits of Anushka Limited are which profits? Post-acquisition profits. Because this is newly formed company. By the time I am acquiring Anushka Limited, that company does not have any profits now for a newly started company. Therefore, whatever the profits acquired by the Anushka Limited, after incorporation, everything will be post-acquisition profit. Now you look at the balance sheet of both the companies, Virat and Anushka. Share capital given, reserves and surplus given, non-current liabilities, long-term borrowings given, current liabilities, trade payables given, asset side, non-current assets, property, plant, equipment, non-current investments given. Generally, in non-current investments, sir, in the parent company balance sheet, investment in subsidiary company will be shown as a asset. You see note number 3, shares in Anushka Limited, nothing but 3,20,000. And this investment will appear in the individual balance sheet. But when you prepare the consolidated balance sheet, this investment will be adjusted against the subsidiary company net assets. Balance will be goodwill or capital reserve will come. Okay. Asset side you see property, plant, equipment, non-current investment, current assets, inventory, trade receivables, cash and cash equivalents. Notes to account, share capital 60,000 equity shares of 10 each fully paid 6 lakhs, 40,000 equity shares of 10 each fully paid up 4 lakhs. Total 6 lakhs, 4 lakhs. Reserves and surplus we have general reserve. That's it. So I think this problem is very straightforward question, sir. Two company balance sheets given, Anushka, Virat, and from the beginning Virat Limited is parent of the Anushka Limited. Now we need to do the consolidation as on 31st March 2011. So very simple. So let's do this. So this is illustration number 12, sir. First tell me what is the date of acquisition? Since the date of incorporation. What is step number 2? Shareholding pattern, correct? Shareholding pattern. Sir, in Anushka Limited, Virat Limited is having 80%, sir. And minority interest is having 20%, sir. So total 100%, sir. If you want, you can write number of shares also, sir. All these things. Now, what is step number 3, sir? Analysis of profits of Anushka Limited. Important, sir. Sir, in the Anushka Limited balance sheet, if you see, as on 31st March 2011, in the reserves and surplus, note number 2, they have general reserve of 1 lakh. Correct now? So this general reserve they have given, sir. On 31st March 2011, how much balance given? 1 lakh. You tell me what is this 1 lakh? These are all post acquisition profits. We cannot divide this into pre and post. These are all post acquisition profits. Why? Because from the beginning, Virat is parent of the Anushka Limited. So whatever the profits earned by the Anushka is obviously post acquisition profits. Now, once we identify post acquisition profits, step number 4, apportionment. Apportionment of profits. How I am going to apportion it? Pre, post. So post acquisition profits. Here we have analyzed general reserve. It's a revenue reserve. How much? 1 lakh. This 1 lakh you divide between Virat Limited parent company. How much? 80%. Minority interest 20%. So 80,000, 20,000. Can you help me out? What is the treatment? Parent company share in the post acquisition profits of subsidiary company adjusted in step number 8. Parent company share in the pre-acquisition profits of subsidiary, cost of control step. Now minority interest will go to step number 5, minority interest. So step number 4 over. What is step number 5? Minority interest. Sir, 20% is the minority interest, correct? So look at Anushka Limited. Anushka Limited share capital how much? In that 20%. 80,000. And also you see in the Anushka Limited post acquisition profits, that is revenue reserve, right? In that minority shareholders share, just now we calculated 20,000. So total 80,000, 1 lakh is the minority interest. 1 lakh is the minority interest. So 1 lakh is the minority interest, sir. So we calculated 1 lakh is the minority interest. Now step number 6, important step, cost of control. First you need to take the cost of investment. What is the Virat Limited investment in subsidiary cost, sir? 3,20,000, correct? And this cost of investment based on the information on the date of acquisition, we need to compare with the share in net assets. Parent company share in net assets of subsidiary company, that is Anushka Limited. Anushka Limited represented by share capital. In Anushka Limited, what is the share capital? 4 lakhs. In that 80%. How much? 80% of 4 lakhs? 3 lakhs? 20,000. And also in the post acquisition profits, revenue reserves. Step number 4, if you see, what is the parent company share? 80,000. Correct? So therefore, net assets on the date of acquisition is 4 lakhs. But my investment is 3,20,000. So I am getting more net assets than the investment. So what is this? Capital reserve. So this will be treated as what? Capital reserve. So we got a capital reserve of this much. Correct? Sir, share capital Sir, how this is correct, sir? Tell me, how this is correct? Are you all sleeping? See, this is post-acquisition profit. This post-acquisition profit of the parent company, what we need to do? Step number 8. This is cost of control. Cost of control means in the subsidiary company, pre-acquisition profits, we need to consider the share. So we should not consider this. So please. So therefore, here, small mistakes we cannot do in the examination. Understand? So here only 3,20,000 we need to consider, sir. Because, sir, on the date of acquisition, you have acquired Anushka on the date of incorporation itself. On that date, definitely newly started company will not have any profits. Therefore, only share capital will be there. So that will be net assets, nothing but. So therefore, we need to consider only 3,20,000. So therefore, here nil. Goodwill or capital reserve nil. No goodwill, no capital reserve. You understood the reason, because all profits of the subsidiary are post acquisition. They will not be considered in cost of control step. Cost of control step is calculated based on the date of acquisition data. On the date of acquisition, what is the subsidiary company share capital? Pre-acquisition profits. In that parent company share, we need to compare with cost of investment. So there is no pre-acquisition profits in this question. Entire profits are post-acquisition profits. Okay. So step number 7. Intercompany owings. No, nil. Correct? Intercompany owings nil. Now I need to prepare consolidated reserves. So, yes, reserves for consolidated balance sheet. Very, very important. Can you help me when you start preparing reserves for consolidated balance sheet? First, you need to take balance of Virat Limited. So, in Virat Limited, what are the reserves we had, sir? General reserve is there, correct? General reserve, how much is there? 1 lakh. Now, what we need to add? Yes, post acquisition profits. Parent company share in the post acquisition profits of subsidiary. So, Virat Limited share in post acquisition profits of Anushka Limited. So, step number 4, if you see, you will get it. In step number 4, in the post acquisition profits of subsidiary, what is the share of the parent entity? How much? See this, 80,000. 80. So therefore, the total reserves for consolidated balance sheet 1,80,000. That's it. Now what we need to do? Prepare the consolidated balance sheet. So take it as usual items. Minority interest will extra come. And no goodwill, no capital reserve. Therefore, that will not come. So entirely before whatever the balance sheet of Virat Limited is there, you can take it. Only one additional item is minority interest. So take it. First, shareholders fund, share capital. So in Virat Limited, 60,000 equity shares of 10 each fully paid. 6 lakhs is there. So take it. 60,000 equity shares of rupees 10 each fully paid up, 6 lakhs. So share capital 6 lakhs. Reserves and surplus. Reserves and surplus we already calculated. Step number 8. Reserves for consolidated balance sheet. How much? 1,80,000. How we got this? 1 lakh plus 80,000 post acquisition profit. Total 1,80,000. So therefore total reserves and surplus 7,80,000. Oh, sorry, I added both. Yeah. So only 1,80,000. Correct. So 1,80,000. Minority interest, can you tell me? Already we have done step number 5. So minority interest 1 lakh, sir. 80/20. Right? 1 lakh is the minority interest. We have done this working note 3 also here. No need to do these workings. Already we have done it. Next, borrowings. Long term borrowings are there. Correct? How much is there in parent company Virat? 2 lakhs. Subsidiary, any intercompany owings? Total 3 lakhs. Next, trade payables Virat, Anushka 1 lakh, total 2 lakhs. No change, no intercompany. Next, property plant equipment Virat 4 lakhs. Anushka total 7 lakhs. Okay. Next, inventories Virat 60. Anushka 2 lakhs. Total 3 lakh 60. Trade receivables Virat, Anushka 140. Total 220. That's it. Cash and cash equivalents also there. Virat cash 40. Anushka total 1 lakh. So first, according to our discussion, my format, you prepare 8 steps. Then you prepare consolidated balance sheet, just write the figures. Okay, notes to accounts and all, you follow this pattern, but give references. Give references directly, no need to write again and again. Reserves and surplus, step 8, directly you write the amount like that. Okay, but when you prepare the balance sheet, give reference. See this, for example, shareholders funds, share capital, you write note 2. In note 2, so reserves and surplus, step 8, like that you give reference. That will be very easy, so that when the examiner correcting na, he feels all the notes prepared or not. He will see note 1, note 2, note 3, note 4, note 5, and in below you give the reference. Anyway, you will do it as a working note, right? So he will find and he will check and he will give the marks. Not a problem. Sir, presentation, whatever you do, it's no problem. Whether you are doing correctly or not, that's the important thing. But always when you prepare the balance sheet, sir, below that notes to accounts should be there. In the notes to accounts, minority interest, give reference, step number 5, like that. You give reference. No need to again and again you solve same thing. Once you solved in the working notes, that is sufficient. You give working note, reference to working note. Ante. Okay. So reserves and surplus, how much came? 1 lakh 80. Minority interest 1 lakh. Long term borrowings 3 lakhs. Trade payables total 13 lakhs 80,000. PPE we got it, how much? 7 lakhs. Current assets inventory 3 lakh 60. Trade receivables 250. 2 lakh 20. Okay, 2 lakh 20. Cash and cash equivalents 1 lakh. Total, that's it, 13 lakh 80,000. So 3 problems we have done. 12th sum, this is very simple, basic consolidation sum. Okay, sir, why I am solving 10, 11, 12 na? Because I want you to understand the basic consolidation first. What we are doing in consolidation? What are the important steps? Analysis, apportionment, cost of control, minority interest, consolidated reserves. These 5 are very important. And then just combining the assets, liabilities. All these things you incorporate, minority interest, goodwill or capital reserve, all consolidated reserves, balance sheet will come. Okay, it's just that procedure you need to understand it better. So we have discussed in a very deep manner all the procedure, every point I touched. So it is that now you need to start solving it once, so that you will get comfortable. Okay, this is illustration number 12, sir. So now we are going to start one of the most important question, illustration 13. Okay, so since you are very energetic now, better to solve one good question. Okay, illustration number 13. The speciality of 13 is there is revaluation of assets. So 10, 11, 12 basic consolidation questions we have done. So this question will take you to another level. Okay, because this question involves some good points. So that's why. Let us try to discuss this question. Important, see, these type of questions they are asking in the examinations. Okay, see this illustration number 13. Started. Illustration 13, sir. From the following balance sheets of H Limited and its subsidiary S Limited drawn up at 31st March 2011, prepare a consolidated balance sheet as at the date having regarding to the following. So balance sheets of H Limited and its subsidiary S Limited drawn up at 31st March 2011, prepare consolidated balance sheet as at the date having regarding to the following. Okay, see the points carefully, sir. Important question this is. First, reserves and P&L account of S Limited stood at 25,000, 15,000 respectively on the date of acquisition of its 80% shares by H Limited on 1st April 2010. Sir, what is the date of acquisition? 1st April 2010. Correct? So H Limited acquired S Limited on 1st April 2010. How much acquired? 80%. And on the date of acquisition in the subsidiary company S Limited, you see reserves and P&L account of S Limited stood at how much? 25,000, 15,000 respectively. Therefore, on 1st April 2010 in the subsidiary company 25,000, 15,000 is there. This is called pre-acquisition profits. Okay. Next, machinery. This is the important point. Machinery book value 1 lakh. Furniture book value 20,000 of S Limited. S Limited, that means subsidiary company, are revalued at 1,50,000, 15,000 respectively on 1st April 2010. That means on the date of acquisition, subsidiary company, machinery, furniture, both got revalued. For machinery book value 1 lakh, revalued at 1,50,000 upward. Furniture book value 20, revalued at 15, downward revaluation. So one asset upward, another asset downward. As I told you, on the date of revaluation, on the whatever revaluation happened on the date of acquisition, that is which profit? Pre-acquisition profit. And because of this upward and downward revaluation, there will be either additional depreciation or excess depreciation we need to adjust. Sir, I said we have discussed this point, sir. Next. Okay. On first, for the purpose of fixing the price for its shares. Okay. Rates of depreciation computed on the basis of useful lives. Machinery 10% rate, sir. Furniture 15% rate. Okay. Now look at the balance sheets of H and S, which is given on 31st March 2011. Sir, date of acquisition 1st April 2010, sir. Date of consolidation 31st March 2011, sir. Equity and liabilities, shareholders fund, share capital. Reserves and surplus, note 2. Current liabilities, trade payables. Assets, non-current assets, property, plant, equipment, other non-current assets. Notes to accounts, if you see, share capital 6,000 equity shares of 100 each fully paid. 1,000 equity shares of 100 each fully paid. Total. Reserves and surplus, general reserve is there, P&L account is there. So in subsidiary company, 2 reserves are there. General reserve, P&L. Property, plant, equipment, machinery, furniture. Other non-current investments, that is shares in S Limited. So, sir, here other non-current investments, we have non-current investments 4,40,000, 1,50,000, and also shares in S Limited 1,60,000. So in the parent company, 2 investments are there. In subsidiary, 1 investment, outside investments are there. They will come in consolidated balance sheet. Only parent company investment in subsidiary will not come. I think this is the balance sheet they have given, sir. This is the information. Now we need to prepare consolidated balance sheet. So tell me the date on which we need to prepare consolidated balance sheet. 31st March 2011. Date of acquisition 1st April 2010. And in this question, while analyzing the subsidiary company reserves and surplus, the most important point is revaluation of assets. So that is the most important point involved here. Okay. So very interesting, very good sum. Let us try to solve this question carefully, everybody. So see this. What is illustration 13? First I am doing the consolidation procedure. So consolidation procedure. Consolidation procedure. Step number 1, consolidation procedure. Date of acquisition. Tell me on which date H Limited acquired S Limited. 1st April 2010. This is the date of acquisition. Second, shareholding pattern. On the date of consolidation. So on the date of consolidation, 31st March 2011. So number of shares, percentage of holding. So H Limited minority interest. Sir, H Limited is having 80%, sir. Minority interest 20%, sir. Total 100. And if you look at the number of shares of subsidiary company, so total number of shares is 1000 equity shares of 100 each. Correct? 1000. In this 1000, 80% means 800 shares held by H, 200 held by minority, total 1000. This is the shareholding pattern on the date of consolidation. Shareholding pattern on the date of consolidation. Next, step number 3, the most important step is analysis. Analysis of reserves and surplus of subsidiary company, that is S Limited. Now I am analyzing one by one. First, there is a revaluation of assets is there in the subsidiary company. Therefore, revaluation reserve will come, right? That I will analyze first. So see this. See this here carefully. First is revaluation reserve. Revaluation reserve. Actually, there are two assets, sir, here. Two assets. One is machinery. Correct? So, particulars. What is the book value? WDV. What is the revalued amount? And what is the profit? Take one by one. First you take machinery. What is the machinery of the subsidiary company? On the date of acquisition, you see, on the date of acquisition, machinery book value is 1 lakh. So take 1 lakh here. And this 1 lakh worth of machinery, they revalued to 1 lakh 50. So take 1 lakh 50. Can you tell me how much increase? 50,000 increase in the asset value. Correct? Similarly, take the next asset. So furniture. What is the book value of furniture? 20,000 is the book value of furniture, right? 20,000 is the book value of furniture. And what is the revalued amount? 15,000 is the revalued amount. So therefore, how much profit or loss? Loss minus 5,000. Minus indicates loss. So therefore, I think revaluation happened, one asset upward, one asset downward. Net 45,000. Correct? This is called net revaluation reserve. Overall, because of the revaluation, the subsidiary company assets were increased by 45,000. Can you tell me what is this 45,000? This 45,000 is pre-acquisition profit. Understand? Because parent company, when acquiring the subsidiary company, they revalued it. So this is happened on 1/4/2010. So on 1/4/2010 there is a revaluation happened. Because of that, overall 45,000 increase in the net asset value, right? So this is revaluation profit. Asset account debtor to revaluation, asset account debtor to pre-acquisition profits. Asset to pre-acquisition profit. And I told you all pre-acquisition profits are which profits? Capital profit. So this is capital profit. Because next step I need to apportion between the parent and subsidiary. So for that purpose I am analyzing it. So tell me, have you understood the revaluation? Now next, help me. In subsidiary company, next reserve is what? In subsidiary company, what else we had, sir, in the form of reserves? So we have general reserve 75,000. Correct? So now let us analyze general reserve. So general reserve on 31st March 2011. What is the general reserve balance? 75. Now I want to analyze this into pre-post. Now tell me on 1/4/2010, that is opening balance, how much is given? See, the clearly given in the question, you see, on the date of acquisition. So on 1st April 2010, the reserves and P&L account of S Limited stood at what? 15,000. So therefore 25,000 is the opening balance of reserves and surplus. Correct? So 25,000. What is this 25,000? This is pre-acquisition profits. Already by the time you are acquiring subsidiary, this is there. So this is which profit? Capital profit. Capital profit. Pre-acquisition profits, capital profit. That means you tell me, sir, your opening balance is 25, closing 75. Therefore, what is the current year appropriation? Why I am calling appropriation? Because this is general reserve. Generally to general reserve, profits are transferred from P&L account. That is called appropriation. Even in schedule 3 also I told, cash flow statement also I told, appropriation to general reserve. Tell me what is the appropriation? 50,000. This is the balancing figure. Sir, kindly analyze. Closing balance 75, opening 25. You acquired subsidiary company on 1st April 2010. On that 25,000 balance is there. Therefore, it's a pre-acquisition profit. It is a capital profit. And that means if your opening balance is 25, your closing has become 75. That means how much is the current year appropriation? 50,000. So this 50,000 is a current year appropriation. Now entire current year appropriation becomes what? Post acquisition profits. And these post acquisition profits are called revenue reserve. Very good. Revenue reserve, because I am analyzing general reserve. So you understand the analysis of general reserve? Hello. Important. So every reserve analyze and identify whether it is capital profit or revenue reserve. Next, any other reserve in subsidiary company? Yes, what is that? P&L account is there. Look at the reserves. P&L account is there. How much is there? 25,000. Very, very important. Listen to me carefully. So P&L account I am analyzing. On 31st March 2011, what is the balance in P&L account? How much? 25,000. Now this is on 31st March 2011. So if I analyze this properly, if I divide this into pre and post, on 1/4/2010 opening date, how much is the balance in P&L account, sir? See this given, 15,000. In the S Limited, on the date of acquisition, 15,000 balance is there. So 15,000 will be what? It's a pre-acquisition profit. Agreed or not agreed? Already by the time you are acquiring, these profits are there. Therefore, they are pre-acquisition profits. All pre-acquisition profits are which profits? Capital profits. Capital profits. Now, understand carefully, you see. 25,000 is the closing balance, opening balance 15,000. Therefore, what is the current year profit? 10,000 balancing figure. Anybody can say this. No confusion at all. 25,000 is the closing balance, opening balance 15,000. Obviously, current year profit is 10,000. Now you tell me whether this 10,000 is subject to any adjustment. Yes, because there is a revaluation of assets. I told you whenever there is a revaluation of asset, if there is an upward revaluation, because of that my additional depreciation will increase. It is affecting my post acquisition profits. Therefore you see here machinery value increased how much? 50,000. On that 50,000 you apply depreciation rate at 10%. That means 5,000 additional depreciation you need to provide. If you provide additional depreciation of 5,000, your current year profits will decrease. Correct? Therefore here less additional depreciation on plant and machinery. How much? 50,000 is increase in the value of machinery, 10% rate of depreciation given. So 5,000 will be depreciation increase. If there is additional depreciation, my profits will come down. Agreed or not agreed? One more thing will come, furniture. You see furniture undervalued, downward, upward, downward. If you downward that, obviously excess depreciation will be added back. See this. Actually furniture in the books, how much is there? 20,000. But it is, what is the revalued amount? 15. That means this company on this furniture, 20,000 into what is the rate? So 20,000 into 15%, how much is the depreciation they provided? 3,000 they provided. But if you provide depreciation on 15,000 into 15%, it will be 2250. That means what is the excess depreciation? 750. This excess depreciation I need to add back. Because of that my profits came down now. So therefore I need to add back. So therefore here add excess depreciation on furniture. Important. Sir, furniture 5,000 increase, sir. Sorry, 5,000 decrease, sir. So into 15%. So therefore 2,000. How much? 750. Excess depreciation on furniture 750. Because see, current year profits are adjusted with the depreciation on the original value. What is the original value? 20,000. This one. They provided depreciation on this 20,000. 20,000 into 15%. Actually they should provide depreciation on 15,000 revalued amount. So because they provided excess depreciation, because of that my profit got decreased. Now I am adding back. And because of the machinery, they have considered the old one, but the new one is more. So therefore they have missed some depreciation. Now I provided it. I think this is the important adjustment, sir. Once you do the revaluation of assets, this adjustment you need to do. Now you tell me what will be the total? 5,750. What is this? Post acquisition profits. Correct? What is this post acquisition profit? Revenue profit. That's it. I think we have completed the analysis. So you understand this analysis? See, this is what I am talking about. Clarity. If you see the study material, of course it is correct only, but they will not give like this analysis. And I will make sure that whatever I am writing, it will be available to you. So you just download and use it. Okay? And if you solve like this now, there is less chances that you are going to do a mistake. And you will understand also very easily. P&L account 25, opening, closing. So current year, in the current year, what adjustments happened? Tell me, sir, have you understood, sir? So in analysis of resources of subsidiary company, we analyze it, sir. Now once analysis is completed, next one is what, sir? Apportionment we need to do. Correct? See this. Step number 4, I am doing the apportionment. Apportionment of profits of S Limited. So subsidiary company profits, I need to do the apportionment. So pre-acquisition profits, capital profits, post-acquisition profits, revenue reserve, revenue profit. So first, what is the first reserve? Revaluation reserve we have analyzed it now. Tell me revaluation reserve entirely which profit? Pre-acquisition. Already we have analyzed. See this. How much? 45. It's a capital profit, right? So take here 45. Don't consider here. Next, we analyzed what? General reserve. Correct? Reserves are general reserves. General reserve. General reserve, how we analyzed it? See this. In the general reserve, pre-acquisition how much? 25. Post-acquisition 50. So, pre-25, post-50. Okay. Now come to the last one, P&L account. P&L account, how we have analyzed? Pre-15, post 5,750. Correct? Pre-15, post 5,750. Understand pa? See here, post acquisition profit, revenue reserve means reserves other than profits. This is P&L account, revenue profit. Okay. Look at the wordings what I am using. Now you tell me the total of entire capital profit. 85. Okay, 85. Now post acquisition profits, revenue reserve, you tell me 50. This one 5,750. Now you have analyzed the entire subsidiary profits into pre-post. Now once analysis, you apportion this. Apportion between parent and subsidiary. Who is the parent here? Parent and minority interest. H limited. What is the percentage? 80-20. Correct? Tell me parent company share in the pre-acquisition profits. 68. Post acquisition 40. 4,600. Minority interest 17. 10,000. 1150. Now for your clarity, don't need to write in exams. Parent company share in pre-acquisition profits. What you do? Step number 6, cost of control, I will adjust. Parent company share in the post-acquisition profit. Step number 8. And minority shareholders share. Step number 5, I will add to minority interest. This is what for we are doing. See, if you do analysis correct, then only this will come correct. If you don't do the analysis properly, this will be wrong. Okay? Yes. And what is the next step? Minority interest. Correct? So minority interest actually 20%. Now in the subsidiary company, share capital how much you tell me? Share capital of subsidiary 1 lakh. 1 lakh. In that 20%. 20,000. Next, as per step number 4, capital profits. What is the minority share? 17,000. Revenue reserve. What is the minority share? 10,000. You take here. Revenue profit. Step number 4. 1150. So can you tell me the total? Minority share, nothing but 37, 47, 48,150. Correct? So minority interest done. Now the most important step is cost of control. And in cost of control, first I need to take the cost of investment. Can you tell me what is the cost of investment? 1,60,000. Correct? 1,60,000 less parent company share in net assets of S Limited, and this is represented by share capital first 1 lakh into 80%, 80,000, and also on the date of acquisition, whatever with the pre-acquisition profits, they are capital profits. In this capital profits, parent company share. What is the parent company share? Just now we calculated 68,000. Understand? See how I am solving, you need to observe. We have actually understood the concept. So parent company share in the subsidiary company pre-acquisition profits. That is adjusted to cost of investment. So that's why first I take the cost of investment, then in the capital profits, what is the share? 68. So therefore, my cost of investment is adjusted against share capital and capital profits of subsidiary company, 1,48,000. So therefore, I invested more than the net assets. So therefore, 12,000 is my goodwill. So this will be treated as goodwill. This will come in consolidated balance sheet. So step number 6, very, very important. Sir, in examination, suppose if you feel consolidation sum is so tough, at least if you have a time, you do this step, COC step, minority interest, you will get marks. It is not that entire consolidation you solve, then only they will allot marks. Stepwise marking will be there. Okay, but I hope you are going to solve the entire question. Okay, now step number 7, intercompany owings nil, correct? So intercompany owings nil, sir. So no need to consider. Now most important step, reserves for consolidated balance sheet. So reserves for consolidated balance sheet. Now when you are considering the reserves for consolidated balance sheet, sir, you have to be very careful. First to go to the parent company reserves. General reserve is there, P&L account not there, but basically P&L account is also there. Two reserves are there. Okay, so general reserve, P&L account. First take the balance of H limited. Sir, in the H limited balance sheet, general reserve how much is there, sir? 2 lakhs is there. Take it. P&L account nothing. Reserves and surplus. Oh, P&L account is there. So okay, I have not seen it. I thought some missing figure is there. Yeah. P&L account is also there. Yes, correct. 1,000. Take it here. 1,000. Yeah. P&L account 1 lakh. Okay. Now tell me now what we need to do. Yes, most important thing is parent company share in the, so H limited share in post acquisition profits. Post acquisition profits of S limited. So step number 4 we have already done. What is the parent company share in the net assets of subsidiary company? See this, 40,000, 4,600. This one, 40,000, 4,600. 40,000 is revenue reserve. 4,600 is revenue profit. Therefore, 40,000 you add to general reserve. 4,600 you add to P&L account. Because it is nothing but P&L means revenue profit. General reserve means revenue reserve. Parent company share in the post acquisition profits of subsidiary we need to add to the consolidated reserves. That's it. So it will be 2 lakh 40, 1 lakh 4,600. That's it. So I think all the steps we covered. Now we need to prepare the balance sheet of the parent company along with its subsidiary. Now when it comes to balance sheet, sir, as usual, equity and liabilities, shareholders funds, share capital, reserves and surplus, minority interest, any non-current liabilities we will take, then current liabilities, non-current assets, current assets. As usually same balance sheet. So see here, if you see the H limited balance sheet, sir, shareholders funds is there, share capital, reserves and surplus, current liabilities is there. As far as assets, only non-current assets are there. So very simple balance sheet, sir. So first shareholders fund, share capital you come, sir. When it comes to share capital, only parent company share capital we will consider. What is the parent company share capital? So 6 lakhs. So take it 6 lakhs. So 6 lakhs will be the share capital. Notes to accounts you will write share capital 6 lakhs, equity shares of 100 each fully paid up 6 lakhs. So total 6 lakhs. Now come to reserves and surplus, sir. Reserves and surplus already step number 8. We have detailedly provided, sir. What items will come, what items will not come. Like that we have done. So if you see, sir, general reserve 2 lakhs 40,000. Correct? So if I want to write according to the requirements, 2 lakhs this one, 40,000 this one, total 2 lakh 40. And also P&L account, if you see, 1 lakh 4,600, correct? P&L original 1 lakh parent company, 4,600 parent company share in the post acquisition profits. So 1 lakh 4,600. So total it will be how much? 3 lakhs 44,600. 3 lakh 44,600, correct? So take here 3 lakh 44,600. Minority interest already we calculated, sir. Working note 5. For us it is step 5. Okay. PP will come here. Property, plant, equipment. So remove here. So what will be the minority interest we got? 48,150. So take 48,150. So 48,150. So 48,150 here. Next, current liabilities, trade payables. So come to current liabilities, sir. Any note is there? Nothing. So directly you can add. Parent company, 1 lakh 5, 1 lakh 50. Okay. Subsidiary, 57,000. So total 2 lakh 7,000. So can you tell me the total of the balance sheet? 11 lakhs 9750. 11 lakh 99,750. Come to asset side, sir. Non-current assets, they have property, plant, equipment. Working note 4. Property, plant and equipment you need to consider carefully because there are revaluations happen, right? So take one by one, sir. First, you take the parent company plant and machinery, sir. So parent company, you tell me. Plant and machinery, H limited how much? 3 lakhs, huh? Okay. S actually originally book value how much? 1 lakh. How much increased? 50. So that's he is showing. S limited original book value, this is appreciation 50. So it is 1 lakh 50. So 1 lakh 50. Now you provide depreciation on the subsidiary company because parent company already they might have provided depreciation. So see this. In the subsidiary company, you take first machinery. Sorry, in the consolidated balance sheet, you take machinery. Parent company 3 lakhs. Subsidiary company 1 lakh 50. Provide depreciation. How much depreciation you will provide, sir? On 1 lakh 50, 10%, 15,000. Depreciation you will provide. Come to furniture, sir. H limited how much, sir? Any balance is there in H limited? Furniture. Furniture, Nana. Furniture is there now 1 lakh 50. 1 lakh 50 furniture. In S limited originally how much? 20. But we have decreased it 5. So therefore it is 15. So 1 lakh 50, 15 minus depreciation. 15,000 into 15%, 2,250. Because depreciation you need to provide on revalued amount. So we provided. Anyway, revaluation happened at the beginning of the year. Now you tell me here, if I make the proper total, 3 lakhs, 1 lakh 50 minus 15. 4 lakhs 35 is the machinery. One minute, sir. Actually, H limited outer column you take 3 lakhs. Okay. Now subsidiary company 1 lakh 50 minus 15, 1 lakh 35. So this is the machinery total. So 3 lakhs, 1 lakh 35, 4 lakh 35. Similarly, furniture. Parent company 1 lakh 50, take in the outer column. Subsidiary company 20,000 book value, sir, 5,000 decrease, 15,000. On that 15% depreciation, 12,750. So it will be 1 lakh 50 plus 12,750. 62,750. So I think this is plant and machinery, sir. You add both 4 lakh 35 plus 162,750. 597 750. So 597 750. Intangible assets, what we had? Goodwill. How much we got goodwill? Step number 6, 12,000. Take it. And next, other non-current investments. Other non-current investments, 4 lakh 40, 1 lakh 50. Correct? 4 lakh 40 H Limited, 1 lakh 50 S Limited. Total 6 lakhs 90,000. That's it. 5 lakhs 90. Yeah? So 5 lakhs 90,000. So 5 lakhs 90, sir. You take 5 lakh 90,000. Total 11 lakhs 99,750. So balance sheet is quite easy, sir. Just you need to make the proper adjustments. The only new points here is minority interest, property, plant, equipment, because revaluation happened. Na? Hello. So you understood property, plant, equipment, how they presented machinery, furniture, or else simply you can present like this. Simple. See this. First machinery you take. What is the parent company machinery balance? 3 lakhs. In the subsidiary company machinery, what is the revalued amount? 1 lakh 50. In the beginning, if I provide 10% depreciation, 15,000. Therefore 3 lakhs plus 1 lakh 35. 4 lakhs 35. That's it. Directly you can take this. In the furniture, what is the parent company share? 1 lakh 50. What is the subsidiary company furniture? 20, but they reduced it to 15. Correct? And on this 15,000, 15% depreciation if I provide, it will be 2250. So therefore, how much is 1 lakh 65 minus 2250? 1 lakh 67. So not 162. That's it. You add both. How much we got this? 597 750. Same thing. See here. 597 750. So this way also you can simply present like this. Simply our parent company asset, subsidiary revalued amount minus depreciation. You will get the total carrying amount of the assets. So this will come in consolidated balance sheet. 597 750. So in this question you see this important point is what? Analysis. You understand this analysis? This is important thing. So once you understand the analysis, remaining is very easy. Okay, that's it. This is, what is the illustration number? So illustration 13 we have discussed it. Illustration 1, sir. Okay, see this illustration number 1, sir. From the following data, determine in each case, sir. I think there are 4 cases given in the question, sir. In each case they are asking us to determine minority interest at the date of acquisition, at the date of consolidation. So minority shareholders share in the net assets of subsidiary company on the date of acquisition, on the date of consolidation. Goodwill or capital reserve. Sir, why goodwill or capital reserve on the date of acquisition, on the date of consolidation not asked? Just goodwill or capital reserve? Yes, because cost of control is calculated only on the date of acquisition. By using the information on the date of acquisition, it will not change that goodwill or capital reserve. But minority interest, minority shareholders share in the net assets will change. Date of acquisition, date of consolidation. Because during their company earns some profits, obviously net assets will increase. Therefore, minority shareholders share will also increase. Next, third bit. So, in this question, minority interest means step number 5. Goodwill or capital reserve means step 6. Next, amount of holding company profit in consolidated balance sheet. Assuming holding company own P&L account be 2 lakhs in each case. Can you tell me what is this step they are asking? Step 3, I mean this one, third requirement. 8th, reserves for consolidated balance sheet. Understand, sir? Say they are asking amount of holding company profit. Holding company profit means parent company profit. Where? In the consolidated balance sheet. In the consolidated balance sheet, how much reserve you are showing? Assuming holding company own P&L account be how much? 2 lakhs in each case. So that means all I told you in step number 8. First we will start with the parent company reserves now. So each case parent company reserves assume 2 lakhs. Now that parent company reserves we will add back the parent company share in the post acquisition profits of the subsidiary company. So they are asking 3 things, sir. Actually this one is step number 8. Now if I calculate for each case, see this, there are 5 cases they have given. See this. Case 1, subsidiary company A, percentage of shares owned 90, cost 1,40,000, date of acquisition at the beginning 1/1/2011, share capital P&L account given, that means net assets given, share capital plus reserves and surplus is net assets, consolidation date at the end, share capital P&L account given. Therefore in each case what we need to find out? Minority interest. Now in this case very simple, sir. If I start calculating the minority interest, illustration 1, so how many cases? 4 cases. So case 1, see in case 1 2 times we need to find out minority interest, 2 points of time. One is date of acquisition, second date of consolidation. So in the first case what will be the minority interest? 10%, because 90% held by parent. See this, first case 90% held by parent, sir. That means 10% is a minority interest. So on the date of acquisition in the subsidiary company, you see the net assets on the date of acquisition 1 lakh plus 50,000. 1,50,000 is the net assets, correct? So 1,50,000 into 10%, 15,000 is the minority interest on the date of acquisition for the first case. Hello, on the date of acquisition, see on the January 1st they have given clearly the share capital reserves and surplus 1,50,000. Both you add 1,50,000. Assets minus liabilities or share capital plus reserves and surplus, both are net assets only na. In the net assets, what is the minority share? 10%. So 1,50,000 into 10%. How much? 15,000. Now same manner calculate on the date of consolidation 1,70,000 into 10%. Correct? 17,000. So this is very easy. So case 1 done. Now come to case 2. What is the minority interest here? The parent company is having 85. So minority interest is 15. You tell me now. So on the date of acquisition 1,30,000. Correct? 1,30,000 into 15%. 19,500. Okay. On the date of consolidation, see this. On the date of consolidation 1,20,000. Correct? So 1,20,000 into 15%. 18,000. Now come to case 3. What is the minority interest? Parent company is having 80. So remaining minority interest 20%. Correct? 20% share in the net assets. In the beginning there is 70,000 net assets. 70,000 into 20%. 14,000. At the end same, there is no change. 70 into 20, 14,000. So minority interest at the beginning, at the end. Now come to case 4. Minority interest 0, sir. So there is no minority interest in this case. So minority interest is nil. Because in 4th case 100% shares are held by parent only. So therefore there is no minority interest. So first step we have done. You understood? Very simple. Next, goodwill or capital reserve, each case. So we need to calculate cost of control. So in cost of control, sir, there are 4 cases. So case 1, 2, 3, 4. Now first tell me what is the cost of investment. So cost of investment, first case you see 1,40,000. Given 1,40,000 is the cost of investment, right? And this we will compare with what? Parent company share in the net assets of subsidiary company. So on the date of acquisition, what is the net assets? 1,50,000. 1,50,000 into 90%. How much? 1,35,000. So therefore 5,000 is what? Goodwill. Goodwill. Come to case 2. What is the cost of investment? 1,04,000. Correct? 1,04,000. Now what is the parent company share in the net assets of subsidiary on the date of acquisition? 1,30,000 into 85%. 1,10,500. So how much is the balance? 6,500 negative. So this indicates capital reserve. Come to case number 3. What is the cost of investment? 56,000. Correct? 56,000 is the cost of investment minus parent company share in the subsidiary on the date of acquisition. On the date of acquisition 70,000 is there. Correct? 70,000 into 80%. 56,000. So cost of investment is share in net assets, both are same. So net assets into parent company share. So 56, no goodwill, no capital reserve. Come to the last case. What is the cost of investment? 1 lakh. Correct? And on the date of acquisition, what is the subsidiary company net assets? 90,000. 90,000 into 100%. 90,000. So therefore here 100% held by us only, parent only. Therefore 10,000 is what? Goodwill. Goodwill will come. Very simple now. We have calculated how to calculate cost of control, but in examination you have to present it properly. See look at the solution, how they have done it in the examination. See, they have done like this. If you want to present like this, you can present it. Or if you want to present like this also, it is allowed. Case 1, case 2, case 3, case 4. Cost of control less parent company share in the net assets of subsidiary company represented by share capital plus reserves and surplus. On that 80% you take. I mean, depending on the percentage you take. So remaining balance will be either goodwill or capital reserve. Now last one more thing they are asking, sir, that is reserves for consolidated balance sheet they are asking now. So case 1, 2, case 3, case 4. Now first always we start with parent company reserves. Correct? Parent balance. Parent company balance, they said in each case 2 lakhs. Take 2 lakhs. Each case 2 lakhs. Now tell me to this what you are going to add. Parent company share in the post acquisition profits of subsidiary. So in this case we need to add to the reserves parent company share in post acquisition profits of subsidiary. Post acquisition profits of subsidiary. Okay, very simple, sir. Sir, if I do the analysis, what happens you see? Come to case 1 first. Case 1, what is the opening profit? 50. See this, opening 50, closing 70. That means 20,000 is what? Current year profit, post acquisition profit. In that 20,000, 90% belongs to parent. So how much? 18,000 we will add. So it will be 2,18,000. Because we said parent company share in the post acquisition profits of subsidiary. So parent company share in the post acquisition profits of the subsidiary is 18,000. Now come to case 2. Case 2. So what is the opening P&L? 30. Closing 20. So profit decreased, not increased. So 10,000 decrease. Correct? That means current year there is a loss. So 10,000 into 85%. 8,500 loss. So minus 8,500 here. Sir, when there is a profit you are adding na. So similarly when there is a loss you deduct. So 1,91,500. This is the resource for consolidated balance sheet. Now come to case 3, sir. In case 3 if you observe, sir, What is the opening P&L account, sir? 20. Closing also 20. That means there is no current year profit, there is no post acquisition profit. So nothing to be added, nil. So therefore, here 2 lakhs we need to take. Because current year there is no profit, there is no post acquisition profits. So therefore, we will not consider anything. Come to case number 4, sir. Case number 4, what is the opening P&L? 40, closing 55. How much increase? 15. What is our share? 100%. Therefore, 15,000 entire 15,000 is the parent company share in the post acquisition profits of subsidiary. So add back 2,15,000. 2,15,000. Tell me, have you understood? Sir, reserves for consolidate, take parent company reserves. For that, you need to add parent company share in the post acquisition profits of subsidiary. Post acquisition profits means the profits which is earned by the subsidiary after you acquire. See here in this case, the date of acquisition is January 1st, 2011. Therefore, at the end, compare the profits. Suppose opening profit 50 in the first case, closing 70. That means 20,000 profit. In that 20,000 as a parent company, your share will be added to the consolidated reserves. In case number 2, opening 30, closing 20. That means current year there is a loss. In that loss as a parent company, your share 85%. So 7,500, I think how much? 8,500 will deducted. Similarly, case 3, you see opening 50, closing also opening 20, closing also 20. That means there is no current year profit. That means there is no post acquisition profits. So we cannot add anything. So therefore, case number 4, you see opening 40,000, closing 15,000, 55,000. How much increase? 15,000. This 15,000 entirely belongs to parent only, now post acquisition profit. So add back to the consolidated reserves. So that's it. So they got the answers. Say this. So on the consolidated date, what is the P&L account balance? So what is the amount to be added? First case, how much we added? 18. Second, minus 8,500 nil 15,000. Correct only, na? See this. 18,000, 8,500 minus nil 15,000. So we got the consolidated reserves also. Sir, tell me, have you understood? That's it. And sir, I think similar to this question, there is one case scenario based question is there, sir. I think scenario based question, one question is there. 7, 8, 9, 8th, 8th. Similar. So please do that as a practice. Okay. Scenario based question 8. Similar to this. Just for practice. I think you understand this now. Very easy. That's it. This is illustration 1. Okay. So let us. Illustration number 2, sir. Illustration 1 completed. Come to illustration number 2. Illustration number 2, sir. Illustration number 2. XYZ Limited purchased 80% shares of ABC Limited on January 1st, 2011 for 1,40,000. See the question. XYZ Limited purchased 80% shares of ABC Limited. What is the date of acquisition? 1st January 2011. For how much? 1,40,000. The issued capital of ABC Limited on 1st January 2011 was 1 lakh and the balance in P&L account was 60,000. That means on the date of acquisition in the subsidiary company, share capital 1 lakh is there, P&L account 60,000 is there. That means total 1,60,000. Okay. So cost of investment 1,40,000. Parent company share in the net assets of subsidiary company 1,60,000 into 80%. Then you will get cost of control. Correct? Hello? Can you help me here? 80% of 1,60,000. 1,28,000. So on the date of acquisition, your cost of investment is 1,40,000, sir. and your share in the net assets 1,28,000. So I think goodwill will come. How much is the goodwill, sir? 12,000. That's it. But provided there is no other effect. But in this question there is one effect is there. See it carefully. Next, what they have given. During the year ended 31st December 2011, during the year, ABC Limited earned a profit of 20,000 and at the year end declared and paid a dividend of 15,000. Sir, in the current year, the company earned a profit of 20,000, sir. And they paid a dividend of 15,000. Okay. Show by entry how the dividend should be recorded in the books of XYZ Limited. How XYZ Limited will record this dividend entry? First thing. Second thing, what is the amount of minority interest as on 1st January 2011, 31st December 2011? So, on the date of acquisition at the end, what is the minority interest? Also, please check whether there should be any goodwill or capital reserve at the date of acquisition. So, at the date of acquisition, what will be the goodwill or capital reserve? Goodwill or capital reserve. So, they are asking us to calculate the goodwill or capital reserve and also minority interest. Okay. And how entry for dividend will be recorded. These are the things they are asking. So, can you first tell me what will be the minority interest? Minority interest, you try and tell me the answer. Minority interest in this case. Minority interest. Illustration 2. Minority interest. How much? 32,000 minority interest. When? On the date of acquisition, 32. Date of consolidation? Date of consolidation? Sir, in this question, you have to be very careful, sir. So, see this. Illustration number 2. Sir, tell me what is the date of acquisition? 1/1/2011, sir. What is the shareholding pattern on the date of consolidation? So, which company is the parent, sir? ABC. They are having, who is the parent? XYZ Limited. Okay. XYZ Limited is having 80%. Minority interest 20%. See this. Total 100%. Now, very important thing is analysis of profits of subsidiary company. Subsidiary company is ABC Limited. Now, in the ABC Limited, at the end of the year, that is on 31st December 2011, P&L account balance, how much is there? P&L account balance. Closing balance we don't know, correct? But we know the breakup. See this. What is the opening balance? That is on January 1st, 2010, date of acquisition. P&L account balance in ABC Limited is 60. And all the 60,000 is pre-acquisition profit. And this is capital profit. Correct? Because XYZ acquired ABC Limited on 1/1/2010. So, in the question clearly said, this one, see this. Date of acquisition is this. On the date of acquisition, the profit, the P&L account balance is, P&L account balance was 60,000. So we take 60 opening. So what is the current year profit? They have given in the year 10-11, what is the profit of subsidiary company? See this. ABC earned a profit of 20,000 during the year. So 20,000 is the current year profit, right? But important, sir, this is current year profit. But company, see this, at the year end, they have declared and paid a dividend of 15,000. Subsidiary company paid the dividend. But actually from which profit dividend is paid? Whether company used opening 60,000 or current year profits 20. So they have not mentioned anything. During the year ending, ABC earned 20 and at the end declared and paid a dividend of 15. So therefore here the assumption, if I take an assumption that this dividend is paid from current year profit, that is post acquisition profit. So dividend will be deducted now. To that extent my profits will reduce. So what is the balance? 5,000 only. This is post acquisition profits. And these are which profits? Revenue profits. So this kind of analysis is required, sir, first. Suppose, sir, if the dividend is given from pre-acquisition profits, then we need to reduce 60,000 minus 15. So accordingly, yes. And pre-acquisition dividend is adjusted to cost of investment. But in this question, sir, generally current year we earned a profit of 20 and they declare a paid a dividend. So therefore here the general presumption is they given a dividend from current year profits. So therefore I reduce it from the current year profits. Now the balance profit is 5,000. This is revenue profit. So I have done the analysis. Once I done the analysis, I want apportionment. Of course, in this problem I don't want entire consolidation. So apportionment, if I do, pre-acquisition profits, post-acquisition profits, and we have only P&L account. In P&L account, how much is P? 60. Just we analyze it, 60. It's a capital profit. Post-acquisition profit is a revenue profit, right? In that 5,000. So therefore, the entire profits of subsidiary company was analyzed between pre and post. Understand they have given a dividend. You should not forget that. Because of the dividend, the profits was decreased. Now you apportion between parent. Parent is ABC, correct? AB now. Which company is the parent? XYZ. Okay. So XYZ Limited, how much shares they had? 80. So can you tell me? Minority interest 20%. 60,000 into 80%. 48,000. Next 12,000. This one 4,000. And you know the treatment. Parent company share in the pre-acquisition profits. What we need to do? Adjust it to the cost of investment. Correct? Parent company. And then parent company share in the post-acquisition profits we will add to the consolidated reserves. Minority interest will be added to minority interest. But that much is not required here. Just we done the analysis. Now tell me what they are asking. First minority interest and then cost of control they are asking. So if I calculate minority interest in this case, very simple. 20% minority interest in the subsidiary company share. What is the share capital of subsidiary company? What is the subsidiary company share capital? So 2 point of time I need to find out. Date of acquisition, date of consolidation. Correct? 1/1/2010, 31st December 2010. 2 points of time I need to find out. So the share capital is 1 lakh. In that 20%, it will not change. Share capital remains same. So 20,000, 20,000. And what is the share of the minority shareholders in the capital profits? Step number 4. 12,000. Hello. This 12,000 is pre. See this. This is on the date of acquisition. So I add 12,000. 12,000. And in the revenue profits, step number 4, minority share, nil. This is 1,000. Okay. So total 32,000, 33,000. Simple, sir. Minority interest, minority shareholders share in the subsidiary company net assets. So in the subsidiary company, what are your net assets? Share capital plus we analyzed and we have taken it. You understand minority interest? Hello. Sir, this 1,000 is which profit, sir? Post acquisition, correct? Therefore, it is considered for the date of consolidation, not on the date of acquisition. Okay. One more calculation they are asking. Cost of control. I mean, goodwill or capital reserve comes only by cost of control. So can you help me out how to calculate cost of control in this case? Cost of investment. What is the cost of investment? And you know, cost of control is calculated only on the date of acquisition. Less share in net assets of subsidiary company, which company? ABC Limited. Represented by share capital. What is the share capital of ABC Limited on the date of acquisition? Given 1 lakh. Issued share capital 1 lakh. Only share capital 1 lakh, right? So 1 lakh into 80%, 80,000. And then capital profits, parent company share. Right? Nothing but capital profit means pre-acquisition profit on the date of acquisition. Right? How much? 60. In that my share 48. Computed already. 48. Total 128. So 12,000 is what? Goodwill. So goodwill is 12,000. 12,000 goodwill. Sir, are you understanding? Simple, sir. Nothing great here. Now one more thing they are asking, sir. Dividend entry. Dividend entry. Can you tell me what is the entry for dividend by parent company? I told you, whenever dividend given by subsidiary company, you need to see from which profits dividend is given. If dividend is given from pre-acquisition profits, adjusted to cost of investment. If dividend given from post-acquisition profit, it is credited to P&L account. Therefore, in this case, dividend is given from which profits? Post-acquisition profits. So, therefore, it is credited to P&L account. So, therefore, the entry is bank to P&L. Bank to P&L account. How much dividend? Can you tell me? 15,000 is the total dividend, sir. In that parent company share 80%. Therefore, 12,000 is the dividend. Correct? Now, in this case, sir, because dividend is given from post-acquisition profits, we created to P&L. If dividend is given from pre-acquisition profits, then bank to investment account will be created. Sir, this point is not a new point, sir. In theory discussion, I told whenever subsidiary company gives a dividend, you need to see from which sources they have given the dividend. Is dividend is given from pre na posta? If they are given from pre-acquisition, then we adjust to cost of investment. If dividend is given from post-acquisition profit, P&L account. So in this case, since dividend is given from post-acquisition profit, we created to P&L account. That's it, sir. So these are the answers. Look at the answers, what they have got. First entry, you see what they have written. This is the entry for dividend. Bank to P&L. Correct? Why they have created to P&L? Because dividend is given from which profits? Post acquisition. Next, goodwill at the time of acquisition. How much they got? 12,000. We also got 12. Minority interest at the beginning? 32. At the end? 33. So same answers we got na? Minority interest 32, 33. So, but this analysis is very, very important, sir. Analysis. Whenever you got a doubt, you analyze like this. P&L account, opening balance 60, current year 20. From that, they have given dividend 15,000. So 5,000 is the post-acquisition profit. So pre-acquisition profit 60, post-acquisition profit 5,000. So if I apportion, I know. So in this, parent company share in the pre-acquisition profits 48,000. I will adjust to cost of investment. Adjust it. Parent company share in the post-acquisition profit, I will take to consolidated reserves. Here that step is not required. Minority interest, I will add to minority shareholders. Right? So 12,000, 1,000. Because this is analysis of the profits at the end. That's why 12 plus 1. If you want analysis on the date of acquisition, only 12. Because this 1,000 is belongs to current year post-acquisition profits. Hello? That's it. This is problem number 2. Illustration 2, sir. Sir, similar to this illustration, I think one question is there, sir. Share case scenario based question, I think 7 or 9, you see once 7 or 9, one question is there. Exactly similar. One question is there. Same, they are asking goodwill, capital reserve, minority interest. Scenario based question, sir. First question, I think 7th. Scenario based question. 6th. 6th. So question 6 same, you practice that sum. Same question, nothing great. Exactly similar. Okay. Illustration 3, sir. Illustration 3. See this type of questions, illustration number 3, they may ask for 5 marks. Okay. Very good question actually this is. See this question. Okay. Come to illustration number 3. EXE Limited acquires 70% equity shares of Z Limited. Right? So parent, subsidiary. EXE Limited acquires 70% of Z Limited as on 31st March 2011 at a cost of 70 lakhs. So cost of investment 70. Following information is available from the balance sheet of Z Limited as on 31st March 2011. So subsidiary company information given, sir, as on 31st March 2011. That means date of acquisition 31st March 2011. On the same day in the subsidiary company, details given. What? Rupees in lakhs. Property, plant, equipment 120. Investments 55. Current assets 70. Loans and advances 15. And debentures 90. Current liabilities 50. These are the details they have given, sir. Okay. Next, the following revaluations have been agreed upon, not included in the above figures. Sir, in the subsidiary company assets, following revaluations have been accepted. I told you, no, sir, whenever parent is acquiring subsidiary, sometimes subsidiary company assets will be revalued. Here the following revaluations have been agreed, not included in the above figures. Now we need to adjust. Property, plant, equipment up by 20%. Investments down by 10%. Okay. Next. Z Limited, that means subsidiary company, declared and paid dividend at 20% on its equity shares on 31st March 2011. Sir, subsidiary company declared dividend at 20% on equity shares on 31st March 2011. That means it is which dividend, sir? Pre-acquisition dividend. Because exactly on that date you are acquiring subsidiary. So definitely on the date of acquisition, if the subsidiary company is giving dividend, which profit they will use? Pre-acquisition profits. Therefore here whatever the dividends parent company is going to receive is a pre-acquisition dividend. If it is a pre-acquisition dividend, we will adjust to cost of investment. So that's the important point here. Next, X Limited, that is parent company, purchased the shares of Z Limited at 20 per share. So 70 lakhs is the cost of investment. Share price 20 rupees. So can you tell me the number of shares? Number of equity shares purchased by parent company 70 lakhs divided by 20 per share. So 3,50,000 shares purchased by parent company. Correct? Next, what they are asking finally, you see, calculate the goodwill or capital reserve on acquisition of shares of Z Limited. That means which step they are asking? Sixth step, goodwill or capital reserve on the date of acquisition. On the date of acquisition, they are asking goodwill or capital reserve. That means cost of control they are asking. So how to calculate cost of control, sir? First, cost of investment minus any pre-acquisition dividend received. We need to compare with parent company share in the net assets of subsidiary company. Generally, net assets, how we are going to arrive? Share capital plus reserves and surplus. But in this case, here net assets arrived by assets minus liabilities. Because share capital and reserves and surplus not given. That's why net assets can be arrived either share capital plus reserves and surplus on the date of acquisition or assets minus liabilities. In this case, if you see subsidiary company assets and liabilities given. Therefore, you find out the net assets of subsidiary company. In the parent company share is 70%. Compare with the cost of investment. The difference is goodwill or capital reserve. The difference is goodwill or capital reserve. Sir, important sir. Always in your mind, sir, whenever in the exam they have asked a question relating to the goodwill or capital reserve calculation, sir, first remember the format, what things we need to compare. So, see this. Illustration number 3, okay, illustration 3, sir. Illustration number 3. So, what we are going to calculate here, calculation of goodwill or capital reserve. Any one will come, correct? Calculation of goodwill or capital reserve. Now, always first you need to take cost of investment. Cost of investments. And you need to reduce any pre-acquisition dividend received. Any pre-acquisition dividend came, you should deduct it. Then you will get what? Adjusted cost of investment. And this we need to compare with what? Yes, share in net assets of subsidiary. Subsidiary company here is Z Limited. Okay. On the date of acquisition, sir, you should not forget it. On the date of acquisition. So the difference is this. For example, cost of investment one amount. Compare with share in net assets of Z Limited. So the difference is goodwill or capital reserve. Okay. Now you tell me what is cost of investment. Suppose I am considering amount rupees in lakhs. Amount rupees in lakhs, 70 lakhs. And I need to reduce pre-acquisition dividend. Sir, how you know there is a pre-acquisition dividend? It is given in the question, sir. See this. You acquired subsidiary on which date? 31st March 2011. On the same date, your subsidiary has given a dividend. Obviously, from which profits? Pre-acquisition profits. So, by the time you are acquiring subsidiary, whatever the profits are there in the subsidiary, they are pre-acquisition profits. Na? On the same day, if the subsidiary company gives a dividend, that's a pre-acquisition dividend. Now, you need to reduce. I told you, when subsidiary company gives dividend from pre-acquisition profits, we need to adjust to cost of investment. Correct? So, therefore, I need to reduce pre-acquisition dividend. Can you calculate and tell me what will be the pre-acquisition dividend? So, working note 1, I will do. So, pre-acquisition dividend. Pre-acquisition dividend. First, sir, in this case, number of equity shares acquired by EXC Limited, that is parent company. How to get it? 70 lakhs is the cost of investment. Each share is purchased at 20. So 70 lakhs divided by 20. 3,50,000 shares we have purchased, sir. Now subsidiary company gives a dividend of how much, sir? 20% on its equity shares. Face value 10 per share. So therefore, dividend of XC Limited is equal to XC Limited has 3,50,000 shares. Each share 10 rupees into 20%. So how much? 7 lakhs. So 7 lakhs is the dividend. So important, sir. How to find out dividend? You think carefully, sir. You see carefully. Because in the question they said 20% dividend company will give on 10 rupees. And you should know how many number of shares you should have. So they have given cost of investment, purchase price. If you read the question carefully. So cost of investment minus purchase price, you will get number of shares to be purchased. Number of shares purchased into face value into 20%. So 7 lakhs is the dividend. So therefore first always reduce the pre-acquisition dividend. So what will be the adjusted cost of investment? 63. Correct? Now I need to find out what is the share in the net assets of Z Limited on the date of acquisition. Sorry, as a parent company, on the date of acquisition of subsidiary company, what will be my share in the net assets? And this share in the net assets, if I worked out this in working note 2, generally, how share in net assets will be ascertained till now? Till now, the problems we solved. Share capital plus reserves and surplus. But in this question, share capital, reserves and surplus, we know no? No. But on the date of acquisition, we know the assets and liabilities. So take assets and liabilities. So therefore, particulars amount, rupees in lakhs. Rupees in lakhs. So take one by one asset first. So you need to understand, sir, here PP first. Property, plant, equipment. But sir, if there is any revaluation, we need to take the revalued figures. Book value 120, sir. But they said PP was up by how much? 20%. So therefore, 120 into plus 20%. How much, sir? 144. And next asset, sir, investments. Investments, sir. So investments are down by 10%. What is the investment? 55. Down by 10%. So 55 minus 10. 49.5. And come to current assets. Current assets no change, correct na? How much? 70 current assets. Loans and advances, asset or liability? Loans and advances, asset, correct na? So loans and advances, how much? 15. So total assets, tell me. 278.5. From this you reduce the liabilities of the subsidiary on the date of acquisition. What will be the liabilities? Debentures. Any change? No. What will be debentures amount? 90. And also we have current liabilities. How much? 50. Reduce it. So 278.5 minus 90 minus 50. See, this is the total net assets of subsidiary. In that my share. So share of parent company XC Limited. What is my share? 70%, sir. 70. So 138.5 into 70%. 96.95. This is the parent company share in the subsidiary on the date of acquisition. So this you compare with the adjusted cost of investment, 96.95. You see, your adjusted cost of investment is 63. 63. And your share in the net assets is 96.95. So therefore it is a profit. Which profit? Capital reserve. Correct? So what will be the capital reserve? 33.95. So in this problem, where there is a chance that student may do wrong, first chance is pre-acquisition dividend. Either they forgot it or they don't know how to calculate pre-acquisition dividend. Very simple. In this problem, first ascertain the number of shares into face value into dividend percentage. You will get pre-acquisition dividend. Always remember, pre-acquisition dividend is deducted from the cost of investment. Second, net assets calculation. When you are doing net assets calculation, consider the revalued figures. Consider the revalued figures. Whenever subsidiary company revalued figures given, please take the revalued figures for calculation of net assets. And remember, once you calculate the net assets, if you don't apply your share, then also it will be wrong. We need to compare your cost of investment with your share in the net assets of subsidiary on the date of acquisition. Your share is only 70%, right? So 138.5 into 70%. So this is the good sum, sir. These type of questions they are asking in the examination. So how much answer they got, sir? 33.95. How much we same? Yes, 33.95. So cost of investments, $63. Directly there. See, you follow my model. Very simple. This will be the systematic way. Okay. So uniformity I am doing. Here also they solved it. 63 adjusted cost of investment. This one, and share in the net assets 138.5, 96.95. So they compared both. The difference is 33.95. So that's it. This is illustration number 3. Same question is there, I think, in scenario based question. So what is the same question? Can you tell me? Scenario based question 7. I think just amounts changed. If you want, you can see. If you want, you can practice that question. Okay. Scenario based question 7. Now next, examiner's favorite question. Whenever you want to test in consolidation chapter, definitely he wants to test you illustration 4. You see the old paper also, this question is there. So illustration number 4. Okay. Now what is this illustration 4 is all about? This is minority interest calculation. Okay. Listen this carefully. I am going to solve in an easiest manner. If you see the study material na, I will show you study material way of doing things. You see this. They have done like this. You see this, you will go mad. So, but see, if you understand the concept, I will explain the concept. It will be very easy for you. You follow me. See, first we will read the question. Okay, see this question carefully. Let us analyze this question carefully. In this question, one beautiful point is there from accounting standard 21. Definitely you are going to enjoy that point. See this. Illustration 4. A Limited acquired 70% of equity shares of B Limited, that means parent subsidiary, on 1/4/2011 at a cost of 10 lakhs. When B Limited had an equity share capital of 10 lakhs, reserves and surplus of 80,000. So A Limited acquired B Limited, sir, 70%, sir. When they have acquired, sir? 1/4/2011. And what is the cost of investment, sir? 10 lakhs. And on that day in the subsidiary company B Limited, how much is the equity share capital? 10 lakhs. Reserves and surplus 80. So you can easily find out cost of control. Hello? Easily we can find out cost of control. 56,000, because cost of investment 10 lakhs. Share capital 10, 80, 10 lakh 80. 10 lakh 80 into 70%. So cost of control. Nothing, no pre-acquisition dividend. So I think if you calculate the cost of control, how much came? Goodwill capital reserve. 10 lakh 80,000 into 70%, how much? So 10 lakhs minus 7 lakh 56. So 10 lakhs minus 7 lakh 56,000, 2 lakhs. So this is goodwill, sir. Okay, because they have asked a cost of control also in this question at the end of each year. Cost of control. Cost of control each year no need to calculate, because it is a one time. We will compare the cost of investment on the date of acquisition. That's it. It's a one time calculation. It will not change. So we got 2,44,000. Okay. But here the main point is not cost of control. Everybody will do this cost of control question. Not a big deal. Everybody will do mostly. Those who understand consolidation little bit, they will do. They will compare cost of investment with net assets. So balance it and the balancing figure. Now main thing is you see. So tell me, A Limited acquired B Limited on 1/4/2011. Okay. Next what happened? You see. Very interesting. In the 4 consecutive years, B Limited fared badly and suffered losses of 2.5 lakhs, 4 lakhs, 5 lakhs, 1 lakh 20 respectively. Sir, you invested on 1/4/2011. Okay. So you invested 1/4/2011. So 11/12, 12/13, 13/14, 14/15. Next 4 years losses in the subsidiary company. So your leg, iron leg. So you invested 1/4/2011, 4 years losses in the subsidiary. Okay, no problem, sir. Thereafter, what happened? In 15-16, B Limited expected turnaround and registered an annual profit of 50,000. After 4 years, 50,000 profit. Okay. In the next 2 years, 16-17, 17-18, B Limited recorded annual profit of 1 lakh, 1 lakh 50 respectively. That means once 4 years is over, immediately after that 50,000 profit. Next 2 years, 2016-17, they recorded an annual profit of 1 lakh, 1 lakh 50 respectively. Okay. Now what they are asking? Show the minority interest and the cost of control at the end of each year for the purpose of consolidation. Cost of control, will you calculate at the end of each year? No. Because in cost of control, generally we will compare cost of investment with the net assets on the date of acquisition. So over. But every time what you need to calculate? Minority interest. That means you need to calculate minority interest at the end of 31st March 2012, first year end, 31st March 2013, 31st March 2014, 31st March 2015, 16, 17, 18. Because they have given data from C. You invested on 1/4/2011. They have given till 31st March 2018. So in this question, sir, see this. What is the illustration number? 4. So in this question, if you understand the journey properly here, 1/4/2011 you invested, right? So 2011. Next 31st March 2012, first year loss. Next 31st March 2013, again loss. Next 31st March 2014, again loss. Next 31st March 2015, loss. Next 31st March 2016, profit. First 4 years losses, sir. Next we got a profit, correct? Next 31st March 2017, profit we got. Next 31st March 2018, profit. That means if you observe, sir, 11-12, 12-13, 13-14, 14-15, these 4 years losses. 15-16, 16-17, 17-18 profits. Sir, which company, sir? These are all belongs to which company? Subsidiary. 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 Okay, subsidiary. Now they are asking us to calculate minority interest at the end of each year. 31st March 2012, 13, 14, 15, 16, 17, 18. We need to calculate minority interest at the end of each year. Generally, how will you calculate minority interest? Simple. In the subsidiary company, whatever be the net assets is there, in that minority interest share. In the subsidiary company, net assets means share capital plus reserves and surplus. Share capital into minority interest. Reserves and surplus into minority interest. Correct? And interesting point, listen to me carefully. Minority interest in the consolidated balance sheet, where you will show? We have solved consolidated balance sheet questions, na? Equity and liabilities. And first we will show shareholders funds. Correct? After that, second item is minority interest. In shareholders funds, share capital, reserves and surplus, sub items. I am talking about main items. shareholders funds, and then minority interest. That means minority interest where you are showing? Equity and liabilities. So when you are showing an item in equity and liability side, which balance it is? This minority interest is having which balance? Debit or credit? Credit balance, yeah. When you show something on the equity and liability side, how can it show debit balance? So minority interest generally which balance? Credit balance. So minority interest showing credit balance indicates what? Minority interest indicating credit balance indicates what? Simple. In the subsidiary company, suppose, listen to me carefully. In the subsidiary company, 100 rupees net assets is there. But in the consolidation, I will incorporate 100. Total assets minus liabilities. In the parent company, consolidated financial statement, we will incorporate total assets of subsidiary. Suppose parent company is having only 80%, but still we incorporate 100%. That's why we know that in this net assets, along with us, there is minority shareholders who is having how much? 20%. So this 20% also we will calculate and we will show. It's not a liability, kind of a liability. That means in the subsidiary company net assets, if I incorporate 100 rupees in my books, but in this 100, legally speaking, 20% belongs to minority shareholders, others. So that I am showing in my books. As if this 20% is I need to pay to the minority interest, but actually it is not a liability. Now the question is, if the minority interest balance becomes debit, then first of all, when minority interest balance will become debit? When the net assets of the subsidiary company become negative. When the subsidiary company losses is more, obviously net assets in place, we will get net losses. Sir, share capital plus reserves and surplus, sir. If your reserves and surplus are becoming negative, obviously instead of net assets you have what, sir? Net losses. I mean your overall position will be in losses, right? Now when there are losses, in that losses also minority shareholder share will be there, na? Hello? See, in the net assets of subsidiary company, you are consolidating 100%. And in this net asset, certain portion belongs to other shareholders that you are calculating. But imagine if the subsidiary company is having losses. In that losses also, minority shareholders is responsible, certain portion they need to take, na? So, in that situation, can minority interest will show negative balance in the balance sheet? Negative balance in the sense debit balance, because generally minority interest we are showing in the balance sheet 50,000 we are showing. Suppose it becomes minus 1 lakh. Can we show minus 1 lakh? No. Understand logically. So first understand, sir, you are not understanding the question properly. Once you understand the question properly, answers will come. So what I am asking is, minority interest is always credit balance, but if it becomes a debit balance, AS 21 says once minority interest is becoming negative, debit balance, if the credit balance has become 0, next is they went into debit balance, then that loss has to be adjusted to the parent company reserves. And when again subsidiary company started earning profits, whatever the losses of the minority shareholders adjusted to the reserves of the parent, we will set off. So therefore minority interest at any time cannot show negative balance. Minority interest always should show credit balance. It cannot become debit. The moment it becomes debit, that means when subsidiary company started losses, started suffering losses, obviously minority shareholders balance will become negative, debit. But AS 21 says no, you cannot show minority interest debit balance. Why? What is the logic? If you show minority interest debit balance, it is kind of an asset you are showing. It's kind of a assets, right? Because I am incorporating all the losses of subsidiary, but along with me, you are also a shareholder. My share is only 80%, your share is 20%, but in the consolidation, I am considering total 100% losses. In that loss, 20% belongs to you. So I will show minority interest as an asset in my books. Not allowed. That's why minority interest asset side will come. Non-current assets, current assets. No. Like reserves and surplus, minority interest can show in as a negative balance? No. Because basically what is minority interest? In the subsidiary company, net assets, what is my share? What is minority shareholder's share? That minority shareholder's share cannot be negative. Either I will show credit balance, or if they become debit, I need to adjust against my reserves. And once the subsidiary company started earning profits, whatever the losses of the minority shareholders adjusted to the parent company reserves, again it will be set off. So that will be the main point in this question. Of course, see, having said this, I will solve this question. In the process of solving, you will understand it better, I think. We'll take numbers first. Okay, don't worry about it. Come on, see the question. Look at how I am doing this illustration 4. Don't worry. See, till the end you need to concentrate. You will understand by sure. Year, opening balance, okay, 30% share of profit or loss, total adjusted to minority interest, adjusted to, who is the parent company in this case? Name, tell me. A Limited reserves. Okay. Next, closing balance. Closing balance can be credit. It is credit balance which is carried in balance sheet. If it is a debit balance, adjusted A Limited reserves. Okay, see this. Okay, first tell me the year. What is the starting year? What is the starting year? 11, 12. Correct? 11, 12. Starting year. What is the opening balance? Opening balance means minority interest. See, we are calculating minority interest. Actually, in the question you see minority interest, how much can you tell me? 30%, because A Limited acquired 70. Minority interest is 30%. 30% minority interest. Right? In the opening net assets of the subsidiary company, opening net assets is share capital 10 lakh, surplus 80, 10 lakh 80. Correct? So in 10 lakh 80, 10.8, 30%. 3.24. So 3 lakhs 24,000 is the opening minority interest. Accepted? Hello? On the date of acquisition, opening balance 30% of 10.8 lakhs. This is 10.8 lakhs. Now come to year 11-12. In the year 11-12, what happened? You tell me. Subsidiary company loss. How much loss? 2,50,000 loss. Correct? 2,50,000 is the first year loss. 2,50,000. So in this loss, what is the minority shareholders share? 30%. 7,50,000 into 30%. How much? 75. See this. So 75,000 minority shareholders share, which is adjusted to minority interest. Minority interest already, how much balance is there? And current year there is a loss. So 3,24,000 minus 75. So 249,000. So this will be shown in balance sheet. Minority interest. First year, no problem. Hello. Very simple. Come to second year. 1213. What is the opening balance? Last year closing, current year opening. 2,49,000. Okay. Now you see the second year. 1213 profit or loss? Loss. How much? In that 30%. 1,20,000 loss belongs to minority interest. Correct? So total minus 1,20,000. Adjusted to minority interest minus 1,20,000. So 2,49,000 minus 1,20,000. How much? 1,29,000. So therefore in the second year balance sheet also, what is the minority interest? 1,29,000. Are you understanding? Now come to the next year, sir. 2013-14. Correct? Opening balance 1,29,000. Third year profit or loss? Loss. How much? 5 lakhs. Now important. Everybody please concentrate. In that 5 lakhs, 30% share, minority shareholders. How much? 1 lakh? See this. Total loss 1,50,000. In the subsidiary company, third year 1,50,000 loss, which is belongs to minority shareholders. They have to bear that loss. Correct? But what is the balance of the minority interest is there? 1,29,000 is there. That means see, 1,29,000 minus 1,50,000. Tell me what, how much amount will come? Minus 21 will come. That means minority interest will become negative. That means debit balance. Correct? Yes, 21 says no, we are not allowing this. Minority interest will be shown only positive, credit balance. Therefore, sir, then in the third year, subsidiary company suffered a loss. In that, as a minority interest, my share is 1,50,000. Now that means my opening balance 1,29,000 minus 1,50,000, it becomes minus 21. So AS 21 says this 21,000 loss is adjusted to parent company reserves. Therefore, see here, 1,29,000, which is the balance available, adjust minority interest. Balance 21 adjusted to A limited reserves. Look at this. What I have written? Adjusted to, see this, A limited reserves. Sir, this is the important point, sir. Third year subsidiary company loss minus 1. Third year subsidiary company losses, minority shareholders share is 1,50,000. And this loss, if I adjust against my balance 1,29,000, my balance will become negative 21. That cannot be happen. Therefore, this 21,000 I adjusted to which reserves? Parent company reserves. So therefore, at the end, can you tell me what will be the minority interest closing balance? Nil. And it is adjusted in which reserves? Parent company reserves. What will be the adjusted parent reserves? 21,000. 21,000 adjusted. Third year, what happened? You understanding? First 2 years, minority interest is there. How? Which balance? Credit balance. Third year, what happened? Minority interest loss beyond their credit balance. Therefore, minority interest is becoming negative, debit. Can it happen so? No. What we need to adjust? Parent company. So this 21,000 I adjusted to parent company. Later when subsidiary started earning profits, to the extent the reserves adjusted in the parent, we will take it. That means minority interest always will reflect at credit balance. Either 0 or credit. That's it. You cannot show it as debit. Because if you show debit balance, it is kind of an asset. It is not allowed so. That's it. Next. Come to 14-15, what happened? Tell me. Again loss. Already what will be opening balance? Nil. 14-15, what is the loss? 1,20,000. In that 1,20,000, what will be 30% share? 36,000. What you do this 36,000? Adjusted to parent company. And at the end, nil minority interest. Parent company adjusted reserves already 21, this 36. 57 is the adjusted reserves of parent. Next year, Sir, you understand 14, 15? 14, 15, there is a loss again. In that loss, minority shareholder share 36,000. So there is no balance in the minority interest. So 36,000 adjusted to parent company reserves. Therefore, the adjusted reserves of the parent is total 57,000. Okay, next 15, 16. Tell me 15, 16 what happened? Opening balance nil. 15, 16 what happened? Profit. Tell me how much is the profit? 50,000. In that minority shareholder share 30%. 15,000. Correct? Positive or negative? Positive 15,000. So this 15,000 we will adjust against A limited reserves. Already because of your losses, our reserves adjusted. How much adjusted? 57. Correct? Therefore, we will adjust to the extent of 15,000. Therefore, at the end, minority interest nil and adjusted reserves of the parent 57 minus 15. So 42,000 only balance reserves adjusted. That means subsidiary company earned profit na sir in the year 15-16. In that profit, minority shareholders share already adjusted the parent company reserves, because your losses we have adjusted 57,000. So when the profit is earned, your share we will adjust first. Next, come to next year 16-17. Opening balance nil. 16-17 what happened, you tell me? 1 lakh profit. In that 1 lakh 30,000. See this 30,000. Tell me what you do with this 30,000? Adjust to the resource of the parent company. Still 42,000 is there. Adjust 30,000. So minority interest closing balance nil. Still how much balance is there? Minus 42 plus 30. 12,000 is there. Minus. Correct? And come to the next year. 17-18. Right? Opening balance nil. What is the total loss? 1,50,000 profit. In that 30% share. 45,000. See this 45. Now you tell me what to do. This 45,000, still how much loss to be adjusted in the parent company? 12. Adjust it. Still how much is there? That will be transferred to minority interest. Balancing figure. See this. In the year 17-18, subsidiary company earned a profit. In that minority shareholder share is 45. First this 45,000 adjust against the parent company losses. Parent company, your losses adjusted to parent company resource, set off it. 12,000. Still remaining balance 33,000 credited to minority interest. Therefore, at the end, minority interest balance is 33,000. This one, nil. That's it. So, therefore, what they are asking? Calculate minority interest at the end of each year. So, what is your answer here? Tell me. Minority interest at the end of the first year? 2,49,000. Second year? Third year? Fourth year? Fifth? Sixth? Seventh? The answer. This is the answer you need to write. So what is the interesting point you have learned? Minority interest cannot be debit. It is either credit or zero. If at all subsidiary company earned losses, suffered losses, because of that losses, if the minority interest is becoming negative, don't show debit balance. Rather, that loss is adjusted against parent company reserves. When subsidiary later on earning the profits, set off. Okay, so this is the interest. You enjoyed this question? You understand why this question again and again they are asking now? Because of this point. Because most of the students doesn't know this point. They thought this is a simple problem, set off and carry forward of losses. No. So therefore, here I am writing one note point also. Note, minority interest cannot show debit balance. Debit balance, as it is irrecoverable. That means you cannot show debit balance, sir. Always credit balance or zero. Okay. Now in this question they have asked one more thing. What is it? First of all, sir, out of all the solution, this is the simplest way to solve this question. If you follow the study material pattern, if you feel that is easy, you follow, because you understood the concept now. I am not against that. If you want to follow that one, but this will be very easy for you, this table. Okay, only if you remember the headings properly, everything can be done. Now in this question, one more thing they are asking. What is it? Cost of control. Correct? How to calculate cost of control? Tell me. Cost of investment. What is the cost of investment? 10 lakhs. Take it 10 lakhs. Minus parent company share in the net assets of subsidiary company. Correct? Net assets of subsidiary company. Who is subsidiary? B Limited. On the date of acquisition. On the date of acquisition in B Limited, what is the share capital? 10 lakhs. So 10 lakhs into 70%. 7 lakhs. 7 lakhs. And also on the date pre-acquisition profits, that is capital profit. How much? 80,000. In that 80,000, 70%. 56,000. So total 7,56,000. Correct? So your cost of investment is 10 lakhs. Your share in the net assets on the date of acquisition 7,56,000. So you invested extra, that will be treated as goodwill. How much? 2,44,000. So tell me, Nana, any doubts? So whenever minority interest share is becoming debit, what you do? Adjust to parent company reserves. So this is the solution. Okay. So this is what you need to do. That's it. This is illustration number 4, sir. Illustration 5, sir. Sir, in order to solve this illustration, sir, only thing required is you need to read carefully. That's the only thing required. Okay. See this question. Variety Limited holds 46% of the paid up share capital of VR Limited. The shares were acquired at a market price of 17 per share. The balance of the shares of VR Limited are held by foreign collaborating company. So there is a company called VR Limited, sir. So illustration 5, I will analyze the question while reading itself. So there is a company called VR Limited. Now tell me, in this VR Limited, 46% held by whom? Variety. Remaining 54 held by foreign company. Okay, see this. The balance of the shares of VR Limited are held by foreign collaborating company. Okay, next. A memorandum of understanding has been entered into with the foreign company, providing for the following. Okay. The shares held by the foreign company will be sold to Variety Limited. See, this foreign company is having 54% in VR Limited. Now they want to sell this 54% to Variety Limited. Okay. Next. The price per share will be calculated by capitalizing the yield at 15%. Now at what price they will sell the shares? They will sell the price per share will be decided by capitalizing the yield at 15%. You need to find out the yield and it will be capitalized at 15%. Yield for this purpose would be 40% of the average of the pre-tax profit for the last 3 years. So last 3 years average of pre-tax profits you take. Last 3 years profits also given 30, 40, 65. Okay. You find out the average. And that you take 40%. Divided by 15%. You will get yield. Okay. Next. The actual cost of the shares to the foreign company was 5,40,000. The foreign company invested 54% in VR Limited, right? The actual cost of investment is 5,40,000. Okay. The profit that would accrue to them would be taxable at an average rate of 30%. Now since they are selling this 54% to Variety Limited, from this whatever the profit they are getting, that profit straight away how much tax will be levied? 30%. The tax payable will be deducted from the proceeds and Variety Limited will pay it to the government. TDS will be deducted by the Variety Limited and paid to the government, because Variety Limited only is purchasing the shares. So therefore when we pay the purchase consideration, so we will deduct the tax and we will pay to the government. out of the net consideration, 50% would be remitted to the foreign company immediately. Balance will be an unsecured loan repayable after 2 years. Sir, out of the total consideration, 50% we pay immediately. Remaining 50% we will treat it as an unsecured loan which is payable after 2 years. Okay. As if we have taken the loan from foreign collaborating company. The above agreement was approved by all concerned for giving effect on 1/4/2011. Everybody accepted this. The total assets of VR Limited as on 31st March 2011 was 1 crore. So the total assets of VR 1 crore, sir. It was decided to write down PPE by 1,75,000. Current liabilities of VR Limited on the same date was 20 lakhs. The paid up share capital of VR Limited was 20 lakhs divided into 2 lakhs equity shares of 10 each. So the total shares is 20 lakhs divided into 2 lakh shares of 10 each. Find out goodwill or capital reserve to Variety Limited on acquiring wholly the shares of VR Limited. See the bottom line, what they are asking. Find out goodwill or capital reserve. For what? On acquiring wholly the shares of VR Limited. Sir, this question not at all difficult. First of all, very easy question. In this question, what is happening is, see, there is a company called VR Limited. Okay? In this question, see, in the VR Limited, if you read the question carefully, see this. The paid up capital of VR Limited is 20 lakhs divided into 2 lakh equity shares of 10 each. So, in this VR Limited, 2 lakh shares are there. Given in the question, 2 lakh shares. This 2 lakh shares, 46% held by Variety Limited. That means 2 lakhs into 46%. Can you tell me how much? 2 lakhs into 46%? 92,000. That means foreign company is having how much? 2 lakhs into 54%. How much? 1,08,000. These are the shares held by foreign company. Now, this foreign company want to sell this 1,08,000 shares to Variety Limited. Already Variety Limited has how much? 46%. And their cost of investment is how much? See this. In the question clearly said, they have acquired, see this, 46% of the paid up capital. The shares were acquired at 17 per share. Correct? So that means their cost of investment is 92,000 shares they acquired. Each share acquired at 17. 92,000 into 17. 15,64,000. This is one cost of acquisition for 46%. Now this 54% also we are acquiring now. So therefore this 54% how much we are paying we need to find out. And if you want goodwill or capital reserve, we need to compare what? Cost of investment with net assets on the date of acquisition. Cost of investment 46%, 54%. 46%, 15,64,000. Now for this 54% how much we are paying? That we need to find out. How much we are going to pay? See this. We need to find out the price of the share. Price per share will be, see this, calculated by capitalizing the yield at 15%. Yield means 40% of the average pre-tax profits for the last 3 years. So tell me, average of pre-tax profits of last 3 years. So actually last 3 years 30, 40, 65. Correct? So 30, 40, 65. Correct? Divided by 3. How much? 45. This is the average of the last 3 years. And if you want, 40% you need to take. Correct? How much? 18 lakhs. And they said 40% of this, and this is called yield. So this is yield. Yield is 18 lakhs. But I need to find out the capitalized value. Correct? Capitalized value of yield. 18 lakhs divided by 15%. Can you tell me capitalized value of yield? 120 lakhs. Correct? 120 lakhs. Now important, see this. This is the capitalized value. I want to find out the price per share. At what price foreign company is selling to me? 120 lakhs divided by number of shares, 2 lakh shares. So 60 rupees per share. Important, sir. Sir, look at the question, sir. The shares held by the foreign company will be sold to Variety Limited. The price per share will be calculated. How? By capitalizing the yield at 15%. I find out the yield and I capitalized it. I want price per share. How will you get price per share, sir? Capitalized value divided by number of shares. So number of shares in Variety VR Limited is how much, sir? 2 lakhs. Don't take number of shares of the foreign company. This capitalized value is for entire business. This capitalized value for entire business. So therefore, 120 lakhs divided by 2 lakhs, 60 rupees. So that means I am purchasing one share at 60 rupees. Correct? Like that, how many shares I am buying? 1,08,000. So therefore, what is the cost of investment for this 54%? 1,08,000 into 60. How much? 64 lakhs 80,000. Therefore, my total cost of investment is 15 lakh 64, 64 lakh 80. 80 lakhs 44,000 is my total cost of investment. Correct? Sir, Variety Limited already has 46%, sir. 92,000 shares, sir. Each share purchased at 17, sir. 92 into 17, 15 lakh 64, sir. Got it. Foreign company is having 54%, sir. 54% means 1,08,000 shares, sir. This 1,08,000 shares they will sell at what price? They will sell at a price which is capitalized value, sir. Capitalized value of yield, sir. Yield means last 3 years profit at 40%, sir. And that will be capitalized at 15%. You will get the total capitalized value of the business 1 crore 20 divided by number of shares. You will get price per share. This is the price at which foreign collaborating company is selling shares. Therefore, I am purchasing each share at 60 rupees. 1,08,000 shares. That means I am paying 64 lakh 80. Therefore, for 46%, 15 lakh 60%. For 54%, 64 lakh 80. Total cost of investment 44,000. This I need to compare with what? Net assets on the date of acquisition. What is the net assets on the date of acquisition, sir? Simple. See this. Net assets they have given now. In the VR Limited, what is the total assets? 1 crore. But this 1 crore was decided to write down PPE by how much? 1,75,000. And so therefore 1 crore minus 1,75,000 minus current liabilities on the same date 20 lakhs. You will get the net assets. Can you calculate net assets? 1 crore minus 1,75,000 minus 20 lakhs. 1 crore minus 1,75,000 minus 20 lakhs. I think 78 lakhs. That's it. So 78 lakhs 25,000. 78 lakhs 25,000. So this is my cost of investment. This is the share in the net assets. So therefore, how much extra I am investing? This is my goodwill. So 2,19,000 is the goodwill. This is the main answer they are asking, sir. 2,19,000 goodwill. So see how you are going to solve this question. Very simple, sir. Illustration number 5. Correct? Calculation of goodwill or capital reserve. Particulars. Same manner. Amount in rupees. How you are going to calculate, sir? First we need to take cost of investment. But in this question, cost of investment is 2 categories. First, for 46% of investment. Next, for 54% of investment. In this question, investments in 2 parts. Directly we had 46. Now we are purchasing 54. You need to add these 2. Then you will get cost of investment. This will be compared with share in net assets of subsidiary company. Who is subsidiary company here? So VR Limited, because VR Limited shares only we are purchasing. Okay, then you will get goodwill or capital reserve. So therefore, first I want this working note 1. Working note 2, I need to find out 54%. Share in net assets, working note 3. So if I find out working note 1, that is, what is it, 46%. 46% investment cost. Simple. How many shares I had? So Variety Limited I had 92,000. Correct? 2 lakh shares I had. In this 46%. Into each share I purchased at 17. Therefore my cost of investment, that's it, 1564. So working note 1, I got it, 1564. Now I need to find out 54% of investment. 54% investment. So you need to find out the capitalized value of yield. Here yield is equal to 40% of average pre-tax profits, correct? Of last 3 years. And if you find out the average of last 3 years profit, it is how much? 45. In that 40% if you apply, it is 18 lakhs. 18 lakhs I got. And 18 lakhs divided by 15% the capitalized value. So 120 lakhs. This is the capitalized value. I want price per share, sale price per share. Sale price per share is equal to 120 lakhs divided by number of shares of the company, 2 lakhs. Therefore, what is the price? 60. 60. So therefore, for this 54%, that is 1 lakh, 2 lakhs into 54% into 60. How much? 64 lakhs 80,000. So therefore 64 lakhs 80,000 is my cost of investment for 54. So if I add both, how much it is? 80 lakhs 44,000. This is my cost of investment. Now what is the share I am getting in the net assets of VR Limited? So find out the net assets. Simple. Net assets is equal to total assets they have given. How much given? 1 crore. Correct? 100 lakhs. Everybody. And they said PP down by 1 lakh 75, minus it. Any revalued figures? Minus. Less what my current liabilities? 20 lakhs. So what is the net assets? That's it, 7825 I got. So I will compare 7825. So therefore my investment cost is 80 lakh 44. My share in net asset 7825. So how much extra? 2 lakhs 19,000 is my goodwill. Goodwill or capital reserve? Goodwill. Goodwill. 2 lakh 19. Very simple. You read this question once. And also in the question they said, sir, if you read, what is the total purchase consideration we are paying? 64 lakh 80,000, right? This one. 64 lakh 80. This 64 lakh 80,000, sir, we need to divide into two parts, right? One part is what? I mean, see, this 64 lakh 80, first we need to deduct 30% tax. After deducting tax, what is the balance left? Tell me. Yes, 64 lakh 80 minus cost of investment 5 lakh 40. Sir, to that foreign collaborating company, they are getting now 64 lakh 80,000 from the Variety Limited. And what is the cost of their investment? 5 lakhs. So therefore, what is the profit to them? Profit is equal to, they are receiving 64 lakh 80 sale value, correct? And what is their cost of investment? 5 lakhs. That means what is the profit? What is the cost? 5 lakh 40. So what is the profit? 59 lakh 40. In that they said in the question tax. How much? Tell me the tax. 17 lakhs 82,000. So therefore, what will be the net PC? 59 lakhs 40,000 minus 17 lakh 82. Because this 17 lakh 82,000 Variety Limited will deduct and pay to the government. Because it's a foreign company, right? We are purchasing shares from foreign company. That means Consideration is paid to that company. So when we are paying, we need to deduct tax. So what will be the net PC? 41 lakhs 58,000. Simple. This 41 lakh 58,000, what we need to do? Two categories you do. In the question they said 50% pay immediately. Tell me how much? 50% pay immediately. How much? 50%, 20? Sir, is this correct first of all? 59 lakhs 20 minus 17 lakh 82. Net PC correct? See, important. Yes. When you are finding this net PC, sir, see this. Actual PC we need to take here. Correct. 6480. Because 64 lakhs 80,000 is the total amount, right? Yes. Minus 1782. So tax. So 4098. This is the correct amount, right? So 4698. In that, what is the 50%? 40. This pay immediately. Remaining balance 2349,000. This will be loan, unsecured loan, given in the question, which is paid after 2 years. But sir, frankly speaking, sir, they have asked only this one. In the question, if you see, they are asking whether goodwill or capital reserve. This one is only for information purpose. Even if you don't do it, not a problem. But because they have not asked, in the question they are asked only goodwill or capital reserve. Okay. But anyway, since they have given in the question, I calculated it. You understand this? That's it. This is illustration 5, sir. That's what. So see illustration 6, sir. A Limited acquired 60% shares in B Limited, sir. So parent subsidiary at 20 per share. Following is the extract balance sheet of B Limited. So 10 lakhs equity shares of 10 each, 1 crore, 10% debentures, trade payables, property, plant equipment, investments, current assets, loans and advances. On the same day, sir, what happened? B Limited declared dividend at 20%, and as agreed between both the companies, property, plant equipment were depreciated at 10%, investments to be taken at market value 60 lakhs. Calculate goodwill or capital reserve to be recorded. Simple, sir. Sir, same manner. First we need to find out cost of investment. What is the cost of investment? 60% shares at 20. Correct? What is the total number of shares in subsidiary company? 10 lakhs. 10 lakhs into 60% means 6 lakhs. 6 lakhs into 20. 1 crore, 20 lakhs. Let's say, in this case, sir, you see, subsidiary company declared a dividend of 20%. Correct? So, simple. Find out the pre-acquisition dividend. What will be the pre-acquisition dividend here? Pre-acquisition dividend. We purchased how much shares? So 60% means 6 lakh shares. Each share 10 rupees. So 1.2 crores into 20%. Correct, na, sir? No. Wait. Yes. We purchased each share at 20, but dividend will be paid on face value. Yeah. So 6 lakh shares into 10 rupees into 20%. Can you tell me how much? 12 lakhs. So what we do? Minus from the cost of investment. Next, parent company share in the net assets of subsidiary company. What is the net assets here? See, property, plant equipment 70 lakhs book value, but how much we need to adjust? Depreciated 10%. Correct? Next, investments we need to take market value 60. Current assets as usual. Loans and advances as usual. So therefore, if you calculate the net assets, property, plant equipment 70 lakhs into 90%. Correct? Investments we will take 60 lakhs. Next, current assets you take 68 lakhs. Loans and advances 22. Minus liabilities, debentures, trade payables 10 lakhs, 55 lakhs. You will get net assets. That's it. So therefore, in this question, very simple question, sir. Compared to the standard of questions we have done. First, what is the cost of investment, sir? 6 lakhs into 20. So 1.2 crores, sir. 1 crore 20 lakhs. Minus what is the pre-acquisition dividend? Correct? Sir, subsidiary company given declared dividend on the date of acquisition, sir. So 20%, correct? So 6 lakh shares we purchased it, sir. 10 rupees face value. So 20% dividend. That means 12 lakhs dividend, sir. Minus it. So you will get 1 crore 8 lakhs. This is the adjusted cost of investment. From this, what is the share in net assets? You find out. Share in net assets of subsidiary company. So share in net assets, simple, sir. Calculate the net assets. PPE, revalued amount is there, na, sir? So PPE actually 70 lakhs, but we need to take it at 90%. They said we need to depreciate it 10%. So 70 lakhs into 90%, 63 lakhs. Next, investment. Investment, they said we need to take it at market value. What is the market value? 60 lakhs you take it. Then current assets, no change. How much? 68 lakhs. Then loans and advances is an asset for us. So loans and advances, 22 lakhs. So what will be the total assets? Minus liabilities. What will be the liabilities? 10% debentures, 10 lakhs. And then trade payables, 55. What is the total share? 213 lakhs. Correct? Minus 65. 148. 1 crore 48 lakhs. In that, what is the share of the parent? 60. How much? 88 lakhs 80,000. So compare this here. 88 lakhs 80,000. So 19 lakh 20,000 is goodwill. That's it. Same problem again and again we have done. Okay. So very simple question. If you see, if you want, you can see this question. So they got 19 lakh 20,000. Same question, sir. Nothing great, sir. This is already we have done, sir. These kind of questions. Same question is repeating. Okay. That's it. Only thing is that parent subsidiary company has given a dividend. That's a pre-acquisition dividend. So it is adjusted to cost of investment. That's it. So let us start. We are discussing questions relating to consolidation of balance sheet of a subsidiary as per accounting standard 21. One of the main things in consolidation procedure is analyzing the reserves and surplus of subsidiary company. While analyzing the subsidiary company reserves and surplus, revaluation of assets and liabilities, and dividend declared by subsidiary company, and intercompany transactions we affected, right? Bonus issue is also there. Now today we are going to solve questions which involves bonus adjustment. Okay, so in that the first question is question number 10, problem 10, scenario based questions, problem number 10, scenario based question, problem number 10, sir. This question already one time came in exams. This type of model already they have asked in the examination. Very important question, sir, because this question there is bonus issue, there is dividend issue, and also in this question I think unrealized profit adjustment, intercompany owings adjustments, all these things are there. So overall all adjustments are included in this sum. Okay, so let us see this question, very important question. Question number 10, scenario based question number 10, sir. See the question. On 31st March 2011, the balance sheet of H Limited and its subsidiary S Limited stood as follows. Balance sheet of H Limited and its subsidiary S Limited as at 31st March 2011 given, sir. Rupees in lakhs, sir. Rupees in lakhs. So H Limited is a parent company, S Limited is a subsidiary company. Equity and liabilities, shareholders funds, share capital, note 1, sir. Reserves and surplus, note 2. Current liabilities, trade payables, short term provisions, other current liabilities, that is dividend payable. Next, asset side, if you see, non-current assets, property, plant, equipment, non-current investment. H Limited invested in Shares of S Limited. See this. Shares in S Limited. 3000 lakhs. This is cost of investment. Current assets, inventories, trade receivables, cash and cash equivalents, short-term loans and advances. Notes to accounts you see. Share capital, authorized share capital given, equity shares of 10 each fully paid up, issued and subscribed equity shares of 10 each fully paid up given. Reserves and surplus, general reserve given, P&L account given. Trade payables, creditors, bills payable. Two things are there in trade payables. Short term provisions, we have provision for taxation. Property, plant, equipment. Land and buildings, plant and machinery, furniture and fittings. Okay. Trade receivables, debtors, bills receivable total. Short term loans and advances, we have sundry advances. So this is the entire balance sheet of HS. Both are parent and subsidiary. Now this balance sheet is given on, these are the individual balance sheets given on 31st March 2011. 31st March 2011. Okay. Now next what happened you see. The following information is also provided to you. What information they have given, sir? H Limited purchased 180 lakh shares in S Limited on 31st March 2010. So the date of acquisition is 31st March 2010. Date of consolidation 31st March 2011. When the balances of general reserve and P&L account of S Limited stood at 3000 lakhs, 1200 lakhs respectively. On the date of acquisition in the subsidiary company, how much is general reserve P&L account given? These are nothing but pre-acquisition profits. Next, on 1st April 2010, S Limited declared a dividend at a 20% for the year ended 31st March 2010. H Limited credited the dividend received by it to P&L account. Sir, exactly on the date of acquisition, subsidiary company given a dividend. Actually, this dividend is which dividend? Pre-acquisition dividend. This pre-acquisition dividend received by the parent company will be adjusted to cost of investment. But what they have done? Credited to P&L account. I told you in my theory explanation. Any dividend given by the subsidiary company from pre-acquisition profit, that dividend wrongly created by the parent company to the P&L account. Now we need to rectify. So that adjustment. And also, the point, very important point. What they are telling is, on 1st January 2011, S Limited issued 3 fully paid up bonus shares for every 5 shares held out of balances of general reserve as at 31st March 2010. Sir, subsidiary company given bonus. See this. S Limited issued 3 fully paid up bonus shares for every 5 shares held out of the balances in general reserve on 31st March 2010. That means bonus is given from pre-acquisition profits. And when bonus is given? January 1st 2011. Dates are important. So here date of acquisition 31st March 2010. Date of consolidation 31st March 2011. Date on which bonus declared by subsidiary company 1st January 2011. And that too, this bonus is given from which source? General reserve balance at the beginning. That means bonus given by the subsidiary company from pre-acquisition profits. Next, on 31st March 2011, at the end, all the bills payable in S Limited balance sheet were acceptances in favor of H Limited. Nothing but intercompany owings, mutual owings between the parent and subsidiary. In S Limited, bills payable 372 is there now. This 372 is nothing but acceptances in favor of H Limited. But on the date, H Limited held only 45 lakh of these acceptances in hand, and the rest of them having been endorsed in favor of its trade payables. That means the common debts between the parent and subsidiary we need to eliminate. Here in this case, if you observe, all the bills payable in S Limited, nothing but accepted in favor of whom? H Limited. That means parent company raised bills on subsidiary, subsidiary accepted it. So subsidiary point of view bills payable, parent point of view bills receivable. And 45 lakhs, still these acceptances in hand will be eliminated. So intercompany owings. Intercompany owings. So in this question you see this point intercompany owings, this point bonus, this point dividend. Okay, next. On 31st March 2011, S Limited inventory included goods which it had purchased for 100 lakhs from H Limited, which made a profit at 25% on cost. Sir, on the date of consolidation, subsidiary company inventory included goods which it had purchased for 100 lakhs from parent company. That means parent company sold goods to subsidiary. Parent company sold goods to subsidiary. And I told you, if there are any intercompany sales happen, at the time of consolidation, if any stock remains unsold, in that unsold stock, whatever the unrealized profit is there, that profit has to be eliminated. We have discussed now. This is which transaction? Downstream or upstream? Downstream. Here parent sold goods to subsidiary. That means unrealized profit is there in whose books? Parent. Therefore 100% we will eliminate from parent. So 100 lakhs still remains unsold. Profit is how much? 25% on cost. Okay, so we will eliminate. So this is unrealized profit elimination. Unrealized profit elimination. So look at this question. Very good question actually. Next. What they are asking? Prepare consolidated balance sheet of H and its subsidiary S Limited as at 31st March 2011. So they are asking consolidated balance sheet of the H Limited with its subsidiary as at 31st March 2011. So on 31st March 2011, we need to prepare the consolidated balance sheet of the parent company along with its subsidiary. So as usual, you know what to do. So we have steps, correct? So what is the problem number? This is 10th problem. Scenario based question 10. Very, very important. So tell me, what is the first step? Date of acquisition. I told you. Date of acquisition. So date of acquisition is 31st March 2010. Correct? 31st March 2010. On the date, H Limited acquired S Limited. Next, second step, shareholding pattern. On the date of consolidation. Correct? What is the date of consolidation here? 31st March 2011 is the date of consolidation. See, on the date of consolidation, can you help me? Number of shares, percentage of holding. Important, everybody please concentrate. What happened? So, on the date of consolidation, sir, in S Limited, in the subsidiary company, parent company H Limited, correct? Right? On the date of consolidation, how many shares the parent company had? Initially, see this, on 31st March 2010, in the question clearly said that how many shares are purchased by parent company, sir? Look at this, 180 lakh shares. 180, correct? So therefore, originally how many shares? 180 lakh shares they have purchased. 180 lakhs. Right? Next, what happened? Bonus issue given. So add bonus issue. Bonus issue how given, sir? See this. Bonus given. C point you see. 3 fully paid up bonus shares for every 5 shares. So 3 fully paid up shares for every 5 shares. Okay, that means 180 lakhs divided by 5 into 3. Correct? 3 fully paid up shares for every 5 shares. So 180 divided by 5 into 3. How many? 108 lakhs. 108 lakhs. That means total number of shares held by H Limited in S Limited on 31st March 2011 is how much? 288 lakhs. Agreed? 288 lakhs. That means tell me in the subsidiary company total number of shares. See this. Total number of shares is 4,800 divided by 10. 480 lakhs. 480 lakhs. So therefore 480 lakhs total number of shares at the end. In the 288 lakhs are held by parent company. Therefore what is the percentage of holding? 60%. 60% is the percentage of control by parent. Now come to minority interest. So total how many shares? 480. In that how many shares are held by parent? 288. Remaining balance 192 lakhs held by minority interest. Balancing figure. Therefore, how much is the percentage? 40%. How much is the percentage? 40%. So shareholding pattern you understood? In the subsidiary company, on the date of consolidation, parent company held 60%, minority held 40%. So you need to see the shareholding pattern on the date of consolidation. On the date of consolidation. Now what is step number 3, sir? So step number 3, analysis of reserves of subsidiary company. So analysis of reserves and surplus of S Limited. This is the most important step. Everybody concentrate. Sir, look at the question. Tell me the reserves and surplus in the subsidiary company. First we had general reserve. See this. Correct? General reserve is there. First reserve. So I am analyzing general reserve. So first general reserve. General reserve balance. General reserve on 31st March 2011. Can you tell me how much? 1,380 lakhs. Correct? 1,380 lakhs. Rupees in lakhs. Given, sir, on 31st March 2011, look at the subsidiary company reserves and surplus. First reserve, general reserve. How much is there? 1,380. Now I need to divide this into pre-post. So opening balance given in the question. See this, on the date of acquisition, what is the opening balance? 1/4/2010. How much given? 3,000. 3,000. Correct? 3,000. But they have given bonus issue from this. Bonus issue given. When bonus issue given? January 1st 2011 they have given bonus issue. Understand this, sir. General reserve balance on 13 at the end of the year is 1,380, sir. That means opening balance 3,000, sir. From this opening balance they have given bonus issue given in the question, sir. Read the question carefully. See this. If you read the question clearly, they said that this one, on 1st January 2011, S Limited issued 3 fully paid up bonus shares, 5 shares held out of its balances on general reserve on 31st March 2010. Therefore, this bonus is given from general reserve opening balance. Okay. Can you tell me how much bonus they have given? 108. Sir, bonus is given to all the shareholders. So, actually, see this. So after bonus issue, total how many shares? 480 lakh shares. Correct? In the subsidiary company, at the end 480 lakh shares is there. Now before bonus issue, how many shares will be there? See this. What is the ratio they have followed? For every 5 shares, 3 given. That means 8. Correct? Suppose for example, if I have a 5, they will give 3 bonus. That means it will be 8. That means this 480 is after bonus issue. So after bonus issue it is 8. Before bonus issue it is 5. Correct? 480 divided by 8 into 5. How much? 300 lakh shares. So that means 300 lakh shares are there before bonus issue. After bonus issue 480. That means 180 lakhs is the bonus. 180 lakhs is the bonus. 180 lakhs shares is the bonus. Each share 10 rupees. Therefore 1800 lakhs is the bonus. 1800 lakhs is the bonus. So I am telling once again, listen to me carefully. Actually, in the subsidiary company, total 480 lakh shares are there after bonus issue. And the bonus ratio is every 5 shares they have given 3. That means imagine if you have 5 shares, 3 will be added. Now your shares after bonus 8. That means this 480 is after bonus issue. In this, in every 8 shares, 3 shares are bonus shares. So 480 divided by 8 into 3. 480 divided by 8 into 3. Then you will get number of bonus shares. How much? 180. Each share is given at 10. So therefore 1800 lakhs is the bonus issue. 1800 lakhs is the bonus issue. Therefore what is the balance in general reserve? 1200. Correct? General reserve opening balance 3000. In that 1800 you used for bonus. Therefore still how much balance is there? 1200. What is this 1200? Pre-acquisition profit. Correct? This pre-acquisition profit is called what? Capital profit. Subsidiary company profits are analyzed into pre-post. So you acquired subsidiary exactly at the beginning of the year. Therefore whatever the reserves are there in the subsidiary on the date pre-acquisition profits, they are capital profits. You understood the bonus concept or not? Tell me, before bonus issue, after bonus issue. After bonus issue, 31st March 2011, in the subsidiary company, how many shares are there? 4,800 divided by 10. That means how many shares? 480 lakh shares. That is pakka. That is after bonus or before bonus? After bonus. But I want to know before bonus issue, because I want to know exactly how much company has given bonus. Right? So 480 lakh shares, each 8 shares, 3 shares are bonus. Therefore 480 divided by 3 into, 480 divided by 8 into 3, 180 lakh shares into 10 rupees, 1800 lakhs is the bonus. That means before bonus issue, number of shares 300 lakhs. After bonus issue, 480 lakhs. That means 180 lakhs increase. This 180 lakhs into 10 rupees, 1800 lakhs they have given bonus. This bonus is given from general reserve. So reduce it from general reserve. Correct? And opening general reserve, still how much balance is there? 1200. That is capital profit. Now you tell me, if your general reserve is opening 1200 balance, but closing it becomes how much? 1380. That means how much is the current year appropriation? 180. Current year appropriation balancing figure 180 lakhs, which is nothing but revenue reserve. I told you, if you are analyzing P&L account, it is revenue profit. If you are analyzing general reserve, it is called revenue reserve. Sir, this is closing balance, sir. 1380 is the closing balance. And my opening balance 3000. But from this opening balance 1800 lakhs adjusted. After that it is only 1200. But my closing has become 1380. That means in the current year how much is transferred? 180. So in the current year general reserve balance increased by 180 lakhs. This is post acquisition profit. All post acquisition profits are revenue profits or revenue reserves in this case. So this is how you analyze what? General reserve. Okay. Now next, tell me next reserve in subsidiary company. What is the next reserve? P&L account is there. See this. P&L account, how much is there? 1620. Correct? So P&L account. So P&L on 31st March 2011. How much? 1620. Now listen to me carefully, I am analyzing it. So can you tell me the opening balance given on 1st January 2010? How much given? Or whatever, doesn't make any difference. So when parent company acquired subsidiary, on the date in the P&L account of the subsidiary, how much is there? 1200 lakhs, correct? And subsidiary company has given a dividend from this. Subsidiary company has given a dividend. Say this, subsidiary company, B point you read. On 1st April 2010, S Limited declared a dividend at 20% for the year ending 31st March 2010. Okay, so therefore dividend is given from which profits? Pre-acquisition profits, correct? So this is dividend. Tell me how much dividend given? So dividend is given 20% for the year ending 31st March 2010. That means on 31st March 2010, how many shares are there? Just now we find out 300 lakhs. Because in the beginning, before bonus issue, 300 lakh shares are there. Correct? Sir, this bonus is given at the beginning. In the beginning, how many shares are there in subsidiary? 300 lakhs. Correct? So therefore, if I calculate 300 lakhs into 10 rupees into 20%, 600 is the dividend amount. We are analyzing the subsidiary company P&L account. Subsidiary company closing P&L 1620. Opening P&L 1200 lakhs. From that opening P&L, subsidiary company given dividend. If dividend is given from the opening profits definitely will be reduced. How much dividend they will give? Based on the number of shares on that date. This dividend is given in the beginning of the year. In the beginning of the year in subsidiary, how many shares are there? 300 lakh shares. At the end in subsidiary, how many shares are there? 480. During their bonus 180 lakhs increased. That means in the beginning, how many shares? 300 lakhs. 300 lakhs into 10 rupees, 3000 lakhs share capital into 20%. That means 600 lakhs is the bonus. Sorry, dividend. 600 lakhs is the dividend. So therefore, what is the balance? 600. But my closing balance is how much? 1620. So 600 is there, but it becomes 1620. Therefore, what is my current year profit? So balancing figure 1020. Balancing figure. Balancing figure. Okay. So P&L account also analyzed. Sir, are you understanding, sir? Please understand, sir. These are common sense, sir. Nothing great. So P&L account closing balance given, sir. Opening balance also given, sir. You acquired subsidiary exactly in the beginning of the year, sir. In the beginning of the year, in the subsidiary company, 1200 lakh shares, that 1200 lakh share balance is there, sir, in P&L account. From that, you given dividend, sir. You mean subsidiary company given dividend, sir. Reduce it, sir. How much dividend they will give, sir? On that date, how many shares are there? 300 lakhs before bonus issue into 10 into 20%. So 600 lakhs is the bonus. Sorry, dividend, not bonus. Okay, that's it. Any other reserve to analyze in the subsidiary? Apart from this, nothing, only two reserves, correct? So we analyzed the reserves of subsidiary company into pre, post. And now in this case, this 600 lakhs is what? Pre-acquisition profit. All pre-acquisition profits are capital profit. And this 1020 is nothing but what? Post-acquisition profit, correct? All post-acquisition profits are revenue profit. Because this is P&L account. This is revenue profit. Okay. Analysis done. Next step number 4. Apportionment. Correct? Apportionment of profits. Now how apportionment will be done? Pre-acquisition profits, post-acquisition profits. All pre-acquisition profits are capital profit. Post-acquisition profit, revenue reserve, revenue profit. We have two reserves. One is general reserve. Already we analyzed the general reserve. Tell me in general reserve how much is the capital profit? 1200. Correct? So this 1200. So take this 1200 here. Next, in general reserve, how much is the post-acquisition profit? 180. So take this 180 here. Next, to come to P&L account. We analyzed P&L account. P&L account, how much is the pre-acquisition? 600. So 600 capital profit. How much is the revenue profit? 1020. Take in here revenue profit. Therefore, what will be the total capital profit? 1800. What will be the revenue reserve total? 180. What will be the revenue profit? 1020. Now, apportion this between the H limited and minority interest. That means subsidiary company profits are analyzed into pre-post. After that, we apportion between the parent and minority interest. So, parent 60% share capital is there, minority interest 40%. So, therefore, tell me what is the share of the parent company in the subsidiaries pre-acquisition profits? 1080. This is 720. This one 108.72. This one 612.408. And tell me what is the treatment, sir? Parent company share in the pre-acquisition profits of subsidiary company adjusted to cost of investment. Parent company share in the post-acquisition profits added to the consolidated reserves. Minority interest will be transferred to minority interest. So therefore, we have done the apportionment also. Next, fifth step, minority interest 40%. Correct? Minority interest, very simple. Tell me, in the subsidiary company, how much is the total share capital? 4,800 into 40%. And also, in the subsidiary company capital profit, how much is the share belongs to minority interest? Already we just now calculated. In the revenue reserve, how much is the minority shareholders' share? In the revenue profit, what is their share? All their profits will be added. So 4,800 into 40%, 1920. Capital profit 720. Revenue reserve 72. Revenue profit 408. So total 3120. That's it. 3120 is the minority interest. So we completed minority interest step. Okay. Now what is step number 6, sir? Cost of control. This is one of the important steps, sir. In cost of control, first I need to take cost of investment. So tell me, sir, how much is the cost of investment? So parent company investment in the subsidiary company, how much? 3,000 given. So take 3,000. Now any adjustment to this? Yes, pre-acquisition dividend. Actually, subsidiary company has given a pre-acquisition dividend. This pre-acquisition dividend is adjusted to cost of investment. But wrongly what they have done? They have created to P&L account. That we will rectify. Correct? Correct treatment is what? Whenever any dividend given from pre-acquisition profit, that has to be adjusted to cost of investment. Therefore, less pre-acquisition dividend. Pre-acquisition dividend. How much is the pre-acquisition dividend? Simple. 300 lakh shares in the beginning. Each share 10 rupees. 20% dividend. As a parent company, I had 60%. So my share in the dividend 360 minus, that's it. As a parent company, how much dividend I am going to receive? So in the beginning I had 300, total 300 shares are there. 300 lakh shares are there in the subsidiary. Each share 10 rupees, 3,000. They have given a dividend of 20%. So 3,000 to 20, that is total dividend. In that 60% belongs to parent company. So 360. So can you tell me what is the adjusted investment? 2640. Okay. Now tell me, to this what we need to adjust? Parent company share in the net assets of subsidiary company. Correct? We need to compare cost of investment with parent company share in the net assets of subsidiary company. So from this, less share in net assets of S Limited represented by, tell me, sir, share capital. Everybody please concentrate here. What is the net assets in the subsidiary company on the date of acquisition? So tell me what is the share capital? 3,000. In that 60%, 1,800. Correct? Next, capital profit, pre-acquisition profit. Step number 4. What is the parent company share? 1,080. 1,080. So total 2880. How much? Goodwill capital reserve. Capital reserve 240, which is absolutely wrong. This is wrong, wrong, wrong. That is the twist of this question. See, please understand, sir. Generally, in every problem, what we are doing is cost of investment we are comparing with the net assets. On the date of acquisition in the subsidiary company, whatever the net assets are there. Net assets means share capital plus pre-acquisition profits. In that, our share. We are treating the difference as goodwill or capital reserve. But in this case, when you consider the share capital 3000, understand, important, you are considering share capital 3000. That means this is before bonus issue or after bonus issue? Before bonus issue. But bonus is given from pre-acquisition profits. Bonus is given from pre-acquisition profits only, na? Hello? And when they have given? 1st January. That means on 31st March 2010, you are eligible to participate in the general reserve also. That is also pre-acquisition profit. But while analyzing the profits, here, see this, we have reduced the entire bonus issue. Entire bonus issue, 1800. Sir, common sense, use your common sense, sir. Bonus means what, sir? Capitalization of profits. Your existing reserve is converted into share capital. That means there is no change in the net assets. General reserve becomes share capital. What is net assets? Share capital plus pre-acquisition profits. If you remove some amount from this pre-acquisition profit and add it to share capital, net assets changed? No. You are not understanding. Very simple, yaar. See this. Net assets means what? Tell me. Share capital plus reserves and surplus on the date of acquisition. Correct? Suppose from this reserves and surplus 1800 lakhs I reduced and I added here. I reduced it from reserves, I added to share capital. You tell me whether my net assets changed or not changed. No change. Just place shifted. This 1800 lakhs which is there in general reserve now become part of share capital only. So basically in bonus issue what is happening? Nothing but your profits are converting into share capital, and that too you need to understand here. Suppose I am parent company H Limited. Very interesting point. Listen, I am parent company H Limited. You are subsidiary. In your company how many shares I purchased? Initially tell me. 180 lakhs. In the question they said, na, sir, how many shares we purchased, sir? 180 lakhs. How much bonus you have given to me? 108 lakhs. Now tell me, for that 108 lakhs, is there any additional investment I have made? No. Without additional investment, these are added to me. And that too, what is the source for this? Pre-acquisition profit. Therefore, as a parent company, I have the share in the net assets of the subsidiary company on the date of acquisition. On the date of acquisition, this 1800 lakhs, which is given from general reserve, is also there. Therefore, when you are in this case, when you are considering the share capital, take total 4800 lakhs. Why 4800 lakhs? Because this 1800 lakhs is added from general reserve. General reserve is also pre-acquisition profit. But when you are analyzing, we reduced it, sir. Here we have removed this. So therefore, in the pre-acquisition profit, in the capital profit, see this. This 1800 lakhs is not there. But this 1800 lakhs shifted to share capital from the reserves. Shifted to share capital from the reserves. That means overall net assets remains the same. Therefore, I need to consider 4800. Na? So 4800 into 60%. Can you tell me the amount here? 2880. And my capital profit share 1080. Total 3960. So now my capital reserve will also change. How much? 1320. 1320. So the conclusion is, when subsidiary company gives the dividend from, gives the bonus shares from pre-acquisition profits, nothing but that bonus amount is shifting from reserves to share capital. Therefore net assets remains unchanged. Therefore even including that bonus you need to consider. Including bonus you need to consider. Sir, tell me sir, are you understanding or not? Or else we will do one thing sir, simple way we will follow. What is that is, we will do wrong in the exams. Because sometimes your mind will not accept the logic. Or why you said on the date of acquisition in the subsidiary company, whatever the net assets are there, in that 60% net assets on the subsidiary company on the date of acquisition is share capital plus reserves and surplus. Share capital 300 lakhs only na sir. Okay, share capital 300 lakhs, but general reserve including that 1800 is also there, 1800 lakhs, which you given a bonus. When you have given the bonus? 1st January 2011. That means on 31st March 2010 in the subsidiary company general reserve, that 1800 lakhs which is given as a bonus is also there na. That means on the date of acquisition that 1800 lakhs is also is in the form of capital. I mean reserves and surplus, pre-acquisition profit, but place shifted later on. Later on, since because you have given a bonus issue at the end of 31st March 2011, when you look at it, the place was shifted from reserves to share capital. Just shifting the place will not affect my net assets. How many of you understood? Logically, you don't understand the logic, huh? Okay. So what to do? Tell me. Where you are not understanding? Here. Any specific thing? From the first? Yeah, this one. No. If the bonus is given from pre-acquisition profit, including bonus, that amount, you need to calculate cost of control. Only if the bonus is given from post-acquisition profits, then what happens is, bonus is nothing but what? Increase in your holding, or number of shares were increased without any corresponding flow of resources. So therefore, when subsidiary company gives any bonus from post-acquisition profits, accordingly cost of control, our share in the net assets will also increase. So therefore, because see, you understand, you suppose you have 60% shares in the subsidiary company. Now subsidiary company given you bonus. Because of that bonus, your share in the net assets of the subsidiary company improved or not improved? Not improved. Percentage is still the same. That's what here you need to understand. The bonus which is given by the subsidiary company is given from existing general reserves at the beginning of the year. Therefore, my overall net assets remains unchanged. My share in the net assets of the subsidiary company. That's why if I see, for example, if I instead of 4,800, if I take 3,000 now, what happens? You tell me. That 1,200 lakhs I am ignoring. That 1,800 lakhs I am ignoring now, which is also part of my reserves at the beginning of the year. So which is not correct. That's why we need to consider including bonus here, because that bonus is given from the reserves on the date of acquisition, which is part of pre-acquisition profits, but place was shifted to share capital. That's it. Okay, so this is the thing sir. Cost of control 1320. Next, intercompany owings are there. Yes, in this question intercompany owings are there. 7, correct? Intercompany owings. So can you tell me intercompany owings? Intercompany owings are there in bills, bills payable, bills receivable, correct? See this. Can you tell me, see how we are going to calculate bills receivable, bills payable. H limited, tell me bills receivable. H limited total bills receivable. H limited bills receivable 360. S limited 199. Total 559. Correct? Hello. Come to bills payable. H limited bills payable 372. S limited 160. Total 532. Now these are the totals. Now between parent and subsidiary, how much is the common owings as far as the bills is concerned? 45. Correct? So less mutual owings or mutual debts. How much is the mutual owings? 45. Remove it from both, because we have considered total na. In the total 45 common debts is there, so remove. How much? 514, 487. So these are the things we need to consider in the consolidated balance sheet. 514, 487. Understood? Sir, here in this question clearly given, sir, here this point, all the bills payable in S limited were acceptances in favor of H limited, and H limited held only 45 lakhs of these acceptances in hand, the rest of them having been endorsed in favor of its trade payables. So therefore 45 lakhs is a common debts in the bills payable, bills receivable. So bills receivable of H limited, bills payable of S limited, here common debts are there in this bills payable of which company? S limited. Bills receivable of H limited. Sir, subsidiary company accepted, sir. That means subsidiary company point of view, bills payable. So in the subsidiary company bills payable 45, and in the parent company bills receivable 45. Both will be removed. That's why we have first taken total bills receivable total, bills payable total. From that common debt I reduced. Okay, so intercompany owings are also over. One more thing is downstream transaction is there, very important. Correct? In this question downstream transaction is there. Downstream transaction means parent sold goods to subsidiary. So H limited sold goods to S limited. Correct? At what price goods are sold? Cost plus 25% profit, right? And what is the sale value? 100 lakhs. Correct? 100 lakhs. That means here H limited sold goods to S limited means what is the profit recognized by H limited on this 100 lakhs? 100 lakhs is a sale value, sir. Profit is 25% on cost. So therefore 1/4 on cost, 1/5 on sale price. So 1/5, how much? 20 lakhs. Hello. So this is unrealized profit. We need to eliminate this unrealized profit. So eliminate unrealized profit from parent company P&L account in step number 8. I told you na, unrealized profit we need to eliminate because profit is not yet realized. So it is not a profit for the group. So because goods, parent sold goods to subsidiary, and now parent and subsidiary is one entity only for consolidation purpose. That means goods are within the group only, na. Therefore whatever the sales you made, in respect of that, any unrealized, any unsold stock is there. In that unsold stock, the unrealized profit must be eliminated. And also we need to reduce from the inventory. Inventory value originally how much? 100 lakhs. Correct? This one, only this one. Less in this inventory, what is unrealized profit? 20. Remove it. So therefore inventory will be considered 80 lakhs. That means when you are preparing the consolidated balance sheet, sir, total inventory, can you tell me? Inventory of H limited how much? 3949. 3949. Correct? In that 3949 we need to reduce 80 or 20 or 20 we need to reduce. Plus from S Limited, how much? Sir, sorry. S Limited, how much inventory is there? 1956. From this we need to reduce 20. Correct? Because our stock is there with the subsidiary. So in the subsidiary 1956, 20 rupees unrealized profit, remove it. So 1936 we need to consider for consolidated balance sheet. Subsidiary company inventory. Subsidiary company inventory 1936. Parent inventory 3949. Total inventory will come. You understand this adjustment? Sir, parent sold goods to subsidiary at cost plus 25%. So sale value 100 lakhs, sir. In that, what is the profit included? Suppose cost is 100, sir. 25% profit. That means 125. Correct? This 100 is equal to 125. How much is for 25? This way also you can find out. 100 into 25 divided by 125. So you will get 20. This is the unrealized profit. This unrealized profit has to be eliminated. From the parent company reserves, we need to eliminate in step number 8. And at the same time, inventory, whatever the unsold inventory is there in the subsidiary books, which is sold by parent, in that unsold inventory, reduce this 20. Correct? That's it. This is intercompany owings and transactions. Upstream means same. See, for example, if subsidiary sold goods to parent means the profit is there in whose books? Subsidiary. So therefore subsidiary company profits we have analyzed and apportioned between parent and minority interest. So therefore we need to reduce from the parent company reserves their share and also minority interest share in step number 5. Yesterday we have discussed upstream transaction we need to reduce, okay, from the minority interest share, from the minority interest, parent company share in step number 8. Okay. Next, step number 8. What is that? Reserves for consolidated balance sheet. Important, sir. Sir, when you prepare the reserves for consolidated balance sheet, sir, in the parent company, what are the reserves are there? Tell me. General reserve, P&L account. First, take the balances of parent company, H Limited. How much balance is there in general reserve? 2784. P&L 2715. Tell me what adjustments we do. Add parent company share in post acquisition profits of subsidiary. Correct? So H Limited share in post acquisition profits of S Limited. Already we have done in step number 4. In step number 4, see this. What is the parent company share in the post acquisition profit? 108,612. Correct? So 108 add to general reserve, 612 add to P&L account. Any other adjustment? Yes. Sir, in this question, pre-acquisition dividend given by subsidiary which was wrongly created to P&L, but we need to adjust to the cost of investment. Wrongly created to P&L account means in the parent company P&L account this dividend included. Now remove. So therefore pre-acquisition dividend wrongly credited. Pre-acquisition dividend wrongly credited to P&L account. So how much is the pre-acquisition dividend? 360. Remove it. Dividend, sir, we already calculated. You see, total dividend 300 lakhs. In that 60%. Correct? So 360 pre-acquisition dividend. One more adjustment. URP, unrealized profit. Just now I said parent sold goods to subsidiary. In that whatever the unsold stock is there, in that unsold stock whatever the unrealized profit is there, which is already there in the parent company books, we need to eliminate. Less URP, unrealized profit on sale to S Limited. Already we have done this in step number 7. Okay. Tell me how much? 20. Adjust it. Any other thing? Capital reserve also came. Step number 6. Goodwill, cost of control calculated. We got capital reserve. Na? So that capital reserve also we can take. Hello? Capital reserve is also part of our reserves. So reserve for consolidated balance sheet you can consider. How much is the capital reserve? 1320. So this is from cost of control step number 6, sorry, step number 6. So therefore, can you tell me what are the total reserves? Capital reserve 1320, general reserve 2784 plus 108, 2892, P&L 2715, 612 minus 360 minus 20, 2947. That's it. So now my total reserve for consolidated balance sheet is this. If I add all these things, I will get the reserves. That means all steps we have completed. All the steps we have completed. Sir, here see, the point is, question is easy only. Only thing is that you need to understand properly the bonus element. Remaining and all simple. So in this case, subsidiary company has given dividend from pre-acquisition profits, and these pre-acquisition profits are already there in the beginning of the year at the time of acquisition. So therefore this bonus which is reduced from general reserve shifted to share capital. Therefore still it is part of net assets. So when you are calculating cost of control, you consider that bonus which is given from pre-acquisition profits. That's the only thing you need to remember, because the place shifted from reserves to share capital. That's it. So overall net assets of the subsidiary company on the date of acquisition remains unchanged. Sir, have you understood that point? That is the only point, sir. Remaining and all you can easily manage. And you understand this intercompany owings, downstream transaction, unrealized profit? Yes. So that means we have completed the overall sum. Now I need to prepare the balance sheet. Now come to balance sheet, sir. As usual, equity and liability, shareholders funds. In shareholders funds we need to take share capital. So only parent company share capital. In parent company 480 lakh shares are there. Sorry, that is subsidiaries. Parent company, how much is the share capital? Can you tell me? So the authorized share capital, how much given? 15,000. Parent company you take. Subscribed 12,000. Correct? So here 15,000 authorized. This is only just for presentation. Subscribed and paid up 12,000. This will be considered for total. Correct? So the total share capital in the consolidated balance sheet is 12,000 lakhs. Come to reserves and surplus. Reserves and surplus already we have done. So step number 8. So total reserves and surplus, how much we got? You add everything, 2892. This is general reserve, 2892. So general reserve 2892, sir, 2892. P&L account, sir, 2947. So 2947. And capital reserve, sir, 1320. Capital reserve 1320. So total 7159. That's it. If you want the breakup, you see step number 8. So how general reserve came? Step number 6, cost of control step. Correct? And general reserve balance, if you want, you can see the reference here. How we got it? I already solved. Okay. So 7159 is the reserves and surplus. Minority interest, sir. Step number 5 already we calculated, sir. Minority interest. How much we got, sir? 1320. So 3120. Current liabilities you come. Trade payables. So trade payables, creditors is there, bills payable is there. Correct? So first take creditors. So creditors 1461, S limited 854. Total 2315. Okay. Now bills payable. Actually bills payable we done it. Step number 7, bills payable we already done. How much? 487. How we got that? 372, 160 minus common 45. So 372, 160, 532 minus intercompany owings 45. So how much? 487. So take here 487. So total tell me 2315, 487. 1280, 2315 plus 487. 202. So 2802. This is trade payables. Now short term provisions. I think in short term provisions we have 4 provision for tax. No changes. So this is 4 sir, short term provisions. So short term provision for H limited how much? HS both 8, 55, 394. Total 1249. 1249. This is short term provisions. 1249. 1249. Now other current liabilities we had dividend payable. Only H I think. How much? 1200. So dividend payable 1200. So that's it. So can you tell me the total of the equity and liabilities? 27530. Now come to assets sir. Asset side first we have property plant equipment. Note 6. Any changes in property plant equipment? Nothing. First land and billings only HM. Land and billings 27. Okay. So 2718. Plant and machinery H 49. S 4 900. Okay. Total 805. Furniture and fixtures H 18. S 586. Total 24. Total I think plant PP total tell me. 2718 9805 2431 954. So 14954 sir. Inventories important sir. Inventories sir, in H limited how much is there in inventory? H limited 39. S limited so 19 minus unrealized profit 20. So 1936. Total 5885. Important. So in the inventory there is an unrealized profit sir. We need to eliminate. Now come to trade receivables sir. 8. So debtors, bills receivable, 2 things. Debtors you tell me H. How much is the debtors in H limited? 2000. S 1363. Total 39. Now bills receivable H. Bills receivable already we have done actually. So 360 199. So 360 199 minus 45. So balance 51. So therefore total trade receivables 3963 plus 514. Total you add 4477. Okay. 4477. 4477, sir. So take it here, 4477. Now short term loans and advances, sir. Only S, H. How much? Sundry advances. How much? 520. That's it. Cash and cash equivalents. Both H and S both are there. Okay, H how much? 1490. S 204. Total 16. That's it. So 1694. So this one 520. Correct? Simple adding, sir. Nothing but parent company, subsidiary company, parent, subsidiary. Any common debts eliminate. So total 27,530. That's it, sir. So it's a big sum. So you need to solve it properly, sir. Otherwise, it will be a difficulty. Suppose same kind of question asked in the examination, you need a practice to solve these kind of questions. Only the dividend point is you need to understand. Bonus. Remaining and all same. Scenario based question 9. See this. A Limited acquired 1600 ordinary shares of 100 each of B Limited on 1st July 2011. So how many shares A Limited acquired? 1600. What is the date of acquisition? 1st July 2011. See this, date of acquisition 1st July 2011. On 31st December 2011, the balance sheets of two companies are given below. So date of consolidation 31st December 2011. Date of acquisition 1st July 2011. Now balance sheet of A Limited, its subsidiary B Limited as at 31st December 2011 given. Look at the balance sheet. Equity and liabilities, shareholders funds, share capital note 1, reserves and surplus note 2. Current liabilities, trade payables, short term borrowings. Asset side, non-current assets, property, plant, equipment, non-current investments. Current assets, inventories, trade receivables, cash and cash equivalents. Notes to accounts, if you see, share capital. So 5,000 shares of 100 each fully paid up, 2,000 shares of 100 each fully paid up. Reserves and surplus, general reserve, P&L. Short term borrowings, bank overdraft is there. Property, plant, equipment, land and buildings, machinery, plant and machinery. Non-current investments, parent company investment in B Limited 340,000 cost of investment. Cash and cash equivalents given. So these are the balance sheets of A and B on 31st December 2011. A Limited acquired B Limited on 1st July 2011. Number of shares acquired 1600. Okay. Now next. The P&L account of B Limited showed a credit balance of 30,000 on 1st January 2011, out of which dividend of 10% was paid on 1st August 2011. Sir, dates you should be very careful. See, subsidiary company B Limited P&L account balance given. When? Not on the date of acquisition. Date of acquisition is 1st July 2011. Hello? But they have given opening balance. Sir, here in this question they are following calendar year. They have given balance sheet on 31st December. That means January to December. Right? 1st January 2011 is what? Opening. So opening in the subsidiary company, how much is there? P&L account balance 30. From that 30,000 they have given a dividend of 10%. Which dividend is? Pre-acquisition dividend. Right? Because you acquired subsidiary on 1st July. Before 1st July, whatever the profits are there, they are all pre-acquisition profits. Therefore, the balances which is there on the 1st January, they have given dividend from it. So it's a pre-acquisition dividend. But what A Limited done? See this. A Limited credited the dividend to receive to what? P&L account. But actually, what is the correct treatment? Cost of investment will be adjusted. Like in the last problem, sir, when dividend is received from the pre-acquisition profits of the subsidiary company, it is adjusted to cost of investment. But here what they have done? Credited to P&L account, which is wrong. We need to rectify. How to rectify it? In step number 8, consolidated reserves, we need to minus pre-acquisition dividend from the parent company P&L account. Correct? Next. The plant and machinery which stood at 1,50,000 on 1st January 2011 was considered worth 1,80,000 on 1st July 2011. So that means there is a revaluation of assets. Sir, look at plant and machinery balance is how much, sir? 1,50,000 when 1st January, but which is considered worth how much? 1,80,000 when 1st July. That means I told you, when subsidiary company is acquiring, when parent is acquiring subsidiary, generally subsidiary company assets will be revalued. Here revaluation is done. So whenever there is a revaluation profit will come or loss will come. That is capital profit, I told you. Hello? Because on the date of acquisition only that revaluation is happening. And because of that, what is the additional effect? Additional depreciation may come or excess depreciation has to be written off. Yesterday we solved one question also. Next. This figure is to be considered while consolidating the balance sheet. The rate of depreciation on plant and machinery 10%. Okay. Prepare the consolidated balance sheet. So in this question, what are the adjustments? Two adjustments. One is pre-acquisition dividend. Second, revaluation of assets. Remaining is same. Okay. So very important sum, this sum also, because this type of sum once they have asked in exams. So see this question properly, sir. So scenario based question 9. Look at how I am analyzing it. First, always date of acquisition. Can you tell me the date of acquisition? Important. 1st July 2011. Second step, shareholding pattern on the date of consolidation. On the date of consolidation. Date of consolidation is 31st December 2011. Correct? 31st December 2011. Number of shares. Percentage of holding. Sir, tell me, sir. Parent company A Limited. Minority interest. At the end of the year, in the subsidiary company, parent company is having how many shares? 1,600 shares. No bonus issue, nothing. In the question clearly given that parent company acquired, in the first line itself they have given 1,600 ordinary shares. Okay, assume that there is no change in the share capital. Okay, so therefore 1,600. So can you tell me 1,600 divided by total number of shares in subsidiary company? See this, 2,000 shares given. See this additional information, 2,000 shares of 100 each. So that means out of 2,000 we are having 1,600. That means 80%. That means remaining 400 shares are held by minority shareholders. So 400 divided by 2,000 into 100, how much? 20%. So you understand the shareholding pattern now? Very simple. So shareholding pattern is also done. Next, most important step, that is analysis of reserves of subsidiary company. So analysis of reserves and surplus of subsidiary company B Limited. Tell me what is the first reserve we need to analyze? Revaluation. Actually in this question revaluation of assets is there now. Okay, so first I am analyzing revaluation reserve. Revaluation profit. Can you tell me what is the revaluation profit here? 37,500. See, simple sir. What is the value of plant and machinery as on January 1st, 2011? Look at the question and tell me. On January 1st, 2011, the plant and machinery value is how much? 1,50,000. 1,50,000. But sir, you are taking subsidiary on which date? 1st July. That means 6 months depreciation we need to provide. Less depreciation for 6 months. January to June. 1,50,000 into 10% for 6 months. So 1,50,000 into 10% into 6 by 12. 7,500. Therefore, what is the WDV of the asset as on 1st July 2011? 1,42,500. Now this 1,42,500 worth of assets they are taking at what value? 1,80,000. Say this. So they considered worth 1,80,000 on 1st July. Correct? So therefore, revalued amount 1,80,000. That means, tell me sir, 1,42,500 worth of asset we have taken at 1,80,000. That means how much increase in the asset value? 32,000, 37,000. What is this? This is revaluation profit. Correct? This revaluation profit is pre na posta? Pre. And it is obviously capital profit. Obviously capital profit. Okay, see, please understand, please read the question carefully. They have given plant and machinery value on January 1st 2011, but we are taking subsidiary on 1st July 2011. Therefore we need to compare what is the value at which we are taking, what is the book value of the asset on the date of acquisition. This is on 1st January. So we are taking subsidiary on 1st July. Therefore in between 6 months over. Therefore if I provide 6 months depreciation on this 1,50,000, the WDV is 1,42,500. So the value on the date of acquisition is 1,42,500, but I am taking it 1,80,000. Therefore 37,500 is the revaluation profit. Asset value increasing. I told you what is the entry for this. Asset account debtor to capital profit. Pre-acquisition profits nothing but. Everybody understood? This is already we have done in the last one problem. We have done the same thing. I think illustration number 13. In the two assets we have revalued. One is machinery, another one is furniture. Now you tell me, because of this increase in asset value, what happens? Additional depreciation will come. Additional depreciation will reduces my post acquisition profits. In that question, illustration number 13, if you want you can check it. So in that machinery additional depreciation came. Furniture excess depreciation we have written back. Therefore our post acquisition profits were increased. So that one. So here 37,500. Okay. So I mean we have analyzed this. Now tell me what are the other reserves which is available in the subsidiary company. General reserve is there. Take general reserve. Can you tell me what is the balance of general reserve? 1 lakh. On which date? 31st December 2011. What is the balance? 1 lakh. Any opening balance? Any opening balance? So nothing. So therefore here the assumption is opening balance, that is on January 1st 2011 entire balance is opening. So therefore current year appropriation nil. Current year appropriation nil. Okay. So that means here you see the general reserve balance 1 lakh is there at the end, sir. They have not given any opening balance. So we assumed this entire is what, sir? Opening. So therefore it's a pre-acquisition profit. Therefore it is which profit? Capital profit. Sir, this is assumption, sir. Assumption, assumed that entire general reserve is opening balance and there is no current year appropriation. Don't scratch your head when you are solving this question. This is just an assumption. Or what is the logic? No logic, just an assumption. If you want to take, you can take it as a post acquisition profit also. I have assumed whatever the balance is there in the general reserve is a opening balance. Therefore it's a pre-acquisition profit. If you want, you can take it as a post acquisition profit also. Nothing wrong. Generally, sir, in case of general reserve, what happens is, if there are any appropriations in the current year, they will give. Generally. So nothing mentioned. Therefore I assumed opening balance. Okay. So that's it. So general reserve I analyzed. Entire opening. So it's a pre-acquisition profit. Now what is the next one I need to analyze? P&L account. Most important. Listen to me carefully. Can you tell me what is the P&L account balance in the subsidiary company on 31st December 2011? 82,000. Now opening balance given. Yes, opening balance given. Read the question carefully. The P&L account of B Limited showed a credit balance of 30,000 on January 1st 2011. So therefore on January 1st 2011, what is the balance? 30,000. Now but from this 30,000 they have given what? Pre-acquisition dividend given. So dividend they have given. How much dividend they have given? So 10%, correct? So what is the total share capital? 2 lakhs into 10%, 20,000. So therefore, what is my opening P&L balance remaining? 10. But closing it becomes how much? 82. Sir, understand. Opening 30,000 is there. From that you given 20,000 dividend. Okay. That means it should be 10,000. But closing it becomes 82. That means how much is current year profit? 72,000. But important, sir. Whether this 10,000 is which profit? Pre-acquisition profit. It's a capital profit. Correct? Now come to the 72,000. Is it post-acquisition profit entirely? No. Because parent company acquired subsidiary on 1st July. Therefore, first 6 months pre, next 6 months post. So therefore, if I divide this, January 1st, 2011 to 30th June 2011, 6 months pre. 6 months pre, sir. And then 1st July 2011 to 31st December 2011, 6 months post. Sir, simple, sir. As a parent company, when I acquired subsidiary 1st July, till that point of time, whatever the profits are there, they are all pre. So I know my closing P&L balance 82,000, opening 30,000. From that opening, they have given a dividend of 20. Therefore, 10,000 is there. That is capital profit anyway, because that profit is there before my acquisition. Now that means current year profit 72. So have I acquired subsidiary company from the beginning 1st January? No, I acquired on 1st July. That means 6 months out of the 72,000 is pre. Next 6 months post. So therefore, what is the pre-acquisition profit here? 72,000 into 6 by 12. 36,000. So what is this profit? This is a capital profit, correct? This is also capital profit. This is a pre-acquisition profit. It's a capital profit. Pre-acquisition profit, it's a capital profit. What about next 6 months profit, sir? 72,000 into 6 by 12. 36,000. What is this profit? But you need to adjust depreciation. Additional depreciation you need to adjust. That is the important thing. Less additional depreciation. Whenever parent company revalued the assets of subsidiary company on the date of acquisition, because of that revaluation, asset value may increase or decrease. So if the asset value increases, obviously additional depreciation will also increase. That will affect my future profits. Therefore, from this post-acquisition profits, you need to reduce additional depreciation. Can you tell me what is additional depreciation here? Additional depreciation 1,500. How to calculate additional depreciation here? Very simple, sir. Actually, sir, if you take the old machinery, the real book value on 1st January, how much, sir? 1,50,000. On this, if I provide 10% depreciation for 6 months, can you tell me how much? 7,500. That means this is the depreciation they provided in the books. Correct? But the asset value was revalued. What is the revalued amount? 1,80,000. So if I provide depreciation on 1,80,000 for 10% into 6 by 12, what will be the depreciation? 9,000 I need to provide. So therefore understand, actually see here, if you provide, already see this is provided in the books. As a subsidiary company, we have provided depreciation on this, because the original book value 1,50,000 in the beginning. So on this 1,50,000, if I provide 1 year 6 months depreciation for 10% for 6 months, it will be 7,500. Okay, and now I revalued the amount at 1,80,000. On this 1,80,000, if I provide depreciation for 6 months, it will be 9,000. Therefore, how much is the additional depreciation I need to take? 1,500. Now, because of this additional depreciation, my post-acquisition profits will come down. So 34,500. What is this? Post-acquisition profits. And this post-acquisition profit is nothing but revenue profit, because that is P&L account I am analyzing. So it's a revenue profit. So you understood? Sir, some students will get a doubt. Sir, asset value increased by 37,500, sir. Can I apply 37,500 into 10%? 3,750. Can I say this is my additional depreciation? No. No. Suppose 3,750 into 6 by 12. How much? Wrong this is. See, understand, don't consider like this. Because asset value increased this much, I will provide depreciation on this additional amount. Don't take it. If you do like that, it is a wrong answer. You think sensibly. Originally in the subsidiary company 1,50,000 is the book value in the beginning. On that 1,50,000 they provided depreciation 10%, and if it is for 6 months it will be 7,500. Correct? Now suppose instead of 1,50,000 if it is 1,80,000, what will be the depreciation? 1,80,000 into 10% for 6 months, 9,000. So therefore you already provided 7,500, but we need to provide 9,000. Therefore 1,500 is the additional depreciation. 1,500 is the additional depreciation we need to provide. So this is the important point you need to understand here. So therefore everything we analyzed now. Revaluation profits, general reserve, P&L account, everything we analyze. Next one is what? Apportionment of profits. Correct? So step number 4, apportionment. So can you tell me the apportionment, how it will be done? Pre-acquisition profits are capital profits, post-acquisition profits are revenue reserve, revenue profit. Correct? Now first we have what? Revaluation profit. Revaluation profit, how much came? Entirely pre-capital profit. Next, general reserve. Entirely we assumed capital 1 lakh. Now P&L account we analyzed it just now. See this, in P&L account 10,000. See this, 10,000 is a pre-acquisition profits, and also this 36. Total 46,000 is pre. And next one is, see this, 34,500 is what? Post-acquisition. Correct? 34,500. Therefore, if I make a total, how much is the total of the capital profit? 183,500. Revenue reserve nil. What will the revenue profit? 34,500. Now, if I apportion it between A limited and minority interest. A limited how much, sir? 80. Minority interest 20%. So can you tell me the total balance? 146,800, 36,700. This one 27,600, 900. That's it. So what is the treatment here? Parent company share in the pre-acquisition profits will be reduced from cost of control. Step number 6. Parent company share in the post-acquisition profits will be added to step number 8. Minority interest entirely will be added to minority interest balance, step number 5. Now calculate minority interest, sir. Minority interest how much, sir? 20%. Can you tell me the share capital? 2 lakhs in the subsidiary. Correct? On that to 20%, 40,000. Okay. And also minority shareholders share in the capital profit as per step number 4. And also minority shareholders share in the revenue profit as per step number 4. 36,700, 6,900. Correct? So total 83,600. And also next is cost of control. Important, sir. First take cost of investment. Can you tell me what is the cost of investment? 3,40,000. From this I need to reduce what? Pre-acquisition dividend. Pre-acquisition dividend. What is the pre-acquisition dividend given? 16,000. Because total dividend I think 20,000. Correct? In that 80% belongs to parent company. So 16,000 minus it. 3,24,000. And we need to compare with what? Parent company share in net assets. Correct? Share in net assets of S Limited on the date of acquisition. So share capital 2 lakhs into my share as a parent company 80%. And also on the date of acquisition, what is the capital profit in that the parent company share? Already we calculated. So 2 lakhs into 80%, 1,60,000. And what is the pre-acquisition profits? 1,46,800. 146,800. So can you tell me the total? That's it. 3,06,800. So therefore, how much excess we spend? Goodwill 17,200. So sir, these are all repetitive questions, sir. Same thing we are doing. Every time you cannot put a face like question mark. Same concept again and again I am teaching. Please understand. I am comparing cost of investment with parent company share in the net assets of subsidiary company. Net assets on the date of acquisition, share capital plus reserves and surplus. Reserves and surplus means capital profits on the date of acquisition. In the capital profits, what is share? Step number 4 already we done. So parent company share in the pre-acquisition profits plus share capital, our share. I will get net assets. Okay, goodwill. Now step number 7, any intercompany owings? No. Next, step 8, reserves for consolidated balance sheet. Reserves for consolidated balance sheet. Can you tell me what reserves are there in the parent company? General reserve, P&L account. What is the balance is given? Parent company balance is given 2,40,000. Capital reserve is there? No. Goodwill came na? Yes. P&L account? Yes. Now what adjustments you do? Tell me first. Parent company share in the post acquisition profits. Correct? Share in post acquisition profits. Step number 4. Sir, in step number 4, what is the parent company share in the post acquisition profits? 27,600 relating to RP. RP means revenue profit. That means it is taken to P&L account. And also next one more adjustment, sir. Pre-acquisition dividend. Pre-acquisition dividend wrongly credited to P&L account by the parent entity. So less pre-acquisition dividend wrongly credited to P&L account. Actually here parent company received dividend from subsidiary company from pre-acquisition profits. That has to be deducted from the cost of investment, but they have included in P&L. Minus it. How much? 16,000. That's why we deducted in cost of control step also. 2,40,000. This one 68,800. So reserves for consolidated balance sheet also we got. Next we need to prepare the balance sheet. So balance sheet you prepare, sir. Very easy. Nothing great is there. But in the balance sheet, what are the items will come? Goodwill will come. You need to write goodwill. Extra intangible asset, goodwill we need to write. Reserves for consolidated balance sheet also we have done. Sir, this is not a new sum, sir. See this. If you want to solve this scenario based question, sir, first you solve illustration 13. Yesterday we solved illustration 13. Same question here. Nothing great. Revaluation of assets concept. And dividend wrongly adjusted. And here where there is a chance that you may do a mistake, additional depreciation. Additional depreciation point you understood? Additional depreciation point. That is the only point. Remaining and all same. This is scenario based question 9, sir. Now we are going to see the consolidated P&L account. Till now we have understood and we have solved the questions relating to consolidated balance sheet. Now how consolidated P&L account is prepared? So very simple, sir. Consolidated P&L account. In your study material there are 2 or 3 questions are there relating to consolidated P&L account. So we cannot take a chance. So you may ask consolidated P&L account also, just for change. So why always want to test consolidated balance sheet? Let's change it to consolidated P&L account. Suppose if at all he asked a question relating to consolidated P&L account, you should be in a position to do it now. So that's why we need to discuss it. Very simple, consolidated P&L account. So let us discuss consolidated P&L account. See this. Sir, first of all, understand, sir, in balance sheet, consolidated balance sheet, what we have done, sir? Parent company, subsidiary. Added. Assets, liabilities added. And cost of control we have calculated. Minority interest we calculated. Reserves for consolidated balance sheet we calculated. Everything we adjusted. Same manner, take the parent company P&L. Take the subsidiary company P&L. Start adding line by line, item by item. First, parent company revenue from operations, subsidiary company revenue from operations, parent company other income, subsidiary company other income. Expenses, take each expense, parent company expenses, subsidiary expenses. But only important point you need to remember is, any intercompany transactions are there, we need to eliminate. Suppose parent sold goods to subsidiary. Parent sales included the sales made to subsidiary. Subsidiary purchases includes goods purchased from parent. Both will be eliminated. Why? Because parent and subsidiary now becoming single entity. I can't make sales to myself. I can't make purchases myself. For example, parent company paid rent to subsidiary company. That means parent company point of view expenses, subsidiary point of view income. So we need to eliminate from the income as well as expenses. So like that. Everything is very simple. And you remember the format of P&L account? Tell me, as per schedule 3, what is the format? Revenue from operations, other income, total, expenses, cost of materials consumed, next purchase of stock in trade, change in inventories of finished goods, work in progress, stock in trade, next employee benefit expenses, next finance cost, next depreciation and amortization, next other expenses. Then total revenue minus total expenses, you will get profit or loss for the period, right, before tax, from the tax expenses. Same format here also we will follow. At least for consolidated balance sheet, we got minority interest. Here there is no extra item in the consolidated P&L. Regularly, how we are prepare the P&L account of a company as per schedule 3, same manner we will prepare. There is no difference here. Okay. So see this, some small notes of mine I am showing here. So consolidated P&L account. A consolidated P&L account combines the incomes and expenses of the parent and its subsidiaries. Incomes and expenses. Assets, liabilities over. Now incomes and expenses. Presenting the financial performance as a single economic unit. In the beginning of this chapter I told you, sir, what is consolidated financial statements? Financial statements for the group by presenting them as one single economic entity. By presenting them as one single economic entity, right? Here also I want to know the financial performance. If I want to know the financial position, I will prepare balance sheet. If I want to know the financial performance, I will prepare P&L account. Okay. Now in P&L account, revenue, if you take revenue, what is the first item? Revenue from operations. Generally revenue from operations includes sales, services, sale of goods, sale of services, and any other operational income generated by the group. But remember guys, see this, eliminate intercompany sales to avoid double counting. Intercompany sales you need to eliminate. Intercompany sales. That means between parent and subsidiary, whatever sales happen, eliminate. Why? Because they are not revenue for the group. Sir, parent sold goods to subsidiary, sir. Parent individual financial statements, that is income. But if parent and subsidiaries become one entity, how goods sold by parent to subsidiary will be revenue? Because they are treated as one entity only, na? Therefore eliminate intercompany sales. Same other income also. In revenue, next one is other income. Generally in other incomes, what will come? Interest, dividends, rental income. But eliminate intergroup dividends and incomes from intragroup loans. For example, parent company paid consultancy fees to subsidiary company. Parent point of view expenses, subsidiary point of view income. Eliminate both, because now they are treated as one entity. Similarly, suppose subsidiary company gave loan to parent. Parent company paid interest. So parent expenses, subsidiary income, other income, eliminate. So simple. So the crux is simple, sir. Take parent, take subsidiary, add. Intercommon, eliminate. Similarly for expenses also. Expenses are cost of materials consumed. Cost of materials consumed. And if you remember schedule 3, I told you how to calculate cost of materials consumed. Opening stock plus purchases minus closing stock. Raw material consumption. And remember guys, when you are calculating the cost of material consumed, any direct expenses incurred in manufacturing or procuring of the goods sold, that will also be added to the cost of material consumed only. So when you are solving the questions, they will give you manufacturing expenses. Add them to the materials consumed. How to get material consumed? Opening plus purchases minus closing. And also change in inventories of finished goods. Change in inventories of finished goods means opening, closing. Opening minus closing. And eliminate any unrealized profit in closing inventory on intercompany transactions. Intercompany transactions, unrealized profit in closing inventory. Just now we solved one question. So when parent company sold goods to subsidiary, the stock is there with whom? Subsidiary. In that stock there is unrealized profit we are eliminating. So eliminate it. Because the change in the inventories you are reflecting in P&L account. So if the inventory value is adjusted, obviously P&L account is also affected. Hello? For example, sir, your opening stock balance 100 sir. Closing stock 120 sir. So what is the difference? Minus 20. Suppose for example, if your closing balance includes unrealized profit, I eliminated 5. So it will be 115. Therefore, now the change will be minus 15. The change in inventories of the finished goods, work in progress, stock in trade we are showing in P&L account. Na? So if there is any intercompany transactions between the parent and subsidiary, now in that stock, whatever the unrealized profit is there, that unrealized profit you need to eliminate. Like how we eliminated in the consolidated balance sheet. Same manner in P&L account also, in the inventory, unrealized profit eliminate. Remaining inventory you consider for change in inventories, adjustment. Similarly, finance cost. Finance cost means interest. Any interest on borrowings and other finance related expenses. Eliminate interest on intra-group loans. Parent given loan to subsidiary, subsidiary given loan to parent. So on that whatever the interest generated, eliminate it. And other expenses also. Any other administration expenses, selling expenses, distribution expenses. Remove any intercompany changes. Intercompany changes. So tell me, sir, what is the main point when you are solving P&L account, when you are preparing consolidated P&L? Intercompany owings, intercompany expenses, intercompany incomes, eliminate. So because they are not relevant when you are preparing consolidated P&L for the parent and subsidiary together you are preparing. So they are treated as one entity. So between parent and subsidiary, whatever happened which is already incorporated in their books, we will eliminate and we will consolidate. So I think that is the only point, sir. Remaining and all very simple. And how the balance sheet of the company is prepared, the P&L account of the company is prepared, sir. First I told na incomes we show revenue from operations, then other income, total. Expenses, first cost of materials consumed, second purchase of stock in trade, next change in inventories of work in progress, finished goods, stock in trade, next employee benefit expenses, finance cost, depreciation, other expenses, then total. So total income minus expenses, you will get profit before tax. From that, if you reduce tax expenses, you will get profit after tax. Okay, that's it, sir. Very simple explanation, sir, relating to P&L account. See this, just one paragraph is there. In consolidated balance sheet, there is a big discussion, but in consolidated P&L account, there is no much discussion, sir. What they are giving here, all the items of P&L account are to be added on line by line basis, and intercompany transactions should be eliminated from the consolidated figures. For example, parent company may sell goods or services to subsidiary or receive consultancy fees, commission, royalty, etc. These items are included in the sales and other incomes of the holding and in the expenses of the subsidiary. Alternatively, the subsidiary may also sell goods or services to parent. These intercompany transactions are eliminated in full. This is the only point you need to remember. And if there remains any unrealized profit in the inventory of any of the group company, such unrealized profit is also eliminated from the inventory. I also explain the logic. Because when parent sold goods to subsidiary or subsidiary sold to share, subsidiary sold goods to parent, whatever the inventory is there, that inventory is there within the group only. Therefore, in that inventory, whatever the profit is there, that we need to eliminate. And also, whatever the profit recognized, that is also to be eliminated. Okay, that's it, sir. So now what we are going to do is, we are going to solve the questions relating to consolidated P&L accounts, sir. Okay. See, regarding consolidated P&L, sir, come to 11, sir. 11. 11th question. No, 11th. Illustration, any question is there? Go to illustration first. Go to illustration. In that, I think 15. Yeah, 15th question is consolidated P&L. Illustration 15. Come to illustration 15, everybody. Hello? Come to illustration 15. Illustration number 15. See this question. H Limited and its subsidiary S Limited provide the following information for the year ending 31st March 2013. H Limited rupees in lakhs, S Limited rupees in lakhs given, sir. Sales and other income given. Increase in inventory, closing less opening, raw material consumed, wages and salaries, production expenses, admin expenses, selling and distribution expenses, interest, depreciation. Okay. Now finally, if you see the final line, what is the requirement? Prepare consolidated statement of P&L account. Say this. Prepare consolidated statement of P&L. Okay. Look at what other information given, sir. H Limited, parent company, sold goods to S Limited 120 lakhs at cost plus 20%. Okay. That means H Limited sales we need to reduce 120. H Limited sales we need to reduce 120. Correct? Because these are intercompany sales, sir. Parent sold goods to subsidiary. Is it revenue for the group? No. Within the group only the sale happened. So it is not a revenue. So from the parent company sales we need to reduce 120. Sir, actually parent sold good to subsidiary means subsidiary purchased those goods, sir. Therefore from the subsidiary company purchases also we need to reduce 120. Hello? Next. Inventory of S Limited includes such goods valuing 24 lakhs. So tell me, sir, when parent company sold goods to subsidiary, in that stocks still 24 lakhs worth of stock remains unsold. So what I told you, in that stock whatever the unrealized profit is there, that profit has to be eliminated. That profit has to be eliminated. Okay. Next. Admin expenses of S Limited include, S Limited admin expenses include 5 lakhs paid to H Limited as a consultancy fees. Sir, subsidiary company administration expenses include 5 lakhs which is paid to parent company as a consultancy fees. That means subsidiary point of view, admin expenses. Parent point of view, consultancy fees, other income. So from the parent company other income, in the subsidiary company administration expenses, I need to reduce 5 lakhs. Correct? Next. Selling and distribution expenses of the H Limited include 10 lakhs paid to S Limited as commission. Sir, selling and distribution expenses of parent company includes 10 lakhs paid to S Limited. That means parent point of view, expense. Where it is included? Selling and distribution. And subsidiary point of view, commission, other income, 10 lakhs. So therefore, subsidiary company, other income, parent company, selling and distribution expenses. We need to remove how much? 10. Because this is not an expense, this is not a revenue. Eliminate. Wherever it is incorporated in both the company parties, eliminate it. And also, next, H Limited hold 80% equity share capital of 1000 lakhs in S Limited prior to 11-12. Okay. H Limited took credit to its P&L the proportionate amount of dividend declared and paid by S Limited for the year 11-12. Okay, not a problem. So whatever the dividend declared by the subsidiary company to the parent company take it to the credit of P&L account. Okay, because we acquired subsidiary company prior to 11-12 only, na? And they have given dividend for the year 11-12. Obviously, it is our income. That income we will credit to P&L account. Prepare the consolidated statement of P&L. So they are asking us to prepare the consolidated P&L account. So very simple question, sir. Not at all great. So, but the only thing is that you should get a clarity how I am presenting the things. Presentation is very, very important. So can you tell me the number of the question? Illustration 15. So consolidated P&L account of H Limited, H Limited and its subsidiary S Limited for the year ending 31st March 2013. Now particulars, note number, amount, correct? Note amount rupees in lakhs. Now when you are preparing P&L account, first you need to start with what? Incomes, correct? In incomes, what is the first one? Revenue from operations. Revenue from operations, note number 1. Second, sir, other income, note number 2. Then total, correct? Total income 1 plus 2. Okay, next expenses. Expenses, sir, expenses. Tell me expenses, what items are there? Cost of materials consumed. Cost of material consumed is there. Note number 3. Next, purchase of stock in trade. There no. Change in inventories of finished goods. There. Note number 4. Note number 4. Okay. 1 minute, sir. Other income not there. Yes. So when other income is not there, don't take it. Don't unnecessarily write. So I think we have only revenue from operations. So then cost of material 3, change in inventories. Cost of materials 2, change in inventories 3. So cost of material consumed, purchase of stock in trade is not there. Change in inventories of finished goods is over. Next one, employee benefit expenses. Correct? Employee benefit expenses there. Yes. Employee benefit expenses. Employees benefit expenses, wages and salaries is there. Parent subsidiary. So I will take 4. Next, finance cost is there. Finance cost, take it. 5. Next, depreciation and amortization there. Note number 6. Next, other expense. Other expenses are there. Yeah, selling and distribution is there. Admin, all these things. 7. Right? So then total expenses. So total income minus total expenses. Total income minus total expenses. So what you are going to get? Profit before tax. Tax is there. That is profit before tax. So tax is not there. So profit for the period. Directly I can write profit for the period. 1 minus 2. Sir, please understand, sir, in examination first you need to write the format well. So many of the students thinking that these are all not important. Just understanding the concept is important. Concept you understand, but at the same time you need to get the marks in examination. For that you need to write. So some students are, they don't write all these things. Even they don't practice also. At least you need to practice once. You need to write the format once. And then go to the exams. In examination, suppose this question came, if you don't have the practice, obviously you are going to miss so many items. So therefore you need to write. Okay. Then notes to accounts. Some students, what they will do now, they don't write notes to accounts. Directly they will calculate on the calculator and write the amounts. Whether the person who is correcting the paper will come to your house and you will check the history of your calculator, whether you done all calculations or not. Will he verify? No. Only proof that you have written something is the paper. Whatever you know, write it on the paper. Secondary thing, whatever you know means not all other unnecessary stuff relating to this question. For example, revenue from operations. Don't calculate amount. You won't get marks. You need to prepare note. If you prepare the note, give the breakup, then only marks will be allotted. So schedule 3 is not a dustbin. Most of the students are thinking that balance sheet P&L account is a dustbin. Whatever the items they want to write, they will write. Share capital, SC. They will write SC. In that SC, they will write total authorized share capital. I told you, as per schedule 3, number of shares, face value, we need to disclose. Now what students are doing? ESC, equity share capital. SC, ESC. They don't write authorized share capital, issued, subscribed, nothing. Directly he will write 1 lakh into 10. 10 lakhs he will write. As if it is a mathematical paper. Sir, you are preparing financial statements, sir. Financial statements means what, sir? For whose understanding you are preparing that? For your understanding, users. There are some users, investors for this company. They will look at the financial statements, not you. So therefore, people with reasonable knowledge must need to understand your financial statements. Not that your answer sheet will be sent to the department, narcotics department. They will check it. What is this paper? Harappa, Mohenjo-daro, Japanese, Chinese language. We don't understand the language because he doesn't know what is schedule 3. Why he is preparing the balance sheet? From his point of view, amounts are important. No, sir. Who said, sir? Amounts not important, sir. Presentation, sir. Presentation important, sir. Please understand. Especially when you are preparing the financial statements. Okay. So in examination, don't write shortcuts. Suppose in a particular answer, same word is repeating number of times. First time you write the full word, in brackets you write the short form. And then you use the short form. That's the way. In the beginning itself, SAR is using only shortcuts. SAR says SC. What is this SC? It is a scheduled caste, scheduled tribe. What is that? His point of view, sir, SC means share capital, sir. You doesn't know, I don't know. So please understand, sir. Sir, some points everybody will understand. For example, sales, if you write S, who will understand? Sales you have to write fully, na? So too much shortcuts you cannot do in the examination. For that, practice is required. And this many notes to accounts, 7 notes to accounts. Sir, is it required? Required. Sir, I will take the calculator and I will write. He will allot marks in calculator also. He won't allot it on the paper. Are you comfortable? No. You want marks public, but you write, you do all answers in calculator, in your brain. You don't present. And you want marks. Not possible, sir. Please understand. So, whatever you want to do, perform in the examination paper. Okay. See, what happens is, sir said, whatever I know, I have to show it in my answer sheet. Okay, let's take number of papers. Addition, writing, this much answer sheet. No use. Just content without any substance. What is the use? Tell me. Okay. So I still remember when I'm writing CA foundation. So at the time there was descriptive papers are there, not MCQs. So there is a paper called Organization and Management. OM, Organization and Management, one paper is there. One student, one person before me, he has taken 10 editions. Edition he is taking. In my life, not even one time in entire my CA journey, I have taken edition. In that booklet they will give, that itself is more than sufficient for me. At least if I write 20 pages, that will be, super, 20 pages I have written here. But that fellow has taken editions and editions. I look at him and I shocked. What he is writing, I am unable to write anything. And after the result, I checked, I passed, I checked his paper. In that O&M he got 5 marks. 5 marks. Not per that per paper 1 mark means he will get 40. So that many papers he has taken. But he got only 5 marks. What is the use? That means if you just write the content without substance also, there is no use. Please understand. Okay. So notes to accounts. So notes to accounts, sir. Now if I start preparing the notes to accounts. So first notes to accounts is relating to what? Revenue from operations. Revenue from operations. Check the answer, sir. Everybody check the, check the solution, question given. What are the revenue from operations, sir? See this, sales and other income, correct now? So sales and other income. Sales and other income, sir. Can you tell me H limited? 5,000. S 1,000. Total 6,000. But understand, whether this 6,000 is revenue for the group? No. Because within the 6,000 there is intercompany sales. So see this, from that we need to reduce less sales made by H limited to S. Sir, yes, H limited made sales to S limited, sir. Tell me, sir, how much sales done by H to S, sir? 120. So this 120 is not revenue for the group, no, sir? Okay, so remove this. Next. And also, if you see the question properly, sir, in this is administration expenses of S limited include 5 lakhs paid to H limited as a consultancy fees. That means other income, nothing but. So in the parent company books, other income includes consultancy fees, which is paid by whom? Subsidiary. So this 5 lakhs is also not revenue for the group, na? Because this is paid by your subsidiary. And parent and subsidiary is one entity only, correct? So therefore, from this I need to reduce what? Consultancy fees. Because in this 6,000, the consultancy fees is also included. Parent company, other income. Consultancy fees actually paid by whom? S limited to H limited. How much? 5. Remove it. And also one more thing, sir. See this. Selling and distribution expenses of H limited include 10 lakhs paid to S limited as a commission. That means subsidiary company other income includes commission received from parent. This is also not revenue for the group, na? So therefore we need to eliminate this also. Less commission. And this commission paid by whom? Parent to subsidiary. Therefore in the subsidiary company other income, commission of how much is there? 10. Eliminate it. So therefore understand, total 6,000, sir. In that within the group there is a revenue. 120, 510. Eliminate it. So what is the revenue from operations? That's it. This is revenue from operations. 5,865. So I need to show here 5,865. 5,865. Okay. Now come to the expenses, sir. What is the expenses? First one, sir. Cost of materials consumed. Important, sir. Cost of materials consumed. Cost of materials consumed. In the question, if you see, sir, what are the cost of materials consumed, sir? Raw material consumed they have given. See this. So 800, 200. 800, 200, sir. See this. So cost of materials consumed, H limited how much? 800. S limited how much? 200. Okay. Total 1,000. Now important adjustment, sir. See, cost of materials consumed means what? Opening plus purchases minus closing. That means purchases also included now. But in these purchases, there is intercompany purchases. See this. Parent company sold goods 120 lakhs to subsidiary na. That means subsidiary company purchases includes this 120 lakhs. We eliminated from the parent company sales, group sales, and at the same time expenses we need to eliminate na. So less purchases. How much we need to eliminate? 120. If you want clear clarity, sir, you can write like this. You can write S limited purchases how much? Sorry, S limited cost of material consumed how much? 200. In that purchases included, right? But purchases made from parent, how much is there? 120. Remove this. Take only 80. These are outside purchases which is relevant for the consolidated P&L. So therefore it will be 880. And also important things here, I told you any production expenses generally will be included too. So materials consumed. So add production expenses. Production expenses, H limited how much? 200. S limited 100. Total 300. So total 1180. So 1180. Understand, there is a chance that you may do mistake here. So how we got cost of materials consumed? H limited 800. S limited cost of materials I need to reduce purchases because these purchases are made from parent H limited. So we eliminated from H limited incomes. Therefore from S limited purchases also we need to eliminate. These are intercompany transactions. Correct? And also production expenses please add to cost of material consumed. So 1180. Next, change in inventories of finished goods. Change in inventories of finished goods. Change in inventories of finished goods. Important, sir. Sir, generally what is change in inventories of finished goods? The difference between the opening and closing. So look at the opening stock, look at the closing stock, sir. Actually they have given directly, sir. Increase in inventory. In that name they have given. See this. So increase in inventory they have given, sir. Difference how much, sir? H limited 1000. S limited 200. Correct? Now if you see the question carefully, sir, in this question parent company sold goods to subsidiary na. That means in that goods still how much inventory is there with S limited? 24 lakhs. So therefore understand, in S limited what is the increase in inventory? 200. Not 200. 200. Correct. In this 200, sir, there is a inventory which is purchased from parent. In that inventory there is unrealized profit that has to be eliminated from the inventory value. So therefore if I eliminate unrealized balance, how much I will eliminate? Tell me. See, actually 24 is there. Correct? And parent company sold goods to subsidiary at cost plus 20%. That means this is equal to 120. How much is 20? So 24 into 20 divided by 120. 4 is the unrealized profit I need to eliminate. And I will take 196. 196. So therefore it will be 1196. This is what? Change in inventories of finished goods. So you need to compare, you need to take change in inventories opening minus closing stock. And here you need to eliminate unrealized profit. Why you are eliminating unrealized profit? When parent sold goods to subsidiary, the stock is there with subsidiary. In that stock, whatever the unrealized profit is there, you need to eliminate. So eliminated. So 1196. Next, employee benefit expenses. Come to employee benefit expenses, sir. So employee benefit expenses 4. Employee benefit expenses H limited 800. Yes. Any change? Nothing. So total 950. Correct? And also next, I think Finance cost is there now. Finance cost is there. Interest nothing but. H limited how much? H limited 100. Yes, 50. Any adjustments? Nothing. 150. So employee benefit expenses 950. Finance cost 150. Next, depreciation. So depreciation given a how much H limited? 100. Yes, 50. Total 150. So depreciation also done. Now the next important thing is what? Other expenses. So last one, other expenses. This is very, very important. Can you tell me what are the items which is there in other expenses? Admin expenses, selling and distribution expenses. Correct? So first I will take admin expenses. So admin expenses, if you take, sir, 200 parent company, 100 subsidiary company. Correct? But if you read the lines below the information, admin expense of S limited include 5 lakhs paid to H limited. Therefore from the S limited admin expenses I need to remove 5 lakhs. So therefore admin expenses, H limited how much? 200. S limited how much? 100. From that, so consultancy fees I paid na, nothing but paid to H limited 5, eliminated, take only 95. Total 295. Now similarly one more thing is what? Selling and distribution expenses. Same. In the selling and distribution expenses, parent company 200, subsidiary 50. But see, selling and distribution expense of parent include 10 lakhs paid to S limited as a commission. That means parent company selling and distribution expenses includes 10 lakhs. So therefore selling and distribution parent how much, tell me? 200. In this 200 how much we paid to S limited? Remove it. Paid to S limited is not an expense for the group. So 10 you eliminate, take only 190. Now next S limited 50. Total this is 190, this one 50. So 240. So total 495 plus 535. Correct? So 535. So I will take 535. Depreciation, amortization 150. That's it. Can you tell me the total of expenses? Total of all expenses. Total of all expenses. You are not at all observing here. See here, change in inventories we need to put minus symbol. Why? Because closing is more than opening. Generally opening minus closing. Opening minus closing. If closing is more than opening, obviously it is increases my profit. That's why minus plus. See, incomes minus expenses na. Minus plus this. Therefore this 1196 which is increase in inventories is increasing my profits. This we discussed in schedule 3. Sir, when closing stock is more than opening stock, the difference between opening and closing, opening 100, closing 200, difference is minus 100. Minus symbol. So because clearly given increase in inventory. Increase in inventory means closing stock is more than opening. When closing is more than opening, to that extent my profits will increase. So if you don't put minus symbol, your entire answer is wrong. Please understand. Now you tell me the expenses. 1769. So therefore 5805 1769. 5805 minus 1769. Can you tell me the profit for the period? 4096. This is the profit for the period. Okay. So this is consolidated P&L. Sir, consolidated P&L account, there is nothing to worry. Just parent subsidiary add Any intercompany, eliminate. See, if it is included in the parent company incomes, eliminate. If it is included in the subsidiary company expenses, eliminate. One company expenses, another company incomes. One company income, another company expenses. Eliminate from both the places. And only important thing is, whenever there is any sales between parent and subsidiary, in respect of the unsold stock, any unrealized profit is there, that has to be eliminated. That has to be adjusted to inventory. That is the only important thing. And also any production expenses came, that will be added to the cost of materials consumed. That's it. This is illustration number 15, which is relating to consolidated P&L. Next, problem number 11, sir. Scenario based question, problem number 11. So this question is also relating to consolidated P&L account. Consolidated P&L account question, sir. Relating to consolidated P&L, we have two questions. One question we have already solved, illustration 15. Now one more question is there. In the case scenario based questions, question number 11, Chand and Sitara Limited. So this question is also relating to consolidated P&L. Let's see this question, everybody. Chand Limited and its subsidiary Sitara Limited provided the following information for the year ending 31st March 2014. So there is a company called Chand and its subsidiary Sitara. Their information given, sir. Equity share capital, finished goods inventory as on 1/4/2022. Okay. Next, finished goods inventory as on 31st March 2023. Dividend income, other operating income, raw material consumed, selling and distribution expenses, production expenses, loss on sale of investments, sales and other operating income, wages and salaries, general and administrative expenses, royalty paid, depreciation, interest expense. So these are the items they have given, sir. Sir, look at finished goods inventory, sir. Finished goods inventory, I think they have given information for the year ending 31st March 2014, right? But they have given finished goods inventory 1/4/2022. Finished good inventory as on 31st March 2023. I think they are wrong dates, sir. So you need to consider the correct dates. So change in inventories of finished good. I think this is 1/4/23, sir. This is not 23, sorry. 2013. This is 2014. Okay. Because here this is 2014, sir. So opening inventory given, closing inventory given. The difference we will take it in P&L account as change in inventories of finished goods. So in the question we have opening, closing finished goods. So change in inventories is there. Dividend income is there, which will come in other incomes. Other non-operating income. Other non-operating income is also other income. Operating income is revenue from operations. Raw material consumed, cost of material consumed. Selling and distribution expenses, other expenses. Production expenses, we need to add to raw material consumption. Loss on sale of investments, we need to show in other income only. Negative balance. Sales and other operating income, revenue from operations. Wages and salary, employee benefit expenses. General and administration expenses, other expenses. Royalties, depreciation, other expenses. Interest expenses, finance cost. Okay. So this is the information given in respect of Chand and Sitara. Sitara is the subsidiary of Chand. Additional information you see. On 1st September 2011, Chand Limited acquired 5,000 equity shares of 100 each, fully paid up on Sitara Limited. So Chand acquired 5,000 shares of Sitara. Date of acquisition is 1st September 2011. Okay. Sitara Limited paid a dividend of 10% for the year ending 31st March 2013. The dividend was correctly accounted by the Chand Limited. Okay. Actually, here parent company acquired subsidiary on 1st September 2011. Subsidiary company paid dividend for the last year, 31st March 2013. And whatever the dividend received, they have correctly accounted. So correctly accounted means there is no need to do any adjustment. Next, Chand Limited sold goods of 1,75,000 to Sitara Limited at a profit of 20% on selling price. Okay, intercompany sales we need to eliminate. Inventory of Sitara Limited includes goods of 70,000 received from Chand Limited. Unsold stock we need to eliminate unrealized profit. Selling and distribution expenses of Sitara Limited includes 21,250 paid to Chand Limited as brokerage fees. So we need to deduct from selling and distribution expenses as well as other income, brokerage fees. General and admin expenses of Chand Limited includes 28,000 paid to Sitara Limited as consultancy fees. Parent company paid consultancy fees to subsidiary company. Parent company point of view, it is general administration expenses. Subsidiary point of view, it is included in consultancy fees. So we need to deduct from other income as well as general administration expenses. Sitara Limited used some resources of Chand Limited and Sitara Limited paid 5,000 to Chand Limited as a royalty. So subsidiary company paid royalty to Sitara parent company. So parent company other income, subsidiary company expenses. From both the places we need to deduct. Consultancy fees, royalty, brokerage received is considered as operating revenues. Okay. Sir, consultancy, royalty, brokerage, all are operating revenues, not other incomes. Prepare consolidated statement of P&L account of Chand Limited and its subsidiary Sitara Limited for the year ending 31st March 2014 as per Schedule 3 of the Companies Act. So they are asking what? P&L account, sir. Parent company along with its subsidiary P&L account for the year ending 31st March 2014. So how you are going to prepare the consolidated P&L account, sir? First we will start with revenue from operations. Next, other incomes. Next, total. Next, expenses. What are the expenses we had? Cost of materials consumed. Any purchase of stock in trade? Purchases, nothing. Next, change in inventories of finished goods. Next, employee benefit expenses are there. Next, finance cost. Next, depreciation and amortization. Then, other expenses. So, these are the items. One by one, we need to present, sir. Now, first, if you take revenue from operations, can you calculate, tell me the revenue from operations in this case? Revenue from operations, can you tell me? How to calculate revenue from operations? First we will take sales and other operating income. 33, 25,000, 19, 7,500. Correct now? From that we need to remove intercompany adjustments. So parent company sold goods of 1,75,000 to Sitara. Eliminate that. One thing. Next, selling and distribution expense of Sitara includes 21,250 paid to Chand as a brokerage fees. So this 21,250 we need to reduce, because in the question clearly said that this brokerage fees, royalty, consultants fees are considered as operating revenues. That means they are included as a part of sales and other operating revenue. So 21,250 we need to deduct. And also general and administration expense of Chand Limited include 28,000 paid to Sitara Limited as a consultancy fees. So consultancy fees 28,000 we need to deduct. And also royalty 5,000 we need to deduct. So therefore 4 deductions we need to make. One is sales by parent to subsidiary, second brokerage fees, third consultancy fees, fourth royalty. All these will be eliminated. Here important point is they are all considered. Consultancy fees, royalty, brokerage is received is considered as part of operating revenue. Okay. So this is revenue from operations. See this. This is how you need to calculate revenue from operations. So first sales and other operating, Chand Limited you take, Sitara Limited you need to take, calculate total. From that, whatever the sales made by Chand to Sitara deduct, brokerage paid by Sitara to Chand deduct, consultancy paid by Chand to Sitara deduct, royalty paid by Sitara to Chand deduct. Sir, whoever paid to who doesn't matter, sir. It is included in the total revenue, right? Minus it. That's it. So you will get the total revenue. Okay, next. What is the next one, sir? Other income. So tell me what is other income? How to calculate? So in other income, if you see, dividend income is there in the question. Other non-operating income is also there. So first you take dividend income, 168, 43, 750. Any adjustment to dividend income? Yes. Yes. Okay. Sitara Limited paid a dividend of 10% for the year ending 31st March 2013. The dividend was correctly accounted for by Chand Limited. So 10% dividend they have given, sir. Okay. What is the investment of Chand Limited in Sitara, sir? 5,000 shares of 100 each. 5 lakhs. 5 lakhs into 10%. So how much is the dividend? 50,000. So that 50,000 dividend we need to deduct. See this, Sitara Limited paid a dividend of 10%. The dividend was correctly accounted by Chand Limited. That means it's an intercompany income, right? Subsidiary company given dividend to parent. So group point of view, that cannot be income, na? But this is already included in parent company P&L account. Correctly accounted means what, sir? See this, simple, sir. When parent company acquired subsidiary? 1st September. When for this year, this dividend is given 31st March 2013. Obviously this is revenue or capital? Revenue, which is created to P&L account. Therefore I need to deduct now, because it is no more a income for the group. So I need to deduct it. So therefore from dividend I need to deduct how much? Parent company dividend income 168. In that 50,000 I need to deduct. And add subsidiary company dividend 43,750. So 161, 750. Next, other non-operating income is there now. 35, 10,500. No adjustments. Any other thing? Loss on sale of investment also need to be considered as a part of other income, but negative. See here, loss on sale of investment 26,250 is there. Minus, but minus 26,250. So therefore, 3 items will come in other income, sir. Dividend income, other non-operating income, loss on sale of investments. Okay. So see this. Dividend income, first Chand Limited dividend income you take 168. In this 168, how much is received from Sitara Limited? 50,000. Then add Sitara Limited dividend income. Total dividend income 161,750. And also loss on sale of investment, only Chand Limited is there. Consider it as a part of other income with negative symbol. And then other non-operating income, HS 35, 10,000. So total 181. So therefore other income is also done. So therefore revenue from operations, other income, total we got. Now expenses side, can you tell me what is the cost of materials consumed? Cost of materials consumed, calculate and tell me. See this, materials consumed given 13,93,472,500. But in this consumption purchases also included, right? Here parent company sold goods to subsidiary 175. That means subsidiary purchases includes purchases made from parent. So this 175 we need to deduct. Correct? Like last problem. And also one more adjustment, sir. Production expenses we need to add to raw material consumption. So therefore you take raw material consumption 13,93,000, 4,72,500. In the subsidiary company raw material consumption, purchases made from parent is there. So how much? 175. Parent point of view sales we eliminated, subsidiary point of view purchases we need to eliminate. and then you should add production expenses. See this. See this cost of metal consumed. Raw metal consumption H limited how much? 1393. S limited 472 500. Total 1865 500 minus purchases by Sitara from Chand. Sir, why these purchases was deducted, sir? Why these purchases was deducted? It's a intercompany transaction. It is already deducted from revenue from operations. Hello, this 175 already deducted, and also it is deducted from expenses. And production expenses you need to add to the cost of materials consumed. So 2145 500. Okay. Next, change in inventories of finished goods. Calculate and tell me change in inventories of finished goods. Important. Change in inventories of finished goods, sir. So finished goods opening balance, parent company 4,20,000 given, sir. This is opening balance, this is closing balance. So 857 500 minus 4,20,000. Correct? And also Sitara Limited 3,76 250 minus 3,01,000. You will get change, right? But understand here, goods sold by parent to subsidiary is there. In that there is some unsold stock is there. That unsold stock is there with whom? Subsidiary. In that unsold stock there is an unrealized profit that we need to eliminate. So tell me here, parent sold goods to subsidiary 1,75,000. In that how much is the unsold stock? 70,000. In this 70,000 how much is the profit? 20%. 20% on selling price they have given. Directly you can apply 20% into 70,000 into 20%. 14,000 unrealized profit we need to eliminate. As simple as that. Parent sold goods to subsidiary. In the subsidiary there is an unsold stock which is sold by parent. In that unsold stock there is an unrealized profit. That profit we need to eliminate from the stock, because stock has to be properly valued now. It must be valued at cost. Okay. So see this. See this. First change in finished goods. Closing minus opening. Chand Limited closing stock 857 500. Opening 4,20,000. Sitara opening minus closing. But from this 75 to 50, look at unrealized profit I eliminated. Because this 14,000 I need to reduce from the unsold stock which is sold by parent to subsidiary. So 14,000 we eliminated. Unrealized profit included in the stock. Stock value is at selling price. So I need to brought it to cost. If I need to brought it to cost, I need to reduce 14,000. Sir, is this the same point already came in illustration? 15 also, same point again came. Okay. And this 4,98,750 will you debit to P&L account with negative figure or positive? Negative, sir, because here closing stock is more than opening. 498,750. See this, minus 4,98,750. Always remember, closing stock is more than opening stock, means your profit should increase. So but you are showing on the expenses side, revenue minus expenses, so minus minus plus, so this increase will be added. Okay. Next remaining I think same, employee benefit expenses. You see the employee benefit expenses, very simple now. Parent how much? Employee benefit 13,30,000. Subsidiary 2,45,000. Add both. 13,30,000, 2,45,000. Next finance cost same. Interest expenses 17,500, 5,250. 22,750. Depreciation and amortization 31,500, 14,000. Correct? 45,500. Now come to the other expenses, sir. Remaining other expenses. What are the other expenses we had? General and administration expenses is there. Selling and distribution expenses is there. Now come to selling and distribution expenses. So take selling and distribution. Chand Limited 332 500, S Limited 157 500. But see this, there is an intercompany transaction. So selling and distribution expense of Sitara include 21,250 paid to Chand. So we removed from income. and then we need to remove from the expenses 21,250. See this 21,250. And also general and administration expenses you take, sir. General and administration expenses 2,80,000, 1,22,500. So 2,80,000, 1,88,500. 2,80,000, 1,22,500. Correct? But here in the question they clearly mentioned that general and administrative expenses of Chand include 28,000 paid to Sitara. Remove 28,000. And also we have given royalty, sir. Royalty is there. See this royalty paid 5,000 is there, na sir? Hello? 5,000. This entire 5,000 is paid to whom? See this Sitara used some resources of Chand and Sitara paid 5,000 to Chand. Therefore from Chand Limited income we reduced. Now expenses also we need to reduce. So reduce 5,000. So nil. So 843,250. Okay. 843,250. That's it. So like this you need to present, sir. Revenue from operations, other, materials consumed, change in inventories, employee benefit expenses, finance cost, depreciation, other expenses, total. Then profit or loss for the period. So the notable points is any transactions happen between the parent and subsidiary where it is included. In the parent company revenues it is included, minus it. In the subsidiary company revenues it is included, minus it. One company expenses, other company incomes. You reduce from both the places. First you make the total, parent and subsidiary. From that you reduce it. So reduce it from incomes, reduce it from corresponding expenses also. And there is a chance that you may do mistake in cost of material consumed. Please be careful. Okay. When you are ascertaining the cost of material consumed, add production expenses. And also whatever the purchases made, deduct those purchases because it is already removed from the incomes. Now we need to deduct from the expenses, intercompany transactions. And when you are calculating change in inventories of finished goods, understand the difference between closing and opening we need to take. But if there is a sale transaction happened between parent and subsidiary, now there is an unsold stock. In that unsold stock, whatever the profit element is there, unrealized profit, you need to eliminate it. Important. And sometimes when you are eliminating unrealized profit, he smartly give cost plus 20%. Sometimes he will give directly on selling price. You have to see. In this problem, directly he is given on selling price. See this. 20% on selling price. But in illustration 15 we solved, he has given cost plus 25%, like that. So you need to apply accordingly. If he is given directly on selling price, you need to apply directly. If it is not given, if it is given on cost, you need to convert into selling price and then apply to find out the unrealized profit. Okay, that's it, sir. This is consolidated P&L scenario based question 11. So we have completed consolidated P&L account, sir. Consolidated P&L account, bet me, sir, one of the easiest thing. Only 2 or 3 small adjustments. So my suggestion is you practice those 2 sums once again. I think you will get it. We discussed it. Next thing what we need to discuss is there is one concept called uniformity in accounting policies. What is this? Uniformity in accounting policies. Listen to me carefully. Sir, when parent company, subsidiary company accounting policies are different. Suppose subsidiary company accounting policies are different from parent company. Now you are considering subsidiary for consolidation purpose. Can you consider directly? Hello? Sir, here the problem is, see, suppose there is H limited. This is parent. There is S limited, subsidiary. Now, subsidiary company accounting policies, parent company accounting policies, they may not match, na? Possible. For example, subsidiary company is following weighted average cost method for inventory valuation. But here, parent company may follow LIFO method to determine the cost of inventories. Now the question is, when the subsidiary company accounting policies and parent company accounting policies are not matching, can you consider this directly, this subsidiary company figures for consolidation purpose? If you take directly the subsidiary company figures and do the consolidation, then that consolidated financial statements will not reflect true and fair view. Because your policies are different, their policies are different, and you are trying to prepare consolidated financial statements, which is not reflect true and fair view. There is no uniformity. There is no uniformity. You are following one policy, they are following one policy. For example, see, your company, a subsidiary company is following the policy of creating provision for doubtful debts. But parent companies, there is no such policy for them. Parent company, there is no such a policy. So, when there is no uniformity in the accounting policies, so you cannot directly consider the subsidiary company figures, subsidiary company individual financial statements for consolidation purpose. Then what to do? Simple. First, convert the subsidiary company financial statements in accordance with the parent company accounting policies, and then consider that subsidiary company for consolidation purpose. This is called uniformity of accounting policies. So, at the time of consolidation, if parent company accounting policies, subsidiary company accounting policies are different, parent company accounting policies, subsidiary company accounting policies are different. So, first you need to convert the subsidiary company financial statements in accordance with the parent company accounting policies, and then consider such financial statements for consolidation purpose. Consider such financial statements for consolidation purpose. So that is the concept we are going to learn here. See this. If accounting policies of subsidiary company different from holding company accounting policies, if accounting policies of subsidiary company different from holding company accounting policies, then at the time of consolidation, the financial statements of subsidiary company must be revised in accordance with the accounting policies of the holding company, and then considered for consolidation. Fair enough? Correct only, na? What do you think? Tell me. Correct only, na? Because see, I am the parent entity. If I am acquiring any subsidiary company, if that subsidiary company is following different policies, and if I directly consider those figures for consolidation purpose, whether consolidated financial statements are reflecting true and fair view? No. Because as a parent entity, what are my accounting policies? Being my subsidiary, if I am considering parent and subsidiary as one entity, you should also follow my policies, na? Therefore, first we need to identify what are the differences in accounting policies between parent and subsidiary. Then subsidiary company financial statements must be revised in accordance with the parent company accounting policies, and then consider such financial statements for consolidation purpose. Okay, this is the concept. Now, relating to this, sir, one question is given in the study material, sir. I will show you, important. So, if at all he wants to ask something different from consolidation, there is a chance that this question may appear in the examination. Now come to illustration 16, sir. Illustration 16. Not much theory to discuss, sir. Simply subsidiary company financial statements must be revised in accordance with the parent company financial statements. Illustration 16, sir. Sir, you understand the concept here? So tell me, when parent company, subsidiary company accounting policies are different, will you consider subsidiary financials directly for consolidation? No. What you need to do? First, convert the subsidiary financial statements in accordance with parent company policies, and then consider for consolidation. Okay. See this balance sheet, sir. Subsidiary B Limited. See this. Subsidiary B Limited provides the following balance sheet. Subsidiary company balance sheets given, sir. Okay. 2010 to 2011, 2 years given. Equity and liability, shareholders funds, share capital, reserves and surplus. Current liabilities, we had short-term borrowings, trade payables, short-term provisions given. Asset side, if you see non-current assets, property, plant, equipment, non-current investments. Current assets, you see inventories, trade receivables, cash and cash equivalent, other current assets given. Okay. Next. If you see the notes to accounts, share capital, they have 5,000 equity shares of 10 each fully paid up. Reserves and surplus, they have general reserve. Short-term borrowings, they have bank overdraft. Short-term provision, they have provision for tax. Property, plant, equipment, cost given, less depreciation. Other assets, other current assets, prepaid expenses is there. So this is the balance sheet of subsidiary B Limited. Balance sheet for 2 years given, sir. Okay. Next, what happened, you see, important. Also consider the following information. P Limited is a subsidiary of A Limited. See, B is what? Subsidiary of A Limited. Both the companies follow calendar year as the accounting year. Calendar year means January to December. Okay, both the companies follow calendar year. That means these balance sheets are given on which date? 31st December 2010, 31st December 2011. Correct now? Because they are following calendar years. Okay. Now see the B point. A Limited values. A Limited means parent holding. A Limited values inventory on which basis? Weighted average. While B Limited used FIFO. So there is a difference in accounting policy. Parent company following weighted average, but subsidiaries following FIFO. Next. To bring B Limited value in line with those of A Limited, its value of inventory is required to be reduced by 12,000 at the end of 2010, 34,000 at the end of 2011. Sir, to bring the inventory of B Limited in line with A Limited, there what we need to do, sir? We need to reduce the inventory value by how much? 12,000 by the 2010 year end, 34,000 at the end of 2011. That means these are the changes we need to make in the inventory value of the subsidiary to bring uniformity with the parent company. Because parent company is following which basis? Weighted average. Subsidiary is following which basis? FIFO basis. Okay, first thing. So understand the differences. So this is the first difference, sir. First difference. Next, C point. B Limited deducts 1%. B Limited deducts 1% from trade receivables as general provision against doubtful debts. That means subsidiary company has one policy, sir. That is, they will deduct 1% from debtors as general provision against doubtful debts. But there is no such policy for parent company. See, only that is the meaning, na? They said B Limited is following this. That means definitely subsidiary parent company is not following this. So there is second difference. This is second difference. This is the second difference. This is the first difference. This is the second difference. What is the second difference? Tell me. Subsidiary company has the policy of creating provision for doubtful debts, but parent company does not have such a policy. Okay, that's it. Next, see the third one. Prepaid expenses in B Limited include advertising expenditure carried forward of 60,000 in 2010, 30,000 in 2011, being part of initial advertising expenditure of 90,000 in 2010, which is being written off over 3 years. Sir, prepaid expenses of subsidiary company includes advertising expenditure, sir. And by the end of 2010, how much still advertising expenditure they need to carry forward to the future years? 60. In 2011, 30,000 still need to be carried forward. And this advertising expenditure is nothing but initial advertising expenditure of 90,000 in 2010. So in the year 2010, sir, subsidiary company incurred 90,000 advertisement cost. And this 90,000 advertisement cost, they want to return off how many years? 3 years. Suppose 90,000 divided by 3. Every year 30,000. That means in the year 2010, 30,000 is charged to P&L account. Still how much unamortized? 60. Second year 30. That means by the end of 2011, how much balance do we carry forward? 30. This is the policy of which company? Subsidiary. That means subsidiary company is writing off the advertisement expenditure over a period of 3 years. Now you see in the subsidiary company balance sheet also, other current assets we have prepaid expenses 70 to 48. In this prepaid expenses, advertisement expenditure is also included. And what is the policy of the subsidiary? They will amortize the advertisement expenditure over a period of 3 years. But what parent company will do? See this. Similar amount of advertisement expenditure of A Limited had been fully written off in 2010. But if this advertisement expenditure is incurred by parent company, what they will do? In the year of incurrence itself, they will charge directly to P&L account. But what subsidiary is doing? It is amortizing over a period of 3 years. So therefore, this is the third difference between parent and subsidiary. This is the first difference. This is the second, C point. This is third. Okay. Till now we identified 3 differences between parent and subsidiary. Now what they are asking, look at this. What they are asking. Restate. See this. Restate the balance sheet of B Limited. That means we need to revise the balance sheet of which company? B Limited. That is subsidiary company. Correct? Subsidiary company balance sheet we need to revise. Restate the balance sheet of B Limited as at 31st December 2011 after considering the above information. After considering the above information, we need to revise the subsidiary company balance sheet. For the purpose of what? Consolidation. Because subsidiary company balance sheet is not in accordance with the parent company policies. So we need to convert it. Would restatement be necessary to make the accounting policies adopted by A Limited and B Limited uniform? Yes, this restatement is necessary na? Because we need to match the accounting policies of the parent with the subsidiary. Then only it will be eligible for consolidation. Sir, consolidation means parent and subsidiary financial statements together we are preparing as one entity. If you are one entity, you cannot have 2 different policies. Same policies you need to follow. So that's the thing. Now tell me. Now I need to revise the subsidiary company financial statements. So what you are going to do here? What you are going to do? What is the question number? Illustration 16. Important illustration, sir. This is difference in accounting policies. Only one question is there. Now you see this. First we will analyze the question. Accounting policy. Parent company A Limited, correct? Parent company, what is the policy they are following? Parent company. B Limited, subsidiary company. What is the accounting policy they are following? Parent company, what is the accounting policy? Subsidiary company accounting policy. So in the given question there are 3 areas. There is a difference, right? 3 areas. Okay. First area you tell me. Inventory valuation, correct? Inventory valuation, if you see, sir, parent is following which method, sir? Weighted average cost method. Okay. Subsidiary following LIFO na FIFO na? FIFO. See, this is the first difference, correct? This is the first difference. Now what you do, tell me? What you are going to do? P Limited policy is FIFO. So they need to change to weighted average. If B Limited also follows weighted average, what will be the effect in the financial statements of B Limited? That we need to adjust. Already their financial statements are prepared by considering FIFO. Okay. Next, what is the second area of difference? Provision for doubtful debts, correct? Provision for doubtful debts. Provision for doubtful debts. Tell me, sir, in respect of provision for doubtful debts, parent company, is there any policy? No policy, sir, nothing. What is the policy of subsidiary? 1% they are creating provision for doubtful debts, correct? So 1% they are creating from trade receivables as a general provision for doubtful debts. So this is the second area. Second area. Okay. So therefore now what we need to do, tell me? subsidiary companies following provision, now they need to uniform with A Limited. Therefore, this provision we need to eliminate. If you eliminate, what items of B Limited will affect it, you need to make changes. Right? Next, what is the third area? Prepaid expenses. Correct? As far as the prepaid expenses is concerned, what is the policy of the parent company? Fully written off in the first year itself. Correct? Fully written off. Fully written off in the year of expenditure. Year of expenditure. Now, what is the policy of the subsidiary company, sir? Written off over 3 years. Correct? Over 3 years. So, I think these are the differences, sir. Now, see this. If subsidiary company also written off this expenditure in the year of expenditure, what will be the effect in different items in the balance sheet of subsidiary? We need to adjust. So, these are the changes you need to do. So, therefore, now what we need to do is, what changes you do in the B Limited, you conform with the A Limited policies. Simple. B Limited now follow weighted average cost method. Till now you are following FIFO. Change to weighted average. If that done, what changes we need to do? Now you are following 1% from trade receivables as a provision. Now you don't follow it. Next, you have written off over a period of 3 years. Now you written off in the first year itself. So these are the changes we need to make. Okay. So tell me, generally what items will be affected here? Can you tell me? General understanding. Definitely, see this. Because of the first one, what item will be affected? Inventory. Correct? Inventory is definitely affected, sir. Next, reserves will be affected. When you affect inventory, assets and liabilities, obviously reserves will be affected. So, P&L account will got affected. Next, this one, trade receivables, debtors will be affected. And then, P&L account will also be affected. Because if you reverse the provision, profits will increase. Next, last one you come. Prepaid expenses, other current assets will be affected. Yes, other current assets, and also it will affect reserves and surplus. So in all these three policies, sir, so P&L account, reserves and surplus will got affected, and also the corresponding items, inventory, debtors, so other current assets will also got affected. Now, suppose for example, if you roughly prepare the restated balance sheet, see this. Restated balance sheet of B Limited only for the current year, as on what is the current year? 31st December 2011. Hello, 31st December 2010 given, 31st December 2011 given. We need to current year we need to take. Look at the balance sheet given in the question and tell me the order. First, equity and liabilities. Correct? In that, shareholders funds. Okay, first one, share capital. So tell me, is there any change in share capital? No, sir. Share capital will be remain same. How much, sir? 5 lakhs share capital. Note amount. In exams, generally you need to prepare the note for this. Next one, sir. What are the reserves and surplus given in the question? P and general reserve given. Say this. Reserves and surplus. So here, reserves and surplus. Note number 2. This is very, very important. We need to do. Okay. Next. Next, current liabilities. Correct? General balance sheet, sir. Current liabilities. Current liabilities, what items we had? Tell me. Short term borrowings. Short term borrowings. I think it will not get affected, right? Same we can take 1 lakh 70. Next, trade payables. Is this get affected? Trade payables. Trade payables not affected. Same 4 lakh 94. 4 lakh 94. I think trade payables we can take 4 lakh 94. Next item, short term provisions. See this clearly given, short term provisions. So short term provision, whether short term provisions will get affected, 4,30,000. What is there in short-term provisions? Provision for tax. It is not get affected, na? So same thing we need to take. So 4,30,000. So you see this. I think total. That means liability side hardly which one is affected? Reserves and surplus. Because of those changes. Now come to the asset side. Asset side, assets, first one, non-current assets. What are the non-current assets are there? Property, plant, equipment, PP. Any change in PP? No change, na? PP. So PP. So 5. How much will take? PP 2,24,000 original balance. Correct? Next. Non-current investment is there? Any change in investments? No. Directly. How much? 4 lakhs. Next, current assets. In current assets, first one, inventory will change. Yes, inventory will change because we are changing the inventory value from FIFO to weighted average. So this is one change, sir. Next, sir, trade receivable change. Yes, we are adjusting the provision for debtors. So 7. Next, cash and cash equivalents change. No change. How much? 3,000. Next, other current assets change. Yes, prepaid expenses will adjust it. So this is 8 total. Therefore, common sense, Nana. Common sense. What are the differences between parent and subsidiary? And if those differences, I will confirm with the parent what changes I need to do. So therefore, entire balance is same. Here reserves and surplus will be changed. That's why I keep it blank. Now I need to calculate. Now coming to asset side, sir, inventory will change. Trade receivables will change. Other current assets will change. Okay, these things. Now we will do the notes to accounts. So notes to account, share capital, you know, equity share capital we will write. That's okay. Only changes we will do. So reserves and surplus, you come first. So notes to accounts. In notes to accounts, the first one is what? Share capital over. Next, reserves and surplus. Now you tell me, coming to reserves and surplus, what will be the balance given in the subsidiary company? General reserve given, na? How much given? This is original reserve, correct? 7,14,000. 3 changes you need to do. First change, inventory valuation changes from FIFO to weighted average. Now in the question, go and read. In order to bring the change, how much inventory value we need to reduce? 12,000 for the year last year. This year, that means, can I say my inventory value, how much I need to reduce directly given? So less reduction in value of inventory. How much reduction in value of inventory we need to do? Now 34,000 this year end. Last year end will you deduct? Sir, understand, sir, read the question carefully. See this. The A limited values inventory on weighted average, B limited FIFO. To bring B limited values in line with A, its value of inventory is required to be reduced by 12,000 at the end of 2010 last year. 34,000 at the end of 2011. Now you are revising the financial statements for 2011. So tell me, how much inventory we need to reduce? Current year 34 or last year 12? Current year 34. Why we are bothered about last year 12? Because he has already given, in order to bring with parent company policy, directly you deduct 34. That's it. Last year 12,000 I will deduct. Doesn't matter. I want current position, current year financial statements. Some students will say, sir, last year 12,000 if I deduct, last year closing stock deducted, next year that will become opening stock. So again that will deduct, that will reduce my current year profits. That's a wrong way of analyzing the things. Because in the question, he clearly mentioned the final adjustment. His intention is, see, if you reduce 34,000 from the end of 2011 general reserve, that's it. That's it. You brought to the value. Therefore, here see this 34,000 I need to deduct. One deduction I will make in general reserve, another deduction I will make in inventory. 34,000. Okay. Next, provision for doubtful. Sir, provision for doubtful debts, I need to what? Add back. Provision for doubtful debts. Now tell me how much is the provision for doubtful debts? 1%, na? Hello? In the subsidiary company, how much is there? Debtors, trade receivables. See this, 8,91,000. This is after 1% provision, correct? So, see this, 8,91,000 is for, to bring it to 100, minus 8,91,000. So, what is the provision we created? 9,000. Add back, provision reversed. Provision reversed. If you reverse the provision, what happens? P&L, reserves will increase and corresponding asset will be changed. Correct? So provision for doubtful debts 9,000. Next, what is it? Another change, sir. Advertisement expenses. Sir, if advertisement expenses, which year they incurred advertisement expenditure? 2010. See this, 2010. How much incurred? 90. So first year how much you written off? 60. Second year 30. First year 30. Second year 30. Third year 30. Now you are at the end of which year? Second year. So by the end of second year, out of total advertisement expenditure of 90,000, how much already written off? 60. Therefore, what is the balance to be carried forward? 30. That we will written off now. Very simple, sir. In the question, you see subsidiary company writing off advertisement expenditure over a period of 3 years. See this, they will written off over a period of 3 years. Actually, in the year 2010, how much is the advertisement expenditure they incurred? 90,000. Right? 90,000 advertisement expenditure they incurred. Divided by 3, that means every year 30,000. So 2010, 30,000 written off to P&L. 2011, 30,000 written off. Now you are at the end of 2011. So at the end of the 2011, still how much balance is there? That is included in prepaid expenses. In this 48,000, still 38,000 is there. Remove it. Because parent company policy is what? Writing off everything in the year of incurrence itself. Now you are in 2011. Whatever the balance still need to be amortized. Remove it to confirm with the parent company policy. Total 90,000. First year 10,000, 30,000 already written off. Second year you are at the end of second year. Second year already 30,000 written off. So what is the balance to be written off? 30,000. Now you written off it. So therefore, if I remove the entire prepaid expenses, what is the entry I will write? P&L to prepaid expenses. P&L to prepaid expenses. Because prepaid expenses I am treating it as asset na. So this asset will be cancelled. P&L account will be debited. P&L account in the sense general reserve. Hello. So therefore, here what I will write? Less 30,000. Sir, have you understood this? Less prepaid expenses. That is advertising expenditure written off. How much you will written off? 30,000. Deduct. Sir, very simple, sir. Subsidiary company in the year 2010, 90,000 advertisement cost they incurred. Their policy is to write off 3 years. Divide by 3. That means every year 30,000 they will transfer to P&L account. That means 2010 they transfer to 30,000 P&L. That means at the end of 2010, how much is the unamortized balance? 60. Now in the year 2011 they transfer to P&L account 30,000. Therefore at the end of 2011 still how much balance is there? 30. That you written off now. Because in order to confirm with the parent company policy. What is the parent company policy? Write off the expenditure in the year of incurrence itself. Already 2010 is over. Now you are in 2011. Don't think about the last year. Current year what need to do? To confirm with the parent company policy. Reduce the balance expenditure, right? So 30,000. So if I written off the advertisement expenditure, my P&L account balance will be debited, na? That's why my reserve deducted. Hello? So tell me, what is the balance? 6 lakhs. That's it. So here I need to consider 6,59,000. This is the important thing. Okay. So can you tell me the total of the equity and liability side? Total of the equity and liability side. 2253. That's it. Now come to the asset side. What changes we need to do? Inventory. So inventory 6. Correct or this total? Yeah, okay. Now inventory, how much? Inventory, come to inventory. What is the note number for inventory? 6. Inventory. Important, sir. Inventory, what is the balance given, sir? 7 lakh. How much I need to reduce? 34. Reduction. Reduction 34. So how much is the balance? 7 lakh 8,000. Gone. That's it. Next step. Inventory, trade receivables. How much given? 891. I need to add back provision. Add. Correct? Provision for doubtful debts 9,000. So my debtors will be 9 lakhs. And last one, other current assets. In other current assets, prepaid expenses are there. Correct? Prepaid expenses total 48. In that, advertisement expenditure I cancelled na, written off. So advertisement expenditure I written off. Therefore, to this extent, my prepaid expenses will be reduced. Asset. How much? 30. So what is the balance? 18,000. You understand this? So therefore, inventory, how much I will take? 7 lakh. 7 lakh 8,000. Trade receivables 9 lakhs. Next, other current assets 18,000. Tell me the total. Talida, please check. Okay. 20 total 53. Correct? Yes, that's it. 20 to 53. Now what wrong in the book? Tell me. Maybe I think it has missed. Maybe it is in the table. It was hided. I think. Notes alone missing. I think correct only they have given it. Because how then? How can they got 6,59,000 in reserves? They got it correct only in here. So that's it. Okay. So this is illustration 16. So what is illustration 16 is all about? Uniformity of accounting policies. Why we need to do uniformity? Because subsidiary policies are different from parent. So to bring with parent, we need to do this. Have you understood this? So main adjustments are reserves and surplus, 3 assets. Okay, that's it. This is illustration 16 relating to difference of uniformity of accounting policies. So let me start. Accounting standard 23. Accounting for investment in associates in consolidated financial statements. Accounting for investment in associates in consolidated financial statements. Okay, sir. Sir, listen to me carefully, sir. First of all, what is associate? We need to understand. Because AS 23 basically talks about accounting for investment in associates in consolidated financial statements. So here this standard talks about associates in consolidated financial statements. So first of all, you should be a parent company. You should be a parent company, you should have a subsidiary. If you have a subsidiary, you need to prepare consolidated financial statements as per AS 21. Then for you, AS 23 is also applicable. Basically, understand, basically you are a parent company, you are already preparing consolidated financial statements. Now if you have any associate, then you need to consider the associate also when you are preparing the consolidated financial statements. But if you observe the name of the standard carefully, sir, you will understand the crux of this standard. Here the standard name is Accounting for Investment in Associates, and that too in consolidated financial statement. That means this standard is applicable only in CFS. When you are preparing CFS as a parent entity, and if you have any associates, if you have any investment in associate, how the accounting you need to do, that is what this standard talks about. First of all, understand what is associate. See, associate is an enterprise which is neither a subsidiary nor a joint venture. It is not our subsidiary and it is not our joint venture, in which investor has significant influence. So what is the main criteria to become associate? Significant influence. What is significant influence? Having 20% or more control, directly or indirectly. If you have 20% or more control in any entity, directly or indirectly, okay, that is called significant influence. Sir, 20 or more means even it can be more than 50. If it more than 50, it becomes a subsidiary. But I told an enterprise other than subsidiary. Because if it becomes a subsidiary, sir, then the consolidation is done as per AS 21. Please understand. Because in case of subsidiary, the concept of control will come. I told you, parent subsidiary relationship will come because of control. Here, first of all, an enterprise is not a subsidiary for us, not a joint venture, but we have significant influence in that enterprise. That will be our associate. Okay? So neither subsidiary nor joint venture, but we have a significant influence. What is significant influence? 20% or more, directly or indirectly. That 20% or more means minimum 20 up to 50. That's it. 20 to 50. Because once it crosses 50, subsidiary. Once it's a subsidiary, it is not an associate. Okay. Now, say this. For example, there is a company A Limited, sir. It is having 15% shares in B Limited. 15%. So it's a normal investment, sir. Normal investment. A Limited is called investor. A Limited is called investor. And if we invest in shares of any company, if it is a normal investment, in the individual financial statements, the accounting is done as per accounting standard 13. We have accounting standard called accounting standard 13, accounting for investments. By following that standard, we will do the accounting treatment when if it is a normal investment. See the second case. A Limited is having more than 50% in B Limited. That means parent subsidiary relationship will come. Parent subsidiary. Therefore, if you are preparing parent company standalone financial statements, the accounting for investment is done as per AS 13. If you are preparing consolidated financial statements, the accounting is done as per AS 21. Just now we have finished AS 21. So tell me, if you are a parent company, you are preparing your individual financial statements, right? And how you are going to do the accounting in your individual financial statements? By following accounting standard 13. But when you prepare consolidated financial statements, AS 21 we need to follow. Sir, every enterprise will prepare two financial statements. One is individual financial statement, another one is consolidated financial statements. If you are a parent company, you need to prepare your individual financial statements as well as consolidated financial statements. In your individual financial statements balance sheet, we need to show investment in subsidiary. We have solved questions also, na? Parent company individual balance sheet, investment side, asset side, investment is there na in subsidiary, and that accounting is done by following accounting standard 13. But if you want to consider subsidiary for consolidation, 21. Suppose imagine you are A Limited, okay, you have 20 to 50% in B Limited, 20 to 50. That means it is not a normal investment, it is not a controlling interest, it is non-controlling interest. See, below 20% normal investment, minimum 20 up to 50 is significant influence, above 20 controlling interest. If any enterprise, you invested in any enterprise more than 50, that means you have control, that becomes your subsidiary. Follow AS 21 for consolidation. Any enterprise you invested less than 20%, that means there is no significant influence generally. So treat it as a normal investment, don't consider it for consolidation. But any enterprise where you invested minimum 20 up to 50 and you are having significant influence generally means 20% or more, then you say this is your associate company and you follow AS 23 for consolidation purpose. In the individual balance sheet we follow AS 13 only, AS 13 only. But when you are preparing consolidated financial statements, being a parent company, if you are consolidating subsidiary, we follow AS 21. If you are consolidating associate, we follow AS 23. Okay? So you understand the concept of associate? First of all, tell me what is associate? Which company will become our associate? Basically, that company should not be our subsidiary and joint venture. And in that company, we should have significant influence. Significant influence means generally more, not more than 20 or more, directly or indirectly. That means basically you are investing in another company and the investment is minimum 20 up to 50. Okay? Then you need to consider that associate for consolidation purpose. You need to consider that associate for consolidation purpose. Then AS 23 you need to follow. AS 21, 23, 27 is applied only when you are preparing consolidated financial statements, not individual financial statements. And also I told you, AS 23 is applicable to which company? Basically you should be a parent company. For you AS 21 is already applicable. Parent company means you should have a subsidiary, then only we call parent na. Already you are a parent company. You are preparing consolidated financial statement as per AS 21. Suppose if you have any associate company, then you need to consider that associate also for consolidation purpose as per AS 23. Suppose I am not a parent company. For me AS 23 applicable? No, not applicable. Because if you are not a parent company, you are not required to prepare CFS. CFS is not mandatory if you are not a parent company. Because I told you, in the CFS beginning I told you, section 129 says, consolidated financial statement is mandatory for only parent company. Parent company. That means parent company means you should have a subsidiary, first of all. That's it. So understand, associate is an enterprise other than subsidiary or joint venture. In that we have significant influence. That means 20% or more, directly or indirectly. Okay. Now listen to me carefully, sir. Sir, if any company invests in associate company for consolidation purpose, we need to follow AS 23. AS 23 suggests one method for accounting, that is called equity method. AS 23 suggested equity method for accounting of investment in associate company in the consolidated financial statements. Which method? Equity method. Equity method is very simple method. Only two things are involved. First, remember this point. Always record investments initially at cost. Your investment in associate initially will be recorded at cost. First point over. Tell me, you are investing in associate. your investment will always be recorded at cost. In CFS, see, I am not talking about standalone financial statements. I am talking only about CFS. Whatever I am talking, it is applicable only for CFS. Please understand, I am talking 23. Simple. Whatever the investment you had in associate, initially it is recorded at cost. Point number 1. Point number 2. When the associate company earning profits, okay, to the extent of your share in that profits, okay, increase the investment amount. When associate company profits are increasing, as an investor, your share in that profits, you add to your investment over AS 23. That's it. That's the only thing. Very simple. Those who understand the crux of the standard, this is very simple. So you just follow me. So I am parent company. You are my associate. I invested in your company. So that investment is my asset. I will show that investment in my books at cost initially. Cost only I will show. And then as an associate company, you are doing business. Every year you are earning profits. In that profits, whatever my share, add to my investment. Investment to my P&L account, credit. Whatever profits earned by the associate company, in that profits as an investor, what is my share? That share I will debit it to my investment account, credited to my P&L account. That's it. But here the important thing is presentation. How you are going to present your investment in the consolidated financial statements. But the crux is this. Initially investment will be recorded at cost. Every year associate company profits, your share will be added to investment account, credited to your P&L account. This method is called equity method. This method is called equity method. Very simple, Nana. So see this, everybody. What is equity method? See this. What I have given here. An investment in associate is accounted for in CFS only by following which method? Equity method. Observe my wordings carefully. Investment in associate is accounted for in CFS only by following which method? Equity method. But there are two exceptions to this. Two exceptions. We don't follow AS 23. When your investment in associate is for temporary period, that is, if you want to sell your investment in near future, then don't follow AS 23. Sir, then how to account it? Follow AS 13. Follow AS 13. Generally, as a parent company, if I invest in any associate, as an investor, if I invest in any associate, for consolidation purpose, I need to follow which standard? 23. But if I invest in associate, I want to sell it in the near future. I want to sell it in the near future. Then I should not follow AS 23. That is one exception. Second, when associate is operating under severe long-term restrictions. Severe long-term restrictions. When your associate is operating under severe long-term restrictions, which significantly impair its ability to transfer funds to the investor company. Sir, you have an associate, sir. But that associate is operating under severe restrictions. Now, because of that, its ability to transfer funds to the investor is decreased. Then don't consider such kind of associates for consolidation. Have you seen these 2 points anywhere? Yes, AS 21, same points. When a subsidiary is not considered for consolidation. Tell me, when a subsidiary is not considered for consolidation? When the control is temporary. That means you invested in any company more than 50% with an intention to sell it in the near future. Second, when your subsidiary operating under severe long-term restrictions. Same points here also. So when you are an investor company, if you have any associate and you invested in that associate with the temporary intention, I mean you want to hold the investment for a temporary period, then don't apply AS 23, apply AS 13. Then suppose for example your associate is operating under severe restrictions which significantly impair its ability to transfer funds back to the parent. Then such situations don't consider this associate. For don't follow AS 23. Then which standard we need to follow here? AS 13 we need to follow. Okay, AS 13. See this, AS 13 we need to follow. See this, two exceptions. Investment in associate for a temporary period, that is sale in near future. Next, associate operating under severe long-term restrictions, which significantly impair its ability to transfer funds to the investor company. Okay. So equity method. See this, sir. Everybody, see this equity method. Equity method. What they're telling about equity method, say this. Equity method is a method of accounting whereby the investment is initially recorded at cost, identifying goodwill or capital reserve arising at the time of acquisition. Initially recorded cost by identifying goodwill or capital reserve arising at the time of acquisition. Next, the carrying amount of investment is adjusted thereafter for the post acquisition change in the investor share of net assets of the investee. So initially you record investment at cost, then this carrying amount of investment will be subject to change. Subject to change for what? For the post acquisition change. After you acquiring associate, whatever the change in the investor share of net assets, accordingly you need to change your investment value. In the consolidated statement of P&L reflects the investor share of the results of the operations of the investee. Whatever your share in the associate company results, profits, in that your share will be credited to your P&L account. Okay, okay. So just I have read the theory. Now I am going to take one practical question to solve this. So look at this example. It's a beautiful example I have drafted. With this example you will understand this concept better. Okay. Now look at this example, everybody. Look at this example. There is a company A Limited, okay, which is a parent company. Parent company means holding, which is already having a subsidiary. Now their consolidated balance sheet is given on 31st March 2023 without AS 23. That means this balance sheet is without AS 23. That means we have not yet considered associate for consolidation. This is after considering subsidiary for consolidation. See this, A Limited acquired 30% shares in B Limited on 31st March 2023. There is a company A Limited which acquired 30% shares in B Limited on 31st March 2023. That means there is a associate, because A Limited is already which company? Parent company, right? Now look at the balance sheet items of A Limited. Fixed assets, how much is there? 160. Current assets 100. Look at the other asset, investment in associate. In A Limited balance sheet asset side there is investment in associate. How much is there? 40. Correct? 30%. Okay. Liability side share capital 100. Reserves and surplus 150. Minority interest 50. See, this is the balance sheet of A Limited. Now look at the balance sheet of B Limited, everybody. Look at the balance sheet of B Limited. B Limited balance sheet is an associate company of which company? A Limited. This balance sheet is given on 31st March 2023. Fixed assets 80. Current assets 20. Share capital 50. Reserves and surplus 50. Now prepare consolidated balance sheet with associate AS 23. Okay, so this is the A Limited balance sheet, this is the B Limited balance sheet. What is the relationship between A and B? Associate. B is the associate of A. Now A Limited is already which company? Parent. That means it need to consider associate also for consolidation purpose by following which standard? 23. Now tell me, how you are going to consolidate AS 23? I mean consolidate this associate company into parent company. Generally if it is a subsidiary company, what we have done? Assets we added, liabilities we have added. Share capital we have considered only parent company. Subsidiary company reserves and surplus we analyzed into pre-post, pre-capital profits, which is adjusted to cost of investment, cost of control step, like that minority interest, all these things we decided na. But here all those things are not required. Why? Because we are having only 30% non-controlling interest. We are not able to control this company. Therefore, you cannot take assets, liabilities directly, we cannot add, because that will be done by parent company. This B limited is, we are not parent company. See, A limited is not the parent of B. A limited is the parent company of some other company. We have our subsidiary. This is only our associate. We are having only 30% share in this. Sir, with 30% will you get control? No. Therefore, you cannot add assets. You cannot add liabilities directly as you done in case of subsidiary. Okay. Sir, then what we need to show? We need to show investment. Whatever your investment is there in the associate, you show it as an asset in the consolidated financial statement. At what value? Initially, cost. What is the cost of investment? 40. But AS23 says you show investments at cost only, but presentation is identify the goodwill or capital reserve also. Identify the goodwill or capital reserve. So first point, Nana, very simple. If you are an investor company, if you have an associate, in consolidated financial statements, you cannot add associate company assets, liabilities like you done in case of subsidiary. First thing. Only thing is, as an investor, your investment in associate, we will show in the consolidated balance sheet as our asset investment. But that investment is initially recognized at cost. But when you are presenting it, at cost, you need to show the goodwill or capital reserve also. What is this goodwill or capital reserve? Simple logic, same logic. Say this. I am A limited, right? Hello, everybody please concentrate. I am A limited. How much I invest in B limited? 30%, correct? That means this is the 30%. For this 30%, how much I spend? 40. Now, with this 30%, in B limited, how much worth of net assets I will get? 30%. In B limited, I invested in 30%. That means I am eligible for 30%. So therefore, see this. A limited an investment, B limited reserves and surplus. Sir, my investment is B limited share capital only, sir. I invested in 30% of shares, sir. That means it is part of share capital and reserves and surplus only, sir. That means, see, what is the net assets of B limited? 100, right? In that, what is my share? 30. 100 into 30. 30. What is my cost? 40. 40 minus 30. 10. Goodwill. Same as AS21. AS21 says first you need to take cost of investment. What is the cost of investment? 40. Any pre-acquisition dividend? Minus. Same as usual. If associate company gives any dividend, if it is a pre-acquisition dividend, minus. That is same. So first you need to take cost of investment 40 minus investor share in the associate company net assets. Because the logic is same, sir. Sir, in a particular day, I acquired 30% of your company by spending 40. And by investing 30%, how much share I will get? 30% only. So I am getting 30, but I paid 40. I paid 40. Therefore, what is the difference? 10. I spend excess na? That is goodwill. So even in case of AS23 also, you need to calculate cost of control. Cost of control. Either goodwill come, capital reserve will come. And when you are presenting in the balance sheet, consolidated financial statement, consolidated balance sheet, you need to show here share in net assets 30, add goodwill 10, total 40. Here you cannot present directly investment in associate 40. In the consolidated balance sheet, how you need to present? Share in net assets 30 plus goodwill 10, 40. Like that you need to show. That is equity method they are saying. Anyway, you are showing how much? Cost only. Cost of investment how much? 40. Anyway, you show 40 only. But presentation is different. How you are presenting? Share in net assets plus goodwill. So, understand. So if I am A Limited, if I am investing in subsidiary associate company, what is my share? 30. But what amount I am spending? 40. This is my cost. So in my balance, in the consolidated financial statement, we need to show 40 only. But how I am going to present? Share in net assets 30, add goodwill 10, 40 I will show. This is the initial measurement. Now look at the consolidated balance sheet. Everybody please see this. Look how I am presenting it. Now take first fixed asset with associate. If I A Limited prepares consolidated balance sheet with associate, fixed asset 160 they have taken. 160 only which company? A Limited only. Will they added this 80 also? Associate company fixed assets added? No, not added. Why? We don't have controlling interest in that company. We are just investors, ante. Normal investor. No, I mean, investor with a significant influence. You cannot add like subsidiary company assets, my assets. No, you cannot do that. So therefore you take 160 only. See this, 160. Only A Limited. Current assets, how much you will take? 100 only we need to take. We cannot take associate 20. Okay, sir. We are having 30% share in net assets, sir. We will take 30%, sir. No. Because AS 21 says parent company should do 100% consolidation. If you are having 30%, somebody else is having 70%. They will do 100% consolidation. And in their books, you are minority interest. I am minority interest, sir. Here, if you observe the concept clearly, we are having how much? 30%. That means some company having 70. In their books, I am what? Minority interest. Sir, if I tell you the logic, simple. How minority interest is calculated, the same manner we will show here. That's it. We are minority shareholders, nothing but. Minority shareholders, how we calculate in AS 21? Share capital into minority share. Capital profit into minority interest. Revenue profit. I mean, as a minority shareholders, what is my share in the net assets? Same manner I am doing. Okay. So therefore you see here. Share capital, which share capital you will take? Parent. What is the parent company share capital? 100. Reserves on surplus? 150. Minority interest? Same. Parent company 50. Because already whatever the items are there in this parent, we will take it. But look at this investment. Investment in associate also I will take it at what? 40 only. Why 40 at cost? But look at the presentation. Look at the presentation. How they have presented it? Everybody please watch. Share in net assets how much? 30. Goodwill how much? 10. How to calculate goodwill? See this. Calculation of goodwill or capitalism. Amount invested 40. Share in net assets 100 into 30. Because on the date of investment in the associate company, what is the net assets? 100. In that 30%, 30. So how much excess I spent? 10. So this I need to present here. Anyway, I am showing at cost only, but the presentation you need to look at. This is what AS 23 says. Investment will be shown at cost by reflecting share of net assets and goodwill. Sir, okay, sir. This is first year, sir. That means this is on 31st March 2023. Sir, tell me, sir. Frankly, tell me. You understood? So tell me, if you have an associate, so as a parent company, will you follow which standard you will follow? AS 23 in consolidation. In consolidated balance sheet, will you add associate company assets and liabilities? No. Then what you need to show? Only investment in associate. Why? Because you don't have controlling interest. You are minority shareholder, nothing but. So we will show only investment, and that too, that investment will be shown at cost. But how presentation will be done? Share in net assets, add or less goodwill or capitalism. And the goodwill or capitalism calculation same as AS 21. Same as AS 21. We need to compare with cost of investment with the share in net assets. This is in the first year. Suppose you, in this case, see this. A Limited acquired 30% shares in B Limited on 31st March 2023. 2023 over. Next year. Come to next year. Very interesting here. See this. Come to next year, 31st March 2024. Look at the A Limited balance sheet. Fixed assets 250. Current assets. Investment in associates same na. last year 40. Share capital 100. Reserves and surplus, minority interest 75. Sir, last year fixed assets how much, sir? In A Limited 160. Now become 250. Why? Increased, purchased. Current assets last year how much? 100. Now how much? 60. Decreased. Investment unchanged. You look at this. Investment in associate cost only, na? Share capital how much last year? 100. This year also? Reserves and surplus? 150. Now also? 150. 175. Increased. 25 increase. Profits. Current year profits earned by A Limited. Minority interest also 75. This is the balance sheet of which company? A Limited. Now look at our associate balance sheet. Fixed assets 120. Current assets 30. Share capital 50. Reserves and surplus 100. Now you tell me the difference. Carefully observe. This is the concept. That's it. If you learn this point, this standard is over. Now B Limited, look at the balance sheet of the last year. This is the balance sheet of the last year. Tell me how much is the last year share capital and reserves and surplus? 100, 50, 50. This year, see this, 50, 150. 50, 100, 150. That means when compared with last year, reserves and surplus increased by 50. That means profits. Profit increased by 50. And you see, last year, our assets 100 only. This year, 150, 50 increase. Last year, our reserves and surplus 50. This year, 50. Now, you need to prepare the consolidated balance sheet. A Limited, B Limited. First year, 31st March 2023 over. Now, 31st March 2024. You need to again consider consolidation for associate for consolidation purpose. So, in the consolidated balance sheet, what you will show? Investment. Investment already showing at what value? 40. Right? Now, in the next coming years, what we need to do is, in the subsidiary company, how much profit increased? Net assets increased. 50. In that, as an investor, what is my share? 30%. 50 into 30%. 15. Add it. Add to your investment and credit to your P&L account. That means investment to reserves and surplus. That means as an investor, my investment will increase 15 and also my P&L account is credited with 15. That's it. If it is a profit, add. If it is a loss, less. Sir, what is this concept? See, simple. If I am investing in your company 30%, 40 rupees I invested, right? So in my balance sheet I will show my asset 40 rupees. Okay? That means indirectly this 40 is what? My share in your company net assets. Actually my share in your net assets is 30. But I spend excess how much? 10. So therefore 30 plus 10, 40 I am showing. Anyway, my share in your net assets 30 plus whatever excess I am showing, paying to you, 10 goodwill, both are I am showing now 40. Now next year, if associate company net assets increases, my share in the net assets will also increase. Na? Last year your net assets 100, this year, then how much increase? So therefore, in that 50, what is my share will also increase. Your 30%, last year 100 into 30, this year 150 into 30. So it becomes what? 45. Hello? So therefore, when compared with last year, how much increase? 50. In that 50, 30%. How much? 15. So you need to increase to that extent. Investment value. So therefore, see what they have done. See this, see this, see this. Everybody see this. Investment in associate. Share in net assets, initial 30. Goodwill, 10, 40. Share in profits, current year profits, post-acquisition profits. Post-acquisition profit how much? 50. In that my share, 30. 15 added. So, my investment carrying amount is 55. Including goodwill. 30 plus 15, 45 plus goodwill, 55. That's it. But can you tell me what is the entry for this 15? For this 15, the entry is investment account debit to P&L account. I mean nothing but your reserves and surplus. P&L account will be credited. Your reserves and surplus will be credited and investment account will be debited. See this. What is the entry? In consolidated P&L account of A Limited, we need to show other income. In that other income, share in profits 15 we need to show. Share in profits we need to show 15. That means the investment account, the investment value in the parent company, okay, dancing for the tunes of net assets of associate. If the net assets of the associate increasing, my carrying amount will also increase. Decreases, decreases. Yes. So point here you need to understand is, we are not controlling associate. It is not our controlling company. Like in AS21 we calculated minority interest. Minority interest, no difference, no farak. We are just calculating what? Net assets, what is their share? Correct? Similarly, you are a minority interest holder here. Therefore, whether it is pre or post, it doesn't matter. What is your share in the net assets? Correct, sir? Sir, I am not parent, sir. I am not parent. I am having only 30% in your company. That means I am a minority shareholder. We have done AS21. How we calculated minority interest? Simply on the date of consolidation in the subsidiary company, total net assets into minority interest we done. Same manner here in the net assets of associate company into my share. I will do it. But initially in the consolidated balance sheet, I will show at cost. Every year I will adjust it according to the increase and decrease of net assets of associate. According to the increase or decrease in the net assets of subsidiary. Like how minority interest balance is changing. If the subsidiary company net assets decrease, minority interest balance will also decrease, na? Same manner. AS23 is nothing but minority interest calculation only. Tell me, how many of you understood this? Understood? So tell me, equity method. So initially, come on, 2 questions only you need to answer. Initially, recorded cost. Fixed cost, how you present? Share in net assets, goodwill or capital reserve. That's how you present. But ultimately you show only cost. First year over. Next year associate company in net assets may increase. When net assets increase, in that net asset what is your share? You should add to investment, credit to P&L, investment to P&L, investment to P&L. This is consolidated. Your investment at the consolidated P&L. In consolidated P&L, other income you show. Because in the associate company, you don't have controlling interest. So whatever the net assets, their increase, their profits increasing, in that my share, I will credit to P&L account. Consolidated P&L account. Okay. Next. Yeah. I am giving example number 2. You solve and tell me. Example 2, you see this. Example 2. A Limited invested in B Limited. How much? 25%. That means associate. Hello. How much amount invested? 4 lakhs. What is the date of acquisition? 31st March 2011. Now on the date, B Limited, associate company balance sheet given. Now simple, think like this. On the date of acquisition, associate company net assets how much? 10 lakhs. Simple, 10 lakhs, see this. And what is my percentage? 25. 10 lakhs into 25. 2 lakh 50 is what? Share in net assets. Share in net assets. And how much I am investing? So how much excess? Goodwill. So therefore on 31st March 2011, in the consolidated balance sheet, investment in associate company, share in net assets 2 lakh 50, add goodwill 1 lakh 50, 4 lakhs you will show. Over. Done. See this. Presentation. Asset side, non-current assets, and if you are preparing as per schedule 3, Asset side, non-current investments, non-current assets, non-current investments. Generally investment will be shown. Investment in associates. See how I am showing. Share of net assets. How much? 2,50,000. Add goodwill 1,50,000. Total 4 lakhs. And how I need to calculate what? Cost of control. To get goodwill or capital reserve. How to calculate? First, what is the amount invested? 4 lakhs. And what is my share in the net assets? Total 1,50,000 is the goodwill. Now next year balance sheet is this. Okay, I am not saying anything. You just tell me how you are going to do this. Next year associate company balance sheet is this. Simple. What is your net assets? Net assets 17. Last year 10. How much increase? In that 7 lakhs, what is your share? 7 lakhs into 25. Add. 5,75,000 total, okay. But see, 1,75,000 added. This 1,75,000 investment account debtor to consolidated P&L other income. See this, investment in associate to reserves and surplus. Yeah. Of course, I will tell you disclosures also, but this is the main crux. Nothing is there. No, presentation only. Yeah, we need to show separately. Presentation wise, this standard. But of course, ultimately you know the substance, then presentation is only just a matter of time. So see this, how I am presenting in the current year, sir. See this. Non-current assets, so non-current investment, investment in associate, share of net assets 2,50,000, goodwill 1,50,000, share of profits 1,75,000, total 5,75,000. And that means how much is my share in the current year? 1,75,000. So when the associate company net assets increase, to that extent I need to increase my investment value, and also I need to credit to my P&L account. So other income, share of profits 1,75,000. Because see, I am minority shareholder. I have the luxury. I am not the subsidiary. I am not the parent. I am not the parent company. Like in AS21, if I am a parent company, a lot of headaches are there for me because I am having a controlling interest. Right? Therefore, goodwill calculation, post acquisition. But if I am a minority interest, pre na post doesn't matter for me. What is my share? That's it. Okay. Now see this. Ultimately, what you need to remember is these two things. Finally, I have presented here how we need to present. See this. Everybody, please see this. Calculation of carrying amount of investment. Sir, in examination, if at all they asked any question, you need to present the investment in associate, right? How the presentation will be done? Like this. See this, calculation of carrying amount of investment. Okay. Which company will present this? Parent. Investor. First we need to take what? Share in value of net assets. For that, what we need to adjust? Goodwill or capital. Then automatically you will get cost. Then you need to add what? Investing company share in which profits? Post acquisition profits of associate. Profits means profits or losses, including losses. Okay. And also dividend paid by associate company. If associate company gives any dividend, automatically associate company net assets will decrease, profits will decrease. Therefore, you need to reduce your share also. Sir, simple logic, sir. Your investment should be in line with net assets. If the net assets of the subsidiary company decreasing, you decrease. Increase, you increase. If the associate company gives a dividend given means associate company reserves and surplus decreased. That means net assets decreased. Therefore, you need to decrease your investment value. Hello. Simple. This is how you present. Tell me how presentation will be done. How to present the carrying amount of investment? First, share in value of net assets. Add or less, goodwill or capital reserve. Then you need to add one more thing. What is it? Yes, this one. Investing company share in the post acquisition profits of associate. Any dividend received, adjust. If it is a pre-acquisition dividend, adjust from cost of investment. That is normal. Normal. And in the P&L account, how they are presenting? See this, other income. Share in profits. I mean, in the current year associate company, what is my share? In the current year profits of the associate company, what is my share? I need to show. I need to credit to P&L account. And also any pre-acquisition dividend received minus amount transferred to investment. Generally, if pre-acquisition dividend received, entirely it is transferred to P&L account. I mean, investment account. But you need to present like this. Share in profits, pre-acquisition dividend minus transfer to investment account. And of course, you need to calculate cost of control also. Because you are presenting share in net assets, goodwill or capital reserve, you are adding separately, na? So this, how you calculate goodwill or capital reserve? First you will take amount paid, cost of investment. If any pre-acquisition dividend received, adjust, like in AS21. And investing company share in the value of net assets of associate company, goodwill or capital. Same procedure of AS21. Hello? That's it. So this is how the presentation will be done. So ultimately, sir, what I need to remember, listen to me carefully. I will sum it up, then this standard will be this much. You can't imagine how easy this standard is. I don't know why students are, I mean, AS23, sir, I don't have any idea about AS23. There is nothing to learn in AS23. Only thing is that in AS21 we calculate minority interest. Na? You are a minority shareholder now. You calculate your interest, your balance in net assets. That's it. If you understand the concept, everything is easy. Your fear will go away. If you don't understand the concept now, always be in fear only. So that's why you cannot find for shortcuts. If you are trying to find shortcuts now, always you are in a constant fear only. The person who understands the truth, he will not get any fear. Always you need to try to understand that. What is actually there here? You need to understand like that. What is the concept? Okay, here what is happening? Like that you need to think. Investment in associates, sir, what is this investment? Share in net assets, what that thing? Very simple. So, the conclusions of AS23, tell me. First point, associate company, it is not a subsidiary, not a joint venture, but we should have what? Significant influence. What is significant influence? Having more. Okay, even if you have 20 or more, if you don't have significant influence, then it is not an associate. Sometimes just having share capital is not a significant influence, but generally in theory discussion we will say that significant influence means having 20 or more. But practically speaking, sir, you are having 20% doesn't mean that you have a significant influence. Actually, significant influence means ability to affect the other company in their policy decisions. But that much is not required. For accounting purpose, what you need to understand is minimum having 20. Okay. Now, when you are consolidating the associate, which standard you follow? AS23. Correct? In AS23, if you are an investor company, you will show investment in associate as an asset in your books. Correct? So, how you are going to present this investment in associate? Investment in associate. How you are going to present? Tell me. First, share in net assets. Okay. Then we need to adjust what? Add or less? Goodwill or capital reserve. Okay. Then you need to add post acquisition profits, your share. Post acquisition profits. Okay. And if any dividend received, less. Yes, dividend. That's it. You will get the carrying amount of the investment. And how to calculate this goodwill or capital reserve? Same as AS21. And Every year as an investor company, your share in the profits of associate company, your share in the profits of associate company. So in consolidated P&L account, you need to show other income. In that other income, you need to present like share in profits. What is your share in profits? You need to show. And then pre-acquisition dividend received. Any pre-acquisition dividend received, any. From that I need to deduct less transfer to investment account. Nil. Basically it's a nil only. Correct? Presentation purpose. So therefore this will be the thing. That's it. You need to remember only three things. Two things. How investment will be presented. Share of net assets, adjust goodwill or capital reserve, share in profits. Okay? Confident? So tell me, if you are investing in associate initially in the consolidated balance sheet, what you present? Investment. At what value? Cost. Later on, when the associate company net assets increasing, your share will also increase. So what is the entry? Investment to P&L. Correct? That's it. That means your investment is dancing to the tunes of net assets of subsidiary company. Associate company, sorry. Associate company music, this is dancing. That means their net assets increased, you increase, decrease, decrease. Investment to P&L, investment to P&L. But presentation matters. Sir, confident? Shall we solve questions? Yes. So AS23, illustration number 1. Illustration number 1. Hello. Shall we start? Yeah, see this. A Limited acquires 45% of B Limited shares on 1st April 2011. The moment you see 45%, what is your opinion? Associate. A Limited acquire 45% of B, non-controlling interest. Correct? 1st April 2011. The price paid was how much? 15 lakhs. The cost of investment 15 lakhs. Following are the extracts of balance sheet of B Limited on 1st April 2011. So associate company balance sheet extract given. Paid up share capital, securities premium, reserves and surplus. So total net assets 16 lakhs. Share capital plus reserves and surplus. Correct? 16 lakhs into 45. 45%. 7 lakh. So that means my share in the net asset 7 lakh 20. What is my investment? 15. Goodwill, how much? 7 lakh 80 goodwill. Correct? See this. B Limited has reported net profits of 3 lakhs and paid dividend of 1 lakh for the year ending 31st March 2012. Sir, this is 1st April 2011. That means opening, this is the position. In the current year, 11-12, our associate company earned a profit of how much? 3 lakhs. How much dividend they paid? 1 lakh. Now, calculate the amount at which investment in B Limited will be shown in the consolidated balance sheet of A Limited as on 31st March 2012. Now, I am giving 1 minute time to you. You tell me at what value the investment will be shown at the end of the year. Okay? Tell me. What value you need to show the investment value? Very simple. 15 lakhs, 90,000. Simple, sir. Initially we will show at what value? Cost 15. In the current year, what is the profit? 3 lakhs. And what is the dividend? 1 lakh. So 3 lakhs added, 1 lakh minus. Correct? And the net assets increase 2 lakhs into 45%. How much? 90,000. So 15 plus 90. 15 lakhs 90. In the opening net assets of the associate company, 16 lakhs. At the end, the profits have been increased by net 2 lakhs. P&L net profit at 3 lakhs, dividend 1 lakh. Okay? So therefore, how you are going to present this in the consolidated balance sheet? Correct? Very easy. So how much time it will take in exams? I think hardly 3 minutes. This they are asking for 5 marks. So see this. How you are going to present the investment, carrying amount of investment in this case? See, first always first compute goodwill or capital reserve. Tell me how you are going to compute. First you take the cost of investment. How much is the cost of investment? 15 lakhs. Okay. And then from this we need to reduce what? A limited share in net assets of B limited as on 1st April 2011. Sir, on the date of acquisition. Tell me. So equity share capital 10 lakhs. Securities premium 1 lakh. Reserves and surplus 5 lakhs. Total 16 lakhs. This is the net assets, correct? In that, what is my share? 45. How much? 7 lakh 20. Correct? Minus. So therefore, how much excess I invested? So this is goodwill. So I recognize goodwill. Same as AS 21. Okay. Now I need to present the carrying amount of investment, right? So carrying amount of investment in consolidated balance sheet for the year ended 31st March 2012. Tell me how we are going to present it. I told you now, first we need to take share in, yes, share of net assets as on 1st April 2011. What is my share in net assets? 7 lakh 20. Already we calculated. Hello. And we need to add goodwill. Then you will get what? Cost. How much is the goodwill? 7 lakh 80. Presentation. So how much? 15 lakhs. Cost. Correct? This is the initial amount. Now during the year what changes happened? So add A limited share in profits of B limited. Correct? In profits of B limited. For the year 11-12, what is the profit of B limited? 3 lakhs. In that 3 lakhs, what is my share? 45%. Simple, sir. When the profits of associate increase, their net assets will also increase, sir. Net assets means assets minus liabilities or share capital plus reserves surplus. Your reserves surplus increasing means your net assets increasing, na. So therefore, in that net assets increase 15, 13, 3 lakhs, your share 45. How much? 1 lakh 35 we need to add. But they have given dividend also. When associate company paid the dividend, obviously their reserves and surplus will decrease. That means net assets will decrease. When net assets are increasing, you are adding, na. When net assets decrease, less. So dividend paid by associate B limited. How much dividend they are paying, sir? 1 lakh into 45%. That's it. 45,000 reduction. So what is the carrying amount of investment? 15 plus 1 lakh 35 minus 45. 15 lakhs. That's it. That's it. I am minority interest. What is my share in the net assets of subsidiary? You can simply tell the answer, sir. Simple. You see the net assets at the end into 45. That's the answer. Because minority interest, that's how it is calculated, sir. Same man. Sir, you understand that? Here, most important thing is presentation. If you don't present like this, they won't allot marks. So, look at the answer. See this. How they have presented. See this. See this. First, this is the main solution. See this. Share of net assets 7 lakh 20. Goodwill 7 lakh 80. Cost of investment. Profits during the year 1 lakh 35. Dividend paid 45. So, the carrying amount of investment 15 lakh 90. And goodwill calculation. See this. Calculation of goodwill or capital reserve. Investment less net assets. In that net assets, what is my share? Goodwill. So two working, first goodwill or capital reserve working note you need to do, and then how investment will be shown you need to present. Sir, okay, wow, very simple. This is illustration 1. Sir, come to illustration number 2. Very simple. Illustration number 2. Everybody, see this. A Limited acquired 40% share in B Limited. Which company? A acquires 40% share in B Limited. Associate. Okay. On 1st April 2011 for 10 lakhs. On that date, B Limited had 1 lakh equity shares of 10 each fully paid. Accumulated profits of 2 lakhs. Okay. So opening my cost of investment 10 lakhs. The net assets of the associate company is 12 lakhs. 12 lakhs into 40%. Sir, simple sir. On the date of acquisition in the associate company, how much is the net asset, sir? Nothing but share capital 1 lakh into 10. 10 lakhs accumulated profit 2 lakh. Total 12 lakhs na sir. 12 lakhs into 40% share, sir. How much? 4 lakh 80. My cost of investment 10 lakhs. So how much excess I invested? 5 lakh 20. That is goodwill. Over. Hello. Anyway, I need to do goodwill calculation na. So goodwill over. Next see. During the year 11-12, B Limited suffered a loss of 10 lakhs. So 11-12 there is a loss, sir. Okay. During 12-13 loss of 12 lakh 50. Okay. During 13-14 again loss of 5 lakhs. That means next 3 years losses. Accordingly, your net assets balance will, net assets of associate will decrease. So you need to decrease your investment value. Instead of share in profits, we will get share in losses. That's it, na? Show, see what they are asking. Show the extract of consolidated balance sheet of A Limited on all 4 days regarding the above items. All 4 years. 4 year, all the 4 dates means first initial date on 1st April 2011. So see this, all 4 date means simple. 1st April 1st 2011 on the date of acquisition. Now first year end 31st March 2012. Next 31st March 2013. Next 31st March 2014. That's it, all 3 years. So tell me, initially you will show investment at what value? Cost, that is 10 lakhs. Correct? Simple. Cost. Presentation, net assets plus goodwill. But overall we need to show cost. First year what happened, tell me? First year during the 11-12 suffered a loss of 10 lakhs. In that 10 lakhs, what is your share? 40%. 10 lakhs into 40%. 4 lakhs. Therefore, your investment value will be reduced by 4 lakhs. Therefore, at the end of the first year, what is the carrying amount of investment? 6 lakhs. Your carrying amount of investment is 6 lakhs. Now come to the second year. Come to the second year. Second year again losses na? How much? 12 lakh 50. What is your share? 5 lakhs. First year share. First year your share 4 lakhs. Second year your share 5 lakhs. So 4 plus 5. 9 lakhs. Your cost of investment 10. So 10 minus 9 lakhs. How much? 1 lakh. Come to last year. Last year how much loss? 5 lakhs. In that 40%. 2 lakhs. So first year 5, second year 4, third year 2. So first year net assets in the associate decreased by 5. Second year net assets of the associate your share decreased by 4. Third year net assets your share decreased in the associate 2. 5 plus 4 plus 2 total 11. Your investment 10. So 10 minus 11 minus 1. Yes, 0, nil. Investment is 0. Yes, minority interest. Yes, very good. Actually, we have done one sum. You remember illustration 4? I told you minority interest cannot show debit balance. The moment minority interest crosses, that is adjusted to the parent company reserves. Same logic here also. Your investment should always be positive. The moment the associate company is earning more losses, obviously you need to get the share na, but you need to show maximum to the extent of investment value. That's it. You cannot show negative investment value. Sir, you understand this question? Very simple question. So simple, sir. Don't confuse. See here. See this. I will give you overall idea. Illustration number 2. What is the date of acquisition? 1st April 2011. You need to show the investment at what value? Cost. How much? 10 lakhs. This is over. First year. Just I am giving overall investment value. Second year. First year end 31st March 2012. What is the investment value will show? Simple. 10 lakhs is the original cost minus in the first year what is the loss? What is your total loss? 10 lakhs. In that your share is 40%, na? That means in the associate company net assets decrease by 4 lakhs. So therefore your investment value will also decrease by 4 lakhs. Therefore investment will be shown at 6 lakhs. Now come to the next year, 31st March 2013. Simple. Investment value 10. Already in the year 11-12, how much decreased? 4. Now in the year 12-13, what is the loss of the associate company? 12.5 lakhs. In that 40%, correct? How much? 5 lakhs. Therefore, what is the investment value? 1 lakh. Now come to the last year, 31st March 2014. Investment 10 lakhs value. In the year 11-12, 4 lakhs adjusted. Next to 5 lakhs adjusted, 12-13. And 13-14, again there is a loss. How much? 5 lakhs. In that 40%, how much? 2 lakhs. But 2 lakhs, if it and it is restricted to 1 lakh. Therefore, investment value will be nil. So that means my investment is dancing to the tunes of net assets of associate. If net assets is performing well, my investment value will increase. Otherwise, decrease. So this is how presentation will be done. Now look at the presentation, sir. In examination, the presentation plays a key role, sir. See this. First, they have calculated goodwill or capital reserve, sir. How to calculate goodwill or capital reserve, sir? First, you need to take cost of investment. How much, sir? 10 lakhs. 10 lakhs is the cost of investment. And what is my share in the net assets of subsidiary company? Associate company, sir. On that day, net assets is 12 lakhs. In that, 40%, 4 lakh 80. So 5 lakh 20,000. Correct? So, in the beginning, on 1st April 2011, I will show investment, share in net assets, 4 lakh 80, goodwill 5 lakh, total 10 lakhs. Come to second year, 31st March 2012, how investment will be shown? See this. This is the extract. Share of net assets 4 lakh 80, share in loss minus 4 lakhs, add goodwill. So total 6 lakhs. Hello? Order is changing. Actually, in study material, they have presented like this. Actually, in what we have learned is share of net assets, add goodwill minus share. But in the share of net assets in the beginning, they have reduced the loss and added goodwill. Anyway, the answer is 6. Next year presentation you do. Share in net assets same 4 lakh 80. Share of loss. Last year loss, this year loss. Total? Wrong, sir. This is. Yeah. No. Yeah. I think here share in the loss how much? 1213. Actually, goodwill they have not taken. Can you tell me the goodwill? That's it. Correct only. This is share of net assets 4 lakh 80 initial. Next to 2 years losses 9 lakhs. This I think we need to take 9. Correct? 4 lakh 80 minus 9 plus 5 lakh 20. 1 lakh. Correct? Last year also same. Last year investment will be nil. Accordingly. So this is how presentation will be done, sir. You understand this presentation? That's it. Here in examination, sir, either see calculate the carrying amount of investment. This either you present this or this. No need to present 2 times. Actually, why I don't know why they have given 2 times. But this one is sufficient, sir. Carrying amount of investment. Share goodwill less. Share in the loss. You will get the carrying amount of investment. First year and 6 lakhs. Second year and 1 lakh. Third year 0. Okay. That's it. This is illustration number 2. Now relating to AS 23, sir, we have some scenario based questions. So come to scenario based questions. 2 questions are there, 8, 9. Let's finish it. So see question number 8, scenario based question number 8. Look at this question. Observe carefully what they are asking. Bright Limited acquired 30% of East India Limited shares for 2 lakhs on 1st June 2011. So Bright Limited acquired 30%. That means it is our associate. What is the cost of investment? 2 lakhs. What is the date of acquisition? 1st June 2011. By such an acquisition, Bright can exercise significant influence over East India Limited. Okay. So significant influence can be exercised. During the financial year ending 31st March 2011, East India earned profits of 80,000. In the year 2011, sir, this associate company earned a profit of 80,000. Okay, 80,000. And declared a dividend of 50,000 on 12th August 2011. So they earned a profit of 80,000 in the year 2010-11 and they declared a dividend of 50,000. Okay, on 12th August 2011. East India reported earnings of 3 lakhs for the financial year ending 31st March 2012. Next year they earned a profit of 3 lakhs and declared a dividend of 60,000 on 12th June 2012. Okay, so here they are playing with the dates, so you have to be very careful. So first of all, if you analyze the question carefully, what is happening in this question? Very simple. See this. So this is scenario based question 8. Let us analyze this question. Actually in this case, if I draw the timeline 1/4/2010, year end 31st March 2011, correct now? So what is the date of acquisition? 1/6/2011, sir, date of acquisition. So 1/6/2011 is the date of acquisition. So this is date of acquisition. Okay, 1/6/2011 is the date of acquisition, right? Next what happening? During the financial year ending 31st March 2011, East India earned a profit of 80,000 and declared a dividend of 50,000 on 12th August 2011. Correct? So on 12th August 2011, dividend declared. Dividend declared. Sir, on 12th August 2011, dividend declared, sir. From which profits? Which profits they will declare dividend? Completed year. Already completed year is 10-11. 10-11 year completed, sir. See this, 10-11 completed. During the financial year ending 31st March 2011, East India earned a profit of 80 and declared a dividend of 50,000. That means the year which is already completed, for that year dividend is declared on 12th August for the last year. But last year you have the investment, huh? No, see this, you have purchased investment on 1/6/2011. That means the company is declaring dividend for the last year, but you don't have investment in the last year, but you purchased the shares at least just before declaration. Therefore you will also get dividend, huh? But what is the nature of the dividend? Pre-acquisition dividend, because it is given from pre-acquisition profits. Because you don't have investment in the 10-11, you purchased shares on 1st June 2011. Therefore till 1st June whatever the profits are there in associate, every profit is a pre-acquisition profit, right? So that means here these are pre-acquisition profits, this year profits. Now from this pre-acquisition profits they have given the dividend. Dividend given from pre-acquisition profit. Therefore this is called which dividend? Pre-acquisition dividend. Pre-acquisition dividend, what we need to do? Adjust to the cost of investment. Okay, so this is one thing. Next, okay, East India reported earnings of 3 lakhs for the financial year ending 31st March 2012. Assume profits to accrue evenly and declare dividend of 60,000 on 12/6/2012. Sir, in the next year, what is the profit they earned, sir? 3 lakhs. See this. That means 10/11 over, now 11/12. This one. 31st March 2012. Right? So, see this, important, sir. From 1/6/2012 to 31st March 2012, whatever the profits earned by the associate company, these are called post-acquisition profits. Correct? Sir, after you are acquiring associate, whatever the profits earned by associate is what, sir? Post-acquisition. Before you earning, whatever the profits are, they are all pre. Now, post-acquisition profits, how much? 3 lakhs. Now, from this post-acquisition profit, our associate company has declared a dividend. See this, 60,000 on when? 12th June 2012. Correct? So, on 12th June 2012, after the year end, the dividend declared. This is called which dividend? Post-acquisition dividend. So, understand the question carefully. Here 2 years data is given. 10/11, 11/12. 10/11 is the completed year. You don't have investment. Relating to that year, they have given the dividend from pre-acquisition profits. So, it's a pre-acquisition dividend. Next, 11/12. You acquire on 1st July 2011. Right? From that date to till the year end, post-acquisition profits. From that profit, they declared a dividend. That is a post-acquisition dividend. So, this is analysis of the question. Now, finally, what they are asking, see, calculate what? Carrying amount of investment in separate financial statements of Bright as on 31st March 2012. Individual financial statements. Sir, I told you, in case of individual financial statements, don't apply AS 23. You apply AS 13. So, they are asking separate financial statements. How much investment value will be shown in the Bright Limited on 31st March 2012? This is the first question. Second, consolidated financial statements of Bright Limited as on 31st March 2012. How will you present investment in the consolidated financial statements? As per AS 23. See, for this you apply AS 23. For this you need to apply AS 13. Next, what will be the carrying amount as on 30th June 2012 in consolidated financial statements? Okay. So, they are also asking what will be the carrying amount. Okay, we will show the carrying amount of investment also. Now, first, on 31st March 2012, so tell me at what value you are going to show the investment in the standalone financial statements. Simple. First bit answer. So, in the standalone financial statements, first of all, what is the cost of investment? Cost of investment. How much, sir? 2 lakhs. Less pre-acquisition dividend. We received pre-acquisition dividend, sir. How much is the pre-acquisition dividend, sir? Say this. They have given a dividend of 50,000. In that 50,000, your share is 30%. So, 50,000 into 30. If any dividend is given from pre-acquisition profit, it is adjusted to cost of investment. How much? 15,000. So, therefore, what is the carrying amount of investment? 1,85,000. This is the first bit answer. Very simple, na? See this. First bit answer 1,85,000. So, in the separate financial statements, first what is the amount paid for investment? Less pre-acquisition dividend. This is as per AS 13, sir. Carrying amount. Sir, AS 13 also saying same thing, sir. What is the amount invested? If you receive any pre-acquisition dividend, adjust to cost of investment. Over. Now come to the how it will be presented in the consolidated financial statements. In the consolidated financial statements, how you are going to present it? Second bit, CFS. First we need to show share in net assets. Correct? And for this we need to add or less goodwill or capital reserve. So first we need to calculate cost of control. Na? Hello? If I calculate cost of control, what is the cost of investment? 2 lakhs. What is my share in net assets on the date of acquisition? What is my share in net assets on the date of acquisition, sir? Why? Not given. So therefore, simply cost of investment. What is my cost of investment? 2 lakhs, right? Yeah. See here one point. Consolidated financial statements of Bright Limited as on 31st March 2012. Okay. See this. Here what we need to do is first to take the carrying amount of investment from SFS, standalone financial statements. What is the carrying amount? 1,85,000. For this you need to add share in profits, post acquisition profits, correct now? Post acquisition profits. What is the total profits of the year 11-12? 3 lakhs. Now see, important sir, you acquired associate on 1st June, that means April, May, 2 months pre, remaining 10 months post. So in this 3 lakhs, 10 by 12 into, what is your share? 30% is your share. How much? 25. So total it will be 2,60,000. Okay, because in this question we don't know sir, on the date of acquisition what is the share in net assets, we cannot able to calculate. So therefore simply take the cost of investment from SFS 1,85,000, because already pre-acquisition dividend we need to adjust it. And what is the share in the post acquisition profits? 275. So 2,60,000. So what is the difference between accounting standard 13 and accounting standard 23 sir? In accounting standard 13 sir, we just show the cost of investment adjusted with the pre-acquisition dividend. But in as per AS 23, your investment is subject to change in net assets of the associate company. So therefore, here you see your carrying amount is 1,85,000, and in the year 11-12, the proportionate share. Why 10 months profit I have considered? Because post acquisition only 10 months. You acquired subsidiary exactly, you acquired associate on 1st June 2011. So from this to year end, only 10 months. Therefore, you need to accordingly take 10 months profit into 30%, 75. So 2,60,000. One more thing they are asking, sir. What will be the carrying amount as on 30th June 2012 in the consolidated financial statements? Sir, in 30th June 2012, what happened, sir? Dividend paid. Correct, na, sir? Actually, company dividend of 60,000 they paid on 12/6/2012. When associate company gives a dividend, what you need to do? Their net assets will decrease. Therefore, you need to reduce it. Your share. In this 60,000, what is your dividend? 30%. 80,000. So 2,60,000 minus 18. 2,42,000. Because in the year 12-13, what happens? Dividend given by associate company. How much dividend they have given? 60. Sir, when dividend given by associate company, their net assets will come down. How much dividend they have given? 60. In that, what is your share? 30%. So 60 into 30. 18,000 you need to deduct. Understood? Very simple. Next. So same type of questions they have given in last question, sir. Nothing great. Okay. Same, they are asking goodwill, how dividend received will be shown, how A Limited will reflect the value of investment in B Limited in consolidated financial statements. Same questions they are asking, sir. 9th question you try once, sir. I think you can able to get it. Now let us discuss one small concept in accounting standard 23, that is step acquisition in case of associates. step acquisition in case of associate. Very simple concept, sir. Whatever the accounting treatment we have already discussed in case of investment in associate, same thing will be applied here. But first let us try to understand what is this step acquisition. See, when we say a company is our associate, when you have significant influence, that means having 20% share capital. Suppose there are two entities, A Limited, B Limited. When we say B Limited is the associate of A Limited, sir, when A Limited is having 20%. But sometimes what happens, this 20% may not be acquired at a time. It will be acquired stepwise. First, we will acquire some percentage. Later on, we will add another some more percentage. Like for example, A Limited acquired in B Limited 10% shares. After some period of time, another 10% was acquired. Now we got 20%. So this is called stepwise acquisition. So that is what they have given here. Stepwise acquisition in case of an associate. So when you are acquiring, when you have an associate company, and in that associate company, you don't have direct investment of 20%. Directly you are not acquiring at a time 20%. You are acquiring in portions. Then in such a situation, how the presentation will be done in case of investment in associate? Same treatment, sir. We have already discussed in case of AS23, generally how presentation will be done. You know, whenever we make investments, we'll calculate cost of control. We will compare cost of investment with the share in the net assets on the date of acquisition. We'll treat this as goodwill or capital reserve. And how the investments will be presented in the financial statements. First, we will take share in the value of net assets, add goodwill or capital reserve, and whatever the share in the post acquisition profits we will add, then we will get the amount. Same thing we will apply here, but the only thing is that every time when you are making an acquisition, separately we will calculate. See here in the study materials here, they have given 3 cases. With these 3 cases I will explain this concept. Same cases have taken from study material. You see this first case, conversion from passive investor to an associate in the same year. Initially I am a passive investor, that means I don't have 20%, less than 20%. Then I acquired further some percentage of shares so that other company has become an associate, and this happened in the same year. For example, here A Limited acquired 10% stake of B Limited on April 1st, further 15% on October 1st during the same year. So first 10%, next 15%. April 1st, October 1st. Cost of investment given and net assets also given. Now in this case, you know how to present the things. As I already told you, 2 times acquisition happened here. First April 1st, then October 1st. April 1st 10% acquired, October 1st 15% acquired. We will calculate cost of control. How cost of control will be calculated, sir? Simple, take cost of investment. What is the cost of investment for this 10%, sir? 1 lakh. And cost of investment for this 1,45,000. 1,45,000 cost of investment. Less share in net assets. Share in net assets on the date of acquisition. So net assets of the associate company on the date of acquisition is 8 lakh 50, 10 lakhs. So 8 lakh 50,000. Take 10%. Here 10 lakhs into 15%. So 8 lakh 50 into 10%, 85,000 is the share in net assets. Here 10 lakhs into 15%, 1,50,000 is the share in net assets. Right? So compare here, your cost of investment is 1 lakh, but your share in net assets 85. So 15,000 cost of investment is more. Investment amount is in excess of share in net assets. Generally we call this as goodwill. Here cost of investment is 1,45,000, but your share in net assets 1,50,000. So therefore the share, excess share in the net assets is treated as capital reserve. This already we discussed. So therefore here you see the net goodwill is how much, sir? 10,000. So every time separate acquisition happened, separately you calculate goodwill or capital reserve. This we know. Now how you are going to present it in the balance sheet, sir? Balance sheet, asset side, non-current investments, investment in associate company. Here B Limited is our associate company. So first we will take what? Share in profits. You remember the format, how we have done it, how presentation will be done. Share in profits, I will show you. First share in profits we need to take. So what is the share in profits here? 85, 1,50,000. So 85,000 plus 1,50,000, 2,35,000 is the share in profits. For this what we need to do? Goodwill or capital, sir. So if it is a goodwill, I will add goodwill. So 10,000 net goodwill. So it will be 245, sir. 2,45,000. That's it. This is the first thing. First case we have completed, sir. The first case they have calculated goodwill. See, 15,000. Second acquisition 5,000. Capital. So net total goodwill is 10,000. Case number 2, sir. Same case, but the only difference is second time when they are acquiring 15%, the cost of acquisition is 1,55,000. Remaining is same, sir. Same example. Everything is same, sir. First we acquired 10%, then we acquired 15%. But when we acquired second time 15%, the cost they have given here is 1,55,000. So this 1,55,000. So take here 1,55,000. If your cost is 1,55,000, share in net assets is 1,50,000, you will get what? Goodwill you will get. Goodwill. Right? 5,000. So in that case, our total goodwill will be 15 plus 5. It will be 20,000. Right? So when you are presenting share in profits 2,35,000 plus goodwill 20,000. So total it will be 2,55,000. Correct? 2,55,000. So this is how the presentation will be done, sir. Correct? So 235 plus total goodwill 20. 2,55,000. See this. In the second case, you see, sir, second case, they got a goodwill of total 20,000. So share in the net assets 85,000, 1,50,000. So 85 plus 1,50,000. Total 2,35,000 plus goodwill 20. So it will be 2,55,000. Second case. 2,45,000, 2,50,000. Okay. This is how the presentation will be done, sir. Presentation will be done. This is what I have taught you also, how presentation will be done. So in the first two cases, we have seen, sir, in the first case, we got a goodwill of 10,000. In the second case, we got a goodwill of 20,000. And how you are going to present the thing? What is the share in the net assets? And for that, I will add goodwill. So if it is a capital 0, I will deduct. Then automatically I will get the answer. Now, see the case number 3, sir. In case number 3, A Limited acquired 25% stake of B Limited on April 1st, sir. Further 5% on October 1st of the same year. Okay. Cost of investment for 25%, 1,50,000. For 5%, 20,000. Net assets on April 1st, 5 lakhs, sir. Profit for the year 90,000, earned in 2:1 respectively. So profit for the year 90,000 given, sir. Earned in 2:1 ratio. That means first 6 months, 60,000, second 6 months 30,000, because 2:1 ratio. See here 90,000 profit they have given, right? So 90,000 profit, if you share by 2:3 ratio, 2/3, 1/3, this is the ratio they have achieved. So first 6 months 60,000, second 60,000, second 6 months it is 30,000. Okay. Now very important, sir. First acquisition happened on April 1st. Correct? What is the cost of investment? First acquisition cost of investment 25% we acquired, sir. 1,50,000 is the cost of investment. Less, what is the share in net assets? Share in net assets. On that date, the net assets is 5 lakhs, sir. On 5 lakhs, 25%. So 5 lakhs into 25%, it will be 1,25,000. So therefore, your cost of investment is more than the share in the net assets. So therefore, the excess amount is treated as what? Goodwill, 25,000. So initial acquisition, we got a goodwill. Second acquisition happened on October 1st, right? So what is the cost of investment? Cost of investment is 20,000, sir.
Cost of investment is 20,000. And second time you acquired how much, sir? 5%, sir. 5%. Now you are acquiring this on October 1st. So if you see carefully, sir, from April to October 1st, first 6 months, so there is a profit. What is the profit for the 6 months? First 6 months, 60,000. Because 2:1 ratio, right? 60,000. In this 60,000, what is your share? 5%. And what is the nature of this profit? Can you tell me? This is a pre-acquisition profits, correct? Pre-acquisition profits, because you are acquiring this 5% on October 1st. That means from April to this October 1st, the 6 months, you don't have this 5%, but still you are eligible to get the share in this. So it is a kind of a pre-acquisition profit, which is nothing but capital profit to you. It's a kind of a capital profit. So share in the capital profit, 60,000 into 5%, 3,000. Right? So your cost of investment, 20,000, sir. Your share in the net assets, net assets initially how much given? 5 lakhs. On that, suppose 5%. So 5 lakhs into 5%. So it will be 25,000. So basically speaking, what? If I calculate the net assets of the B Limited associate company, initially it was 5 lakhs. Later on, profits was added. On October 1st, 60,000 profit. So it will be 5 lakh 60,000. On this 5 lakh 60,000, 5% share. That is what I have done. 5 lakh 60 into 5%. So it will be 28,000. So therefore, see this. I'm adding here. Sorry. This is less share in net assets. Share in net assets. See this. Initially, my cost is 20. My share in net assets is 28. So therefore, see this. When my cost of investment is less than the share in the net assets, this is basically what, sir? Capital reserve. Capital reserve. So therefore, my goodwill on initial acquisition 25. On second acquisition, there is a capital reserve of 8,000. So therefore, what is my net goodwill? 25,000 minus 8,000 reserve I adjust. 25 minus 8. So it will be 17,000. 17,000. So therefore, now if I want to present this in the balance sheet, how I am going to present it, sir? Tell me. First, I will share in profits. I will take each acquisition. What is my share in profits? In the initial acquisition, what is my share in profits? 125. I will take it. Plus, on the second acquisition, what is my share in profits? 28,000. Right? So therefore, 125 plus 128. So total it will be 2,53,000. And I will add goodwill for this. So goodwill I got 17,000 net. So add, sorry sir, I think 125 plus 28, it is 1,53,000. Not 2,53,000, it is 1,53,000 plus 17,000 goodwill. So it will be 1,70,000. Now guess what? Say this. I am preparing this investment at the end of the year, sir. At the end of the year. So on 31st March, see, 1st April, first acquisition, October 1st, second acquisition. Now at the end of this year, at the end of the year, add, what is my share? Initially, I have 25%, right? In the first 6 months profits, 6 months profit, total throughout, whatever be the profit, first 6 months profit is how much, sir? 60,000. Second 6 months profit is how much, sir? 30,000. First 6 months I have 25%. Second 6 months another 5% added, so it is 30%. So therefore, what is my share in revenue profits? Revenue profits for the first 6 months. First 6 months 60,000 profits, correct? And I have 25%. And what is my share in revenue profits for the next 6 months? 30,000 into 30%. I need to add, because the share in the post acquisition profits I need to add. There, please recollect the original concept what we have discussed. It is just a replica of the same. Say this. The concept is, I told you, the investment amount will dance to the tunes of the net assets of the associate company. So when the profits of the associate company is increasing, accordingly investment value will also change. So therefore, see, you have 25% on October 1st April. That means whatever the profits earned during the year, 25% will be added to your investment value. But here the twist is, first 6 months only you are having 25, next 6 months you are having 30%. So therefore on this 90,000 profit, first 6 months 60,000 profit, 25% share you will get. So 60,000 into 25, it will be 15,000 I will take. Next 6 months 30,000 and it will be 30%, that is 9,000. So therefore it will be 1,70,000 plus 15 plus 9. So it will be 1,94,000. 1,94,000. So this is how the things will be presented, sir. Things will be presented. This is how the answers will be done, sir. So this is the concept of step acquisition, sir. Whenever step acquisition happens, sir, you calculate separately the goodwill or capital, sir. Accordingly, you do the things. Very simple concept, nothing great, sir, here. And by the way, there are no questions relating to step acquisition in the study material. Okay, that's it.